Good morning, everyone. So this is our first FAR session, Financial Accounting and Reporting. We're gonna talk about a lot of topics, but at the beginning, I'm just gonna give you an idea about the topics that we usually cover. So we will definitely cover the financial statements, the balance sheet, the income statement, the comprehensive income statement of changes in equity, special purpose frameworks. I'm gonna explain this. We usually cover the statement of cash flow. We cover the receivables, the inventories, the property, plant, and equipment, PP&E, intangible assets, bonds, taxes, the not-for-profit accounting, also the governmental accounting. By the way, it's going to be also interesting. We cover the consolidation, the transaction, and the journal entries related to the consolidation. It's not like the DIP-IFR exam. It's a little bit different because we dive into the details. We have the earnings per share, we have the revenue recognition, we have the investments available for sale, trading securities, held to maturity securities. We have a lot of things and a lot of financial topics to be covered in FAR. Overall, it's interesting. It's more interesting than the other sections. Why? Because these topics, you use it on a daily basis. So if you are working in an audit firm, if you are working in the corporate environment, you're going to deal with those topics all the time. Before we start with study unit 1, which is about the financial statements, I'm going to give you an idea about the AI CPA blueprint. And I will share it with you. All of the documents, by the way, will be shared with you via email. So I will send the needed. This is, if you want, the AI CPA blueprint, and it gives you more details about each section. So as we said before, the CPA exam is going to have 3 core exams. You have to take the FAR exam, the audit exam, and the reg exam. And you decide about one of those disciplines. So it's either going to be BAR or ISC or TCP. Okay, now when it comes to FAR, you can see that this is a core examination. So when we say core, it means it's a mandatory exam. All right, for the discipline, you select only one, not all 3 at all. Now, if I go to this score weighting to see the details of the exam, I'm going to see that the FAR core exam, it has 50% allocated to the multiple choice questions and 50% allocated to the task-based simulations. And by the way, the score to pass the CPA exam, it's going to be 75. So if you score 75 and above, that means you're passing. If you score 74 and below, you did not pass. Now, if you score between 65 and 74, that means that you still need to study more to pass the exam. If you score in the 40s, 50s, that's really low. But between usually 65 and 74, that means you need to allocate more studying hour for the exam itself. Now, if you fail, then you can retake the exam whenever you want. That's also something that we need to take into consideration. Now, let me go to page 39 just to show you. I think it's not really 39, the FAR, it's 29, okay? So this is a FAR. They tell you we have multiple areas. Area 1, it's about financial reporting, that's area 1. Area 2, it's about selecting balance sheet accounts, as you can see. And area 3, it's about selecting transactions. Now, the allocation, it varies. So for example, for the financial reporting, between 30 and 40%. The balance sheet accounts between 30 and 40%. And selecting the transactions is between 25 and 35%. Overall, especially for FAR, you need to have an overall understanding of all the concepts in order to pass the CPA exam. Because usually in the task-based simulations, the day of the exam, they can give you a simulation that has many topics in it. So you need to have this deep understanding of the different concepts. And usually with FAR, it's not that challenging because you are familiar with all of these concepts. So now let me scroll down a little bit. You can see the topics that we study. So for example, we talk about the cash and cash equivalents, trade receivables, the inventory, as I mentioned before, intangible assets, tangible assets, investments, including the financial assets, PP&E, the accounting for the income taxes. You see contingencies and commitments. By the way, contingencies and commitments, you're gonna see this later on. It's an easy topic, but for some reason, the examiners, they love it. So it's always there in the exam. Accounting changes and error correction, super important topic, super important. And we're gonna talk a lot about it. It's always there in the exam. Fair value measurement, also an important topic. It's easy, but it's an important topic. Leases, definitely easy, always there in the exam. The subsequent events, it's also a small topic, like 2 or 3 pages, but it's heavily tested. All right. So you will see, if you want multiple topics here and there, equity transactions, the long-term debt, I'm just giving you an idea about the content payables and accrued liabilities. That's also overall easy and not challenging. The not-for-profit entities, I like this chapter because it's not covered, for example, in the DIP-IFR curriculum. It's covered here in the CPA, and it's good to know about the right accounting for the not-for-profit organizations. So overall, you can see that we have this, if you want, presentation regarding the farm. All right. Now, the weight, as I said, it varies. Overall, don't focus a lot on the weight because the real exam, it's an exam of everything, all the chapters. You see mainly one MCQ from each chapter. And the task-based simulations, they gather multiple topics from multiple chapters. All right, I will share this blueprint with you just in case you want to get more details about the FAR and the other sections. All right, this is the first thing. Now, today we will start with study unit 1, which is about the financial statements. As you can see, right here, there are 5 subunits. We have the balance sheet, also known as the statement of financial position. We have the statement of income, the comprehensive income, the statement of changes in equity, and the special purpose frameworks. All right, so let's go and let's start with the first one, the balance sheet. First, in the exam, they do not always use the word balance sheet. Sometimes they use the word statement of financial position. So in all cases, you have to know that if they ask you what amount is reported in the statement of financial position, that indicates that this is the balance sheet. Now, what is the full set of financial statements? The full set of financial statements is going to be definitely the financial position, also known as balance sheet. It's going to be the comprehensive income. We will talk about comprehensive income, but if you want the comprehensive income, it has a formula. The comprehensive income, it's going to be equal to the net income plus OCI, other comprehensive income. We will explain about the net income and we will explain about the other comprehensive income in deep details. But this is the formula of the comprehensive income. And now don't make that mistake. If you have one of the MCQs in the task bank, for example, and you are reading, read carefully because comprehensive income and other comprehensive income, it's not the same. These are different things, okay? So always read carefully. Are they asking me about the comprehensive income or the other comprehensive income? Because 2 different concepts. And as I said, the comprehensive income is this other comprehensive income plus the net income. Now, the third set of financial statements is going to be the statement of changes in owner's equity. Usually, this is not heavily tested. Mainly, they focus on 1 and or 2. Okay, the cash flows also important. We're gonna see it in study unit 14. It's not now, it's almost at the end of the curriculum. So the statement of cash flows, it's gonna be covered in study unit 14. Now, regarding the notes, they supplement, okay, they are additional. Why? Because those notes are prepared in order to explain the information that you see in the financial statement. So in the notes, I'm gonna read maybe about the inventory that is reflected in the balance sheet. I'm gonna read, for example, about the revenue recognition, which is in the comprehensive income, P&L, and of all. So the notes are just to supplement and give further explanation. By the way, in the notes, we do not repeat. There is no repetition in the note, not at all. We're gonna cover the notes also separately, okay? But this is just if you want a general presentation. Now, if I scroll down a little bit, all right, I'm gonna make a recap regarding the full set of financial statements. So remember, there are 4. First, we have the balance sheet of financial position. Second, we have the comprehensive income, which is equal to the net income plus the other comprehensive income. Third, we have the statement of changes in stockholders' equity or owners' equity. And 4, we have the statement of cash flows. The notes, this is to supplement and to give further explanation, okay, additional information. Now, right here, they're going to start talking about the balance sheet. The balance sheet, as you all know, it's the statement of financial position. What is the famous, if you want, relationship that we know? It's going to be simple. Assets equals liabilities plus equity. I always give a basic example, especially for those who decide to start with their accounting major. For example, you see a beautiful car, and that beautiful car, it costs $100,000. All right. Now you have $80,000 in your pocket, but you still need $20,000, let's say, loan from the bank to buy the car and settle the price. Accordingly, my assets in this example is going to be the car. That car is worth $100,000. The money that you have in your pocket, that's the equity. It's the $80,000. And remember, you have to go to the bank to get the loan of $20,000 to close the price of that car. So it's gonna be my liability. The liability is $20,000. Always, always, always in accounting, assets gonna be equals liabilities plus equity. So this is the famous equation that we all know. All right. Now, after that, here they give you an idea about the financial position and the way we presented under US GAAP. By the way the balance sheet or the statement of financial position, it's covered under US GAAP. It's totally different from IFRS. Now I'm gonna show you US GAAP and I will also show you IFRS just for comparison purposes. Usually under US GAAP, they put the assets right here, you can see to my left side, and they put the liabilities and equity to my right side. So the assets, it's like T. I have assets to the left and I have the liabilities to my right. The assets, they start with the current assets, then they put the non-current assets. That's the presentation. Also for the liabilities, they start with the current liabilities and then they put the non-current liabilities. And below the liabilities, they put the equity section. So that's the presentation. It's like a T. I have my assets to the left side and I have my liabilities to the right side. The assets are divided into two categories, the current and the non-current assets. And the liabilities are divided into two categories, current and non-current liabilities. And below the liabilities, we put the equity. So that's the presentation. And by the way, when you look at the current assets, they start from the most liquid, which is the cash and cash equivalents. So they do it by order of liquidity from most liquid to least liquid. So we start with cash available for sale, for example, debt securities, AR, notes receivable, inventories, prepaid, etc. By the way, don't worry, because we're gonna cover each one in a different chapter. Okay, I will give you all of the details later on. But the most important thing is that they start from the most liquid to the least liquid. That's under US GAAP. Now I'm gonna show you under IFRS, just for comparison purposes. Definitely IFRS, it's not required in this exam, but that's the presentation. Under IFRS, they start with the, by the way, they don't have this T shape. They have just like a column. They put the non-current assets first, then they put the current assets. And you see, under IFRS, the current assets, they present from least, for example, liquid to most liquid, not like under US GAAP. Under US GAAP, first, they start with the current assets. They put cash and cash equivalents always at the beginning because they start from the most liquid to the least liquid. Then they put the non-current assets. These are the differences. Also right here, after they put the assets, non-current assets, current assets, they present the equity section. Over there, to the right side, remember we had current liabilities, non-current liabilities, then equity. Here it's different. They put the equity first, then they put the non-current liabilities, then they put the current liabilities. Okay, so it's like really different. IFRS versus US GAAP, the presentation of the balance sheet. I'm not talking about the content. The content, it's pretty much the same. There are small differences nowadays. But the presentation of the balance sheet, that's the thing that is different. Here again, under IFRS, you start with non-current assets, current assets, equity, non-current liabilities, current liabilities, and it's a column. But over there, under US GAAP, we have like a T. We have the assets to the left side, and we have the liabilities and equity to the right side. Again, right here, we start with current elements, then non-current elements. Again, current versus non-current elements, and we have the equity. Also, you present those current assets from most to least liquid. Here, you present also from most to least, if you want, in terms of debt. But over there under IFRS, no, it's it's the opposite. Inventories, receivables, for example, and cash equivalents. All right, is everything clear so far? Do you have any question? I didn't let anyone talk so far. I think so. All right. So now let us continue with the details. Cash and cash equivalents, we're gonna cover this in study unit 4, along with the available for sale debt securities. So it's gonna be included in study unit 4. Accounts receivable and notes receivable, we cover this in study unit 5. The inventories, it's gonna be covered, for example, in study unit 6. Prepaid, definitely throughout the lecture, we're gonna explain the concept of the prepaid. Regarding the non-current assets, mainly, we're gonna see them in study unit 7, the property, plant, and equipment. Also, we will talk about the intangible assets. The current liabilities, it's gonna be covered in study unit 9. The non-current liabilities, it's gonna be covered in study unit 10. And the equity section of the balance sheet, it's gonna be covered in study unit 12. So all of the elements of the balance sheet are gonna be covered in different study units. All right, this is an example. And as you all know, my total assets, it's gonna be equal to my total liabilities plus my total equity. And here we have a comparative balance sheet. The current versus last year, the prior year, current year, this year, versus the prior year, last year. Current year, it's year 2025, for example, prior year, and it's gonna be the figures of 2024. All right, that's regarding page 3. Now, they start diving into the details of the current assets. If you prepared for the DIP IFR exam, you have to memorize some definitions, for example, for the sake of the exam. But here, under the CPA exam, you don't have to memorize any definition. Why? Because usually, they never ask you to write things. Either it's going to be multiple choice questions or simulation. And in the simulation, you select something or you put an answer in numbers, but you don't have to memorize any definition. Now, when I say current assets, you know, current assets, it's like cash and cash equivalents, accounts receivable, inventories, prepaid. These are current assets. So they tell you expected to be realized in cash or sold or consumed during the normal operating cycle, usually within a year. All right, so we classify them as current assets. Regarding the AR, definitely you expect to collect from your clients within a year. That's why AR, it's going to be a current asset. Regarding inventories, you expect to sell those goods in your warehouse within a year. That's why the inventories are classified as current assets. All right, so right here they tell you an asset is classified as current on the statement of financial position if it's expected to be realized within the operating cycle or 1 year, whichever is longer. Usually we use this 1 year. Okay, now they give you ideas about what's included in the current assets. As we said before, receivables, inventories, cash and cash equivalents, certain trading securities. We will cover this later on. Okay, maybe certain available for sale, certain held to maturity debt securities, but we're gonna cover this in study unit 4. Let me just give you an idea about the prepaid. Prepaid expenses, we all know about it. It's a simple concept. So, and it's also related to the matching principle. Let's say I have an insurance policy and I'm gonna pay $12,000 for the whole year. Okay, so this is an insurance policy of $12,000. I decide to pay it in full on the 2nd of January, year 2025. So January 2, 2025, I decide to pay the full insurance policy. Definitely under as GAAP, under IFRS matching principle, we're not gonna debit insurance expense for $12,000 on January 2 because that will hit your P&L and that will have an impact on your profit and loss. Accordingly, what you do is January 2, for example, you debit prepaid expense, which is a current asset on the balance sheet, and you credit, let's say, the cash for the value of $12,000. Then remember, this $12,000 is related to 12 months. So it's gonna be $1,000 per month. Accordingly, each month, at the end of Jan, at the end of Feb, etc., at the end of December, you're gonna then amortize this prepaid account and you're gonna book an expense. So you debit insurance expense, $1,000, and you credit prepaid. You reduce the balance in that prepaid account. So if we look at that prepaid account, the T account of the prepaid, we're gonna see that at the beginning, we start with $12,000, then we amortize it by $1,000 each month, Jan, Feb, March, etc. End of December, the balance in that prepaid account, it's gonna be 0. All right, so this is the concept of the prepaid. And as we said before, it's a balance sheet current asset account. By the way, in order to feel comfortable with all the accounts, when you do journal entries, you can simply label it. For example, here I can say BS balance sheet, comma, current asset. The same for cash. I know that this is balance sheet account, comma, current asset. I know I'm starting with the basics, but it's always better to make a recap of everything. Insurance expense, remember this is P&L account, so income statement account. Prepaid, right here, I'm reducing my assets, balance sheet, current asset. Assets, as you all know, they always increase in the debit side and they decrease in the credit side. And by the way, if you look at the basic formula of the accounting, which is assets equals liabilities plus equity, especially under US GAAP, I showed you that they put the assets to the left side and they put the liabilities and equity to the right side. This is because they move in this direction. So when I say left side, the assets, all assets, they increase in the debit side and they decrease in the credit side. And liabilities and equity, we put them together to the right side because they move in the same direction. They both increase in the credit side and they decrease in the debit side. That's why they are grouped together on one side of the presentation of the balance sheet, and they are together right here in the form. It's because they move in the same direction. All right, so this is regarding the current assets. Amy, is it okay with English or you're struggling? I know no French right here. All is good? Yalla, alrighty. Now, what about the non-current assets? So we said non-current assets. Yalla, all is good. Yalla, perfect. Regarding the non-current assets, it's as follows. They tell you investments and funds include non-operating items intended to be held beyond the longer of 1 year or operating cycle. In general, what I have in my non-current assets, this is what I expect to use for over a year. So for example, computers, laptops, furniture, intangible assets like copyright, investment in a bond, for example. We're going to talk about this in deep details, but all of these are non-current assets. And mainly we're going to talk about the PP&E and the depreciation of the PP&E as well. Intangibles, they lack physical substance, okay, without physical substance. You cannot touch them. Copyright, franchise, patents, goodwill, etc. These are the intangible assets. Tangible assets, what I can touch, for example, I can touch my laptop. They have this physical substance. I can touch the table. These are tangible assets. And when we depreciate and amortize, definitely with intangible assets, we use the word amortization. We say we amortize the intangible assets, but with the tangible assets, we say we depreciate the tangible assets. Okay, so here we have amortization. We use the word amortization. Here we use the word depreciation. For the mines and natural resources, for example, if I have a coal mine, we use the word depletion. It's not amortization, it's not depreciation. We use, for example, the word depletion. When it comes to leases, which will be covered later on, we say amortization. Why? Because you amortize the right to use the asset. So also, if you look at this terminology, for example, as I said, in leases, we use the word amortization. Why? Because you are amortizing the right to use the assets. You are not amortizing the tangible asset itself. You are amortizing the right. Right? So also, we will see this later on. But we have amortization, depreciation, and depletion. And we have definitely other non-current assets like deferred tax assets and long-term receivables. They are definitely non-current because it's long-term. Everything that is long-term receivable, long-term notes receivable, it's going to be other non-current assets more than a year. By the way, regarding the deferred tax, we will cover deferred tax in a separate study unit. This is like an intro session. But deferred tax asset, it's always a non-current asset. It cannot be a current asset. It cannot. It's always a non-current asset on the balance sheet. And regarding the deferred tax liabilities, we will see this later on. It is always a non-current liability, always. It cannot be a current liability, by the way. So deferred tax asset, always a non-current asset. We will study it later on. Deferred tax liabilities, it's always a non-current liability, and we will study this later on. All right, is this clear? The DTA and the DTL. And by the way, just for your info, if you have DTA and DTL, you offset and you present on the balance sheet. Let me give you an example. Also, that will be covered later on, okay? But for example, if I have deferred tax assets amounted to $100,000, and if I have deferred do not put right here DTA 100K, and I do not put right here a DTL 80K. No, we offset. We say, do I have more DTA or more DTL? DTA 100, DTL 80. No, I have more DTA. And what is the difference between the 100 and the 80 is 20. So our report on my balance sheet, DTA of $20,000. That's how we do the presentation. Later on, that will be covered in a different study unit. All right. And now, deferred charges, that means long-term prepayments. Because sometimes, like the insurance expense that I gave, I pay $12,000 for a year. But sometimes maybe you're gonna pay $36,000 for 3 years. So if you are debiting prepaid for 36,000 and crediting cash for 36,000, we need to be careful because this prepaid is not in full a current asset. Why? Because it covers 3 years. Only 1/3, which covers 1 year, is current. So this prepaid, I can present it like $12,000 related to the year that is coming, which is current asset, and the remaining 24,000 related to year 2 and year 3, it's non-current asset, and we can call it the long-term prepaid expense, or you can call it deferred charge. So deferred charge or long-term prepayment, it's gonna be a non-current asset on my balance sheet. But right here, I do not put a bulk prepaid of 36. No, I segregate it. The portion that is current, I say it's prepaid current. And the portion that is not current, I say long-term prepayment deferred charge of $24,000. And definitely later on, you're gonna amortize. Make sense? Okay. Now, current liabilities, after that, I will solve some multiple choice questions with you just to give you an idea about the current assets and the current liabilities, non-current assets and non-current liabilities. Current liabilities are obligations. So whenever I see the word obligation, I know that I have a liability. And by the way, whenever you see the word receivable, that indicates that this is an asset. So when they tell you interest receivable, account receivable, note receivable, okay, it means this is an asset. But note payable, account payable, everything that has the word payable, it's an obligation, it's a liability. So current liability, you have to settle it within 1 year. Like the vendors, you have to pay to the vendors definitely within 3 months, 4 months, it depends. With less than a year, it's gonna be current. Trade payable, this is related to the business itself. So for example, I sell iPhones. Now, when I purchase iPhones from the supplier, I can say that I owe him $10,000. This is a trade payable because it's related to the business itself. But if I owe $10,000 salaries to the employees, it's going to be other payables. It's not related to the operations. It's not related to the business. So we do not call it trade payable. We call it other payable, other creditors, salaries payable, wages payable, these kind of things. So that's the difference between trade payable and other payable. By the way, it's the same for the receivable. If I say trade receivable, which is a current asset, that means clients who owe me money, and this is related to my operations. But for example, if you sold, let's say, this table to a certain person, you're not gonna say this is trade receivable. I sold them for the table for 5,000, so I want $5,000 from him. I'm gonna say other receivable, but it's not related to the trade. It's not related to the operation. Unearned revenue, we're gonna see this later on, especially in study unit 2. It's a contract liability also. We use the word unearned revenue and we use the word contract liability. Sometimes they use the word deferred revenue. So unearned revenue, deferred revenue, contract liability, it's also a current liability. And I'm gonna give you an example regarding it. I think you know about it, but let's take an idea. So for example, I have an iPhone right here in my shop. and that iPhone costs $1,000. There is a client who's interested in purchasing that iPhone, and he said, I only have $500, so I will give you $500 as an advance payment. And then after 2 months, I will pay the remaining $500 and I will take the iPhone. I agree with him on this deal. So when I receive, I am the vendor. When I receive the $500, definitely my cash is gonna go up. So I will debit my cash for the value of $500. And then right here, I did not deliver the iPhone to the guy. The iPhone is still with me. This is an advance payment. So I cannot recognize a revenue of $500. Accordingly, I will credit a liability. We call it unearned revenue. We call it deferred revenue. Sometimes we call it contract liability. Here there is no contract, it's a verbal agreement. So I will use the word unearned revenue for the value of $500. Now, after 2 months, this guy comes back and gives me the remaining $500. So once he comes back and give me the remaining $500, I'm gonna debit again the cash for the value of 500. Okay, and now I can recognize the revenue. Remember, the revenue that I can recognize, the sales revenue, it's gonna be equal to $1,000 because this is the value of the iPhone that I sold. And I still need $500 in the debit side. This $500 that you still need in the debit side, it's gonna be the closing of the unearned revenue. I close it because now I delivered the iPhone, so no more unearned revenue. So I close the unearned revenue in the debit side for the value of $500. And this unearned, it's gonna be a current liability. Why? Because he said I will pass after 2 months, settle the price and take the iPhone. All right, this is regarding those everything that is short-term obligation, short-term payable. It's gonna be classified as a current liability on the balance sheet. All is good? Okay. Before I start with that one, let me try at least one multiple choice question with you. We have some MCQs, which is similar to what we usually see the day of the exam. Okay, and we will try to do it together. For example, MCQ 3. I'm going to start with MCQ 3, and I would like to ask Abdulrahman to start reading this MCQ. Abdulrahman, what do we have in this one? MCQ 3.
Go ins trial balance reflected the following liability account balances at December 31st, year 6. We have account payables for $19,000.
Abdulrahman, payable.
Bonds,
Is it liability or asset payable?
liability.
Definitely. And accounts payable in general, what is the category of that account?
Current liability.
Exactly. So I will label it CL. Then
Bonds payable due year 7 for $34,000.
okay,
It's
bonds
also a
payable.
liability,
Also
non-current
liability.
liability.
Current. Why current? Because your balance sheet is dated.
Year 6.
Yes, and this bond is due.
Year 7, so after 1 year, so it's a current liability also.
Exactly. And then
A deferred tax liability for $4,000.
what did we say about the deferred tax liability? Always, always, always
Non-current liability.
always. And deferred tax asset, it's always
Non-current asset.
exactly. And the presentation on the balance sheet, do we present them separately or we net and offset and present?
No, we net between them.
Exactly.
We offset and present in the balance sheet.
100%. That's absolutely correct. So, خلاص, deferred tax liability, you close your eyes and you say this is a non-current liability. And then
we have discount on bonds payable. So that's a current asset.
okay, discount on
Of
bonds
deferred.
payable, it's related to the bond itself. You can have a bond with discount. We will study this separately. And you can have a bond with premium. By the way, the discount, it will reduce the value of the bond. The premium, it adds the value on the top. I will explain. So if I tell you right here, I have a bond of 34 and discount on bond payable of 2,000, what is your net bond payable in this case? Discount, it will be a
32.
minus.
32.
Exactly. So right here, my net bond, payable, my net current liability, it's 32,000. By the way, if instead of discount they say premium, it will be,
will be 36.
yes. If they said it's a premium, it will be 36. If they say it's a discount, it's gonna be a minus. Hala, after this MCQ, I'm gonna give you an idea about the bond. We'll study it later on, but I'm just gonna give you a small idea about it. So here I have 32,000. We said DTL, this is non-current liability. Accounts payable is 19. So far, we're good. And then,
Dividends payable on 15/2 year 7 for $5,000.
this is, by the way, when I see the word payable, this is a liability or asset or equity payable.
Liability.
Exactly, it's a liability. And then remember, your balance sheet is dated December 31, and this payment is to be done on the 15th of Feb. By the way, in the CPA exam, they always put the month, then the day, then the year. So when I say it's payable on the 15th of Feb after 2 months, year 7, is this a current liability or non-current liability?
Current liability.
Exactly. I know this is a current liability. By the way, what is the journal entry when they make a dividend distribution? And dividend declaration. Usually, we're gonna study this in study unit 12. But when they declare dividends, you debit the retained earnings and you credit dividend payable. This is upon declaration of the dividends in the companies. And when you debit the retained earnings, that means you are reducing your equity. And that's why we say the dividends declaration, the dividend, the declaration, decreases the retained earnings. So your retained earnings go down because you're debiting the retained earnings. And the dividend payable, it's a current liability to the shareholders. This is upon declaration. Then when you pay the dividends to the shareholders, let's say after 2 months, you close that current liability, you debit the dividends payable, and you credit the cash because you pay those dividends to the shareholders. But whenever you have a dividend declaration, I decrease my retained earnings, I debit the retained earnings, and I credit my dividend payable. Make sense? All right. And then what do we have? Which element?
Income tax payable for $9,000.
Yes, income tax payable, and it's income tax. They did not say deferred tax liability. Under US GAAP, when we say DTL, deferred tax liability, I know that this is a exactly. But when we say income tax payable, this is current. Exactly.
Liability.
Exactly. That's the difference between income tax payable and deferred tax liability. And then
Notes payable due year 8 for $6,000.
yes,
For year 8, non-current liability.
exactly. Balance sheet, it's at December 31, year 6, and this one is due year 8 after 2 years, more than a year. So it's non-current. I will not take it into consideration. So what is my total current liabilities? Definitely, you can use the calculator. By the way, try to get familiar with the calculator that you have in the exam. It's easy. So 19,000, I would say 19. Plus, we said net bonds payable, 34 minus 2, 32. DTL, I will not consider it. Plus the dividend payable, yes, we have 5. Plus the income tax payable, and that's it, right? So what is my total current liabilities?
65.
Exactly. We scroll down, we're gonna see that 65,000 is the correct answer. All right? And now, Amir, the second one, question 4, we can also do it. What do we have right here?
As of December 1, year 2, a company obtained a $1 million line of credit maturing in 1 year, on which it has drawn $250,000, a $750,000 secured note due in 5 annual installments, and a $300,000 3-year balloon note. The company has no other liabilities. How should the company's debt be presented in its classified balance sheet on December 31st, year 2, if no debt repayments were made in December?
All right. Now, line of credit. It's an interesting concept. LOC, the line of credit. Line of credit, Amir, it's a facility that is given by the bank to you. So they tell you, line of credit of $1 million. It means you have the right to borrow up to
$1 million.
1 million. It's a facility. But does it necessarily implicate that you borrowed 1 million?
No.
No. For example, this month I need $50,000, I will borrow. Next month I need additional $100,000, I will borrow. 50 plus 100, 150, I'm still fine. They said they have a facility to borrow up to 1 million, on which it has drawn, on which they borrowed how much?
250,000.
Exactly. So what is your liability? Is it the 1 million facility given to you or what you actually borrowed?
No, what you actually borrow, 250.
Exactly. So right here, I will disregard. This is a facility. I can borrow up to 1 million, but it's not going to be reflected in my balance sheet. What will be reflected in my balance sheet, this is what I actually have drawn, the 250. Now, is this a current liability or non-current liability, what I have drawn?
It's a current liability.
Because they said it's maturing in
1 year.
Exactly. So I'm going to write down 250K and next to it, I will put current liability. Then you have 750K secured note payable due. When you see the word due, it's an obligation. Due in 5 annual installments. If I divide 750 by 5, this is how much? 150, right?
150,000, yeah.
Yes. So I have 150, 150, 150, 150, 150. Due next year, the year after, year 4 and year 5. Which portion represents a current liability?
The one due this year?
Exactly. Only 150. What about the remaining 600?
It is non-current liability.
Exactly. So right here, I know that I have a current liability of 150, the portion that is due to be paid within a year. As for the remaining 600K, it's gonna be a non-current liability. And then they said, we have
a $300,000 3-year balloon note.
By the way, you know what's the meaning of balloon note? One shot. So 300K, you have to pay it in one shot after
3 years.
3 years. This is the meaning of balloon note. Balloon loan. I have to pay it after 3 years. Shall I settle something now, next year, after a few months, or it's only once after 3 years?
Only the one time in the last.
Yes. So what does this 300K represent?
Long-term, non-current liability.
Exactly. Long-term, that means?
Non-current.
Yes. So now when they ask you about your total current liabilities, your total current liabilities will be
$400,000.
Exactly. What about your non-current liabilities?
$900,000.
Exactly. So I have current liabilities of 400, long-term or non-current liabilities of 900K. And the correct answer is option A. Make sense?
Yeah.
All right. What about the others? All is good? Okay, so we did question 3 and 4. Now, if we go back to our book, there is an interesting concept. And I'm gonna read it. When I read it, it will not make sense. When you see the multiple choice question, you will understand it. They say current liabilities do not include current obligations if the entity intends to refinance them on a non-current basis and demonstrates an ability to do so. The ability is demonstrated by entering into a financing agreement meeting all conditions before the balance sheet is issued. I will explain this. And issuing a non-current obligation or equity securities after the end of the reporting period, but before issuance of the balance sheet. Now, this doesn't make sense when you read it, but I'm trying to make it simple right here in this paragraph. Just to explain this one, I will give you 2 multiple choice questions for a better understanding. But what they are trying to say in the above paragraph is that short-term current liabilities, obligations can be excluded from the current liabilities, and we can put them in non-current liabilities section. If the company intends to refinance it on a long-term basis, and this intent is supported by the ability to do so. So there is an actual refinancing before the financial statements are issued, or we have a non-cancelable financing agreement from a lender. I will explain this using two multiple choice questions, because when you read it, as I said before, it doesn't make sense, and I know this perfectly. So let us go back to question number one. This question, number one, it will help you understand the content of that paragraph. Noor, let's read the first MCQ.
William Co. reported the following liabilities at December 31, year 1. Accounts payable, trades payable, $750,000.
This is
Short-term
general
borrowings,
current or non-current accounts
it's
payable?
current liability.
Yes, exactly. And then
Short-term borrowings, $400,000, it's current liabilities.
exactly, because they said
Short-term.
exactly. And then
Mortgage payable, current portion $100,000. It's $3,500,000. Okay, so the current liability is 100,000,
yes,
and the non-current is $3,400,000.
exactly. This is current, this is non-current. All right. And by the way, if you are reading and you find it a little bit confusing, look at the small amount. Small amount, definitely this is the current portion, and the big amount, it's gonna be the non-current liability. And then
Other bank loan matures June 30, year 2. So this is current liability, $1 million.
exactly, from December 31, year 1 to June 30, year 2, it's a current liability because within a year. But we need to pay attention because they
Okay.
said
The $1 million bank loan was refinanced with a 20-year loan on January 15, year 2, with the first principal payment due January 15. Okay, year 3. William audited financial statements were issued in February 28, year 2. What amount should William report as current liability at December 31, year 1? Okay.
so. What do you think?
Okay, so here they are telling us that the loan would be refinanced with a 20-year loan on January 15.
Yes,
This is an indicator that the loan is gonna be non-current liability.
exactly. By the way, there are two conditions. We said right here, if you have a short-term, for example, obligation, it can be excluded from the current liability and classified as non-current liability if you intend to refinance, okay, on a long-term basis, and it's supported by the ability. Ability, it's actual refinancing or existence of a non-cancelable contract before the issuance of the financial statements. So right here, if I look at the following, they said the 1 million was refinanced. So there is an actual refinancing with the long-term liability. And when did they do this refinancing? When did
After
they?
15 years from the end, from
Yeah.
the
The 1
15
million
days,
was refinanced on,
January 15.
yes, year 2. And when are the financial statements issued?
Okay, on February 28, so before the
Yes,
reporting period.
exactly. So right here, you have to ask yourself, when did we do the refinancing? Or when did we sign this non-cancelable contract? They said it's January 15, year 2. And now look at the financial statement issuance. It's Feb 28, year 2. So this occurred before. Accordingly, the second condition, it's also fulfilled because you need two conditions. So now can we classify this 1 million instead of current? Can we say it is non-current?
We should say it's not current.
Exactly. So now it is a non-current liability. And now they are asking you about your total current liabilities. Your total current liabilities, it's gonna be?
Okay.
So we have these, right? The accounts payable, the trade, the short-term borrowings, and the current portion of the mortgage payable. 750 plus 400 plus 100. It's gonna make up a total of?
1.25 million.
Yes. So the correct answer is option
B.
Yes. And by the way, it's important for the company to have something like this. You know why? Because when you look at the balance sheet, you have assets, you have liabilities, and you have equity. Right here, if they classify the 1 million as current liability, يعني for the investors, they're gonna say, yeah, they have $1 million that is to be paid within a year. It's an obligation. But if the 1 million is classified as a non-current liability, they know that they have more time to settle this liability of 1 million. So classifying it as non-current liability is better, especially for the investors, because they say it's long-term. So they have to pay it later on. You see? Did you all understand why we classified the 1 million exceptionally as Amir? Yes, tell me.
Yeah, I have a question. Actually, isn't refinancing like obtaining another loan on that same loan,
Yes.
like won't it increase to 2 million, or is it that does it stay the same 1 million?
No, they can increase it and they can keep it the same. It depends on that 20-year loan. But
Okay, so when they
usually,
say refinance, we assume that it stays the same 1 million.
you assume it's fully refinanced.
So it's
Exactly.
just the same amount that they took. They don't get anything more. Like I was assuming that this 1 million means, it'll be like double because you're getting another 1 million.
No, you're not. No, you're not. You're just refinancing it with it means like you are gaining time to settle it later on. So
Oh,
instead
so
of
changing the
settling it
terms of the
now,
same.
exactly. It's
Oh,
gaining time, not gaining money. Maybe you are refinancing this and you are getting an additional refinancing. So it's gonna be more than 1 million, maybe. Maybe it's exactly 1 million.
uh-huh.
But it's gaining time to settle the liability.
Okay.
And by the way, there is something. Usually, if you are working in the corporate environment, the way they read the balance sheet, it's like this. Let's say I have assets amounted to $10 million, and they have liabilities amounted to $7 million, and they have equity amounted to $3 million. Automatically, if you are working in the corporate environment, especially the multinational, by the way, they say 70% of our assets are financed with debt. That's how they read the balance sheet. And based on the numbers, they automatically say we have 70% of our assets financed with liabilities and only 30% financed with equity. So for example, if you have a subsidiary in Lebanon, a subsidiary of a multinational company, and it has, for example, liabilities of 90 million and assets of 95 million, it's not an equity of 5 million. This is not a good structure. Why? Because if I say 90 divided by 95, that means that 95% or 94.7% of their assets are financed with liabilities. And it's a risky capital structure because the capital structure is debt and equity. This is the capital structure. If you have too much debt, there will be a financial leverage. There will be a financial risk later on. What if you default and you cannot settle those debts? But this is how they
Tyra,
implement the balance sheet. Yes.
can you please elaborate about the term leverage?
Leverage. Okay. Leverage, we will study it later on, but this leverage, it indicates a risk. So when we say financial leverage, it's our financial risk. If we have a lot of debt, there are many risks, and definitely the risk of default, because maybe when it becomes due, you will not be able to settle that liability, or maybe you will not be able to pay the interest on time. So we have a financial leverage. We can also have operating leverage related to the operations. So for example, if this is the airlines industries and the big pharma companies, they have a lot of fixed costs to be covered, like depreciation, if they are using, for example, the straight line. We will see this later on. They have fixed salaries. So during COVID-19, they suffered a lot. Why? Because of the high fixed costs that they need to cover. And they were struggling. It was a bad time back then. So this is also related to operating leverage, but that will be covered separately, the financial leverage and operating leverage. We cover it later on, okay? And by the way, if you are working with an American, for example, public company, they use the word nibicles. Any idea about the nibicles? Have you heard about it? They say non-interest bearing current liabilities, like accounts payable. They don't say accounts payable. So if you are attending a meeting with the finance department of an American public company, they will say we have nibicles of $100,000. It means non-interest bearing current liabilities. They don't bear interest because when the vendor sells something to you on credit, okay, they don't charge interest. Or salaries payable. Salaries payable, it's also nibicle because it does not bear interest. So when you hear the word nibicles later on, if you are working with a multinational public American company, they will use the word nibicles, which means non-interest bearing current liabilities. But when I say note payable, even if it's short-term note payable and it bears interest, I cannot say that this is nibicle. Why? Because the notes payable, they bear interest in general. Okay, so everything that is short-term but bears interest, we do not call it nibicle. This is also additional information. All right, make sense? Yeah. Amy, we have the second question. Let's go ahead. You can give it a try. Are you able to participate? Yeah. طيب, عبد الرحمن, would you like to do the second one?
Yes, okay, no problem.
Let's go ahead.
A company has the following liabilities at year end: mortgage note payable 16,000 due within 12 months, 355,000.
So how
Short-term
much
debt,
is current?
$16,000.
Yes, this is current. And the portion that is non-current?
355,000.
Exactly. And then?
Short-term debt that the company is refinancing with a long-term debt of $175,000.
So short-term debt, in general, this is current or non-current short-term debt?
Current.
But because it's refinanced with long-term debt,
It becomes a non-current liability.
exactly. But also there is another condition. It has to be refinanced prior to the issuance.
To the issuance of the financial statement.
Exactly. And I think they did not mention it, but you're going to assume that this is prior. So it's a non-current liability. And the third scenario?
Deferred tax liability arising from depreciation of $25,000.
DTL.
It's a non-current liability.
Exactly. Always non-current liability. And then what is the call of the question?
What amount should the company include in the current liability section of the balance sheet?
So what is the current liability?
Just the $16,000.
Exactly. It is just the 16,000. As for the remaining amounts, they are all considered as non-current liabilities. All right. That was the second question. So far we did 1, 2, 3, and 4. I think now it's better as when it comes to the current liabilities and non-current liabilities. All is good? All right. So in general, when I say that I'm reclassifying this liability from short-term to long-term, okay? So we have a reclassification. We said, I know that this is a short-term, but exceptionally, I'm gonna exclude it from the short-term category and classify it as a non-current liability. Zaina, usually liabilities, they increase in the debit or in the credit side for the debt and liabilities?
Debit.
They increase in the
Debit, decrease in the credit.
okay, it's a liability. Remember, assets equals liabilities plus equity. All assets they increase in the debit and they decrease in the credit.
Sorry.
Exactly. Liabilities and equity, it's gonna be the opposite. So they increase in the
Debit.
credit. It's just
Credit,
the
decrease in the debit.
Exactly. So they decrease in the debit side. Now, remember, this is a short term, but I'm gonna take it out of the current liability, out of the short term. So my short term liabilities are going down. So if your short term liabilities are gonna go down, you will debit what? The short term liability. Why? Because when you debit the liability, for example, when you pay to the vendors, okay, what do you credit? The cash, right?
Cash.
Yes, and you debit accounts payable vendor. Am I correct?
صح.
Yes. So when you settle the liability, you debit that liability, right?
Right.
When you debit the liability, that means your liabilities are going down because your
Down.
debit. Exactly. So whenever I debit the liability, it means it's going down. So right here, when I debit the short-term liability, it means my short-term liabilities are going down or up. You're debiting
Going
it.
down.
Exactly. So right here, this entry is telling me that the short-term liabilities, it's going down. And when you credit long-term liability, that means your long-term liabilities are going
Up.
up. By the way, whenever you forget about it, just write down assets equals liabilities plus equity and ask yourself, assets like cash always increase in the
Debit.
and decreases in the credit. Liabilities and equity, it's the opposite. So they decrease in the
The
debit.
debit will increase in the credit.
Exactly. So now if you are increasing your long-term liabilities, you are making this reclassification from short-term to long-term. So now you have more long-term. More long-term liabilities, it means you put it in the credit. So I credit the long-term liabilities. And now you have less short-term. If you have less short-term, that means you are debiting the short-term liabilities. Okay, makes sense? All right. So, Zainab, liabilities
Yes,
and
yes.
equity, they increase in which side, the debit or in the credit side, the liabilities and equity?
To the right side.
In the
Asset to the left side.
Okay, exactly. So assets, they increase in the debit, liabilities and equity, they decrease in the debit, and vice versa. All right, all is good as when it comes to this reclassification, related to the reclassification from short-term obligations to non-current liabilities. Or, by the way, there is another interesting concept. It's called the working capital. We hear about it a lot, working capital. Working capital, it's simply as a formula, current assets minus current liabilities only. And usually in the companies, if you are in a treasury function, you focus a lot on the working capital. So when I say current assets minus current liabilities, what does it mean? It has to be positive. If it's negative, that's not healthy. Current assets minus current liabilities, it means, do I have enough current assets? Do I have enough cash and cash equivalents? Do I have enough accounts receivable? Do I have enough inventories to cover my current liabilities, to pay the salaries to the employees, to pay to the vendors, to pay for the taxes, etc., etc.? This is the meaning of working capital. And we desire the working capital to be positive in a company. Because if it's positive, it means I have enough current assets to pay my current liabilities. By the way, it depends on the industry. If you want to benchmark and make a comparison, it depends on the industry itself. For example, for supermarkets, the working capital is in general low. Okay, it's not high because they have inventories and definitely they have cash and cash equivalents and they pay immediately to the vendors, they settle the salaries, etc. So the working capital, it's healthy. But overall, it's not very high. But if you are looking at a manufacturer, usually the working capital is going to be higher than a supermarket. Why? Because of the value of the current assets and the value of the current liabilities. But it depends on the industry. So if you want to see whether your working capital in the company is healthy, yes or not, you need to benchmark. You need to compare yourself to the competitors and peers, or you compare yourself from one year to another. So let's say last year it was like this year it's better. All right, so you make the assessment. But this is overall a general idea about the working capital. And let me tell you something. When you prepare the statement of cash flow, do you deal with working capital or not? Is there any relationship between the cash flow and working capital?
Is working capital the starting number for the cash flow statement?
For the cash flow, it means the first section, Amir, right?
Yeah.
Somehow you are right. Exactly, because remember, we will study this in study unit 14. The cash flow statement, it has how many sections, Amir?
3.
Yes. the OF, that's the order. OF, operating, investing, and financing. In general, in the operating section, if we are using, we'll study this later on, but if we are using the direct or indirect method, it depends. But overall, we say increase in AR, decrease in AR, increase in accounts payable, decrease in accounts payable. So you are looking at the current assets and current liabilities and the differences between them. So somehow it reflects the changes in your
Working capital.
working capital. Yes, the operating section of the cash flow, it shows the changes in your working capital. And that's why we say in a statement of cash flow, the operating section has to be positive. If it's not positive, you need to raise the red flag. That's a very bad indicator if it's negative. It means you are not generating enough money from your operations if it's negative. All of the companies, they desire a positive or a negative operating section of the cash flow?
Positive.
Positive. If it's negative, as I said before, this is a bad indicator because that means you are not generating enough money from your operations. You don't have enough also current assets to cover your current liabilities. Make sense? I know I'm opening a lot of parentheses, but as I said before, this is an intro section. So we're having a bit from here and now also I want to clarify something. When I say your capital structure, usually what is your capital structure in general? So when we say capital, how can you raise money to the company? You're either gonna increase your equity, right? So capital, it's equity, or you can take liabilities, loans from the bank. So your capital structure, it's always debt plus equity or liabilities plus equity. This is your capital structure in general. Remember, when I say assets equals liabilities plus equity, that's my capital structure, the equity and the debt itself. By the way, if you are taking money from the bank, if you are taking a loan, what happens to your cash, Zainab? If you take a loan from the bank, what happens to your cash? It goes up or down?
Increase. Go
Yes.
up.
So I will debit my
Cash.
cash. And I will credit.
The bank. Loan.
Yes, exactly. The loan payable, for example, to the bank, the liability. Also, that's the same concept for the bonds. So the concept and the idea of the bonds, it's easy. The bonds, it's simply, for example, I am Tesla, and Tesla is issuing a bond. It means that Tesla is taking the cash from people, from the investors, and giving them that piece of paper, Tesla bond, okay? So that means upon issuance of the bond, Tesla will also debit what? Cash. Zainab, why? Because Tesla is receiving cash from the investors.
Investment.
But now Tesla has a liability. What do we call that liability in the credit side? We do not call it loan. We call it?
Liability.
Yes, but what is the exact name? Bonds payable.
Bonds
payable. Yes, but it's a debt. It means Tesla has to return the money to the investors, for example, after 5 years, after 6 years, whatsoever. But this is how you can raise capital from the issuance of debt. We say Tesla issued bonds. It means Tesla took money from the investors and it issued this piece of paper. I owe you that much. And by the way, you can simply Google it, okay, or make a search. You can say Tesla bonds. Tesla bonds. And you can see that they have a lot of bonds, Tesla bonds, corporate bond rates. You can click on it and you can see, you see how many bonds they have? For example, this is Tesla 431, and they put the conditions, the maturity date. Maturity date, by the way, it means that Tesla has to return the money to the investors on the 17th of December 2030. And definitely this liability is non-current liability on the balance sheet of Tesla. You see, all of these, they have a maturity of 2030. All of these bonds are non-current liabilities on the balance sheet of Tesla. You can see face, it's always like this. It cannot be 554, for example, or something. We study bonds separately. The issuer, it means the company that issued the bonds. It's Tesla Energy Operations Incorporation. That means this is the issuer. The issuer always issues the bonds, issues that piece of paper, takes the money from the investors and records a liability. Okay, and you see right here something called the coupon rate. We study this later on, as I said before. It's not today. Coupon rate, it is the rate that is paid by Tesla. It means that Tesla is giving those investors 5.45%, but here it's less. It's 4.7%. Okay, so this is coupon rate. They also call it the stated rate. Stated or coupon rate, it means this is the rate that Tesla, the issuer, is paying to the investors. Okay, and we see the price. Price, I will explain to you about the price later on. And yield to maturity also, I will explain it later on, the market, the yield. Okay, but this is an example regarding bond. So when you think about bonds, don't panic, because some candidates, they see the word bond and they panic. Bond is simply like a loan. But instead of taking the money from the bank, you're taking the money from the investors. Make sense? All right. If you want to participate, let me know. Now, we said this capital structure, Amir, you can issue what? Debt. And you can have also what type of capital structure?
Equity.
Equity, yes. By the way, the equity is also the same. So instead of issuing a debt, you're issuing
Equity or shares.
yes, shares. Exactly. So what happens? You take money from, you do not call them investors now. You take money from the
Holders.
shareholders. So when you take money from the shareholders, what increases?
Your
Cash,
Okay.
right?
Yeah.
So your cash goes up because you're taking money from those shareholders since you are selling shares. And you said the equity increases. Usually the equity increases in which side?
Credit.
Credit. So right here, you credit the equity. By the way, equity, it's common stock and APIC. Okay, I will not dive into the details now. But we have right here, we credit the common stock and we credit APIC. APIC under IFRS, it's known as share premium. But under US GAAP, they do not call it share premium. Under US GAAP, they call it APIC, additional paid in capital. That will be study unit 12 separately. But usually you credit the equity because you have now more shareholders or less shareholders when you issue additional shares and when you sell additional shares. I
You have
have
more shareholders.
more. Yes. If you have more shareholders, your equity is going up or decreasing your equity?
It's going up.
It's going up. And equity, it increases in the debit or in the credit side, the equity, like revenues,
Credit.
like sales. Exactly. It increases in the credits. These are just small, if you want, a recap regarding the journal entries, but we will see the details later on. So equity, it's study unit 12, debt, study unit 11 and 10, okay? And now, the non-current liabilities, they talk about the current liabilities. They tell you current liabilities, definitely they are not current, and we explain this, like bonds payable, long-term notes payable, lease liability. We're gonna see this in the chapter of the leases, the LL, the lease liability. Deferred revenue, as I said before, unearned revenue. It can be, yes. Now, unearned revenue, I said unearned revenue, deferred revenue, and contract liability, it's the same. Regarding right here, they say deferred is the non-current liability. So they are using the word deferred to reflect a non-current liability. Okay, but unearned, deferred, current, contract liability, you can use all of them. Let me just give you an example. So let's say I produce big pumps for water treatment projects, big pumps, very big pumps. And I receive a down payment of $100,000 from one of the clients. And I said this pump will be delivered to you after 2 years. So right here, when I receive the 100,000, always think about your cash first. My cash is gonna go up because I receive money, so I will debit cash. And in the credit side, it's unearned revenue. If you use unearned revenue, it's correct. If you use contract liability, it's correct. And if you use deferred revenue, that's also correct. You can use all of them. But what matters is the classification. Right here, because the pump will be delivered after 2 years, that unearned revenue or deferred revenue or current liability, we classified as, contract liability, we classified as non-current liability. Why? Because you will deliver that pump to your client after 2 years. So as you can see, with the non-current liabilities, they prefer to use the word deferred revenue. If it's current liability, then they prefer to use the word unearned revenue and contract liability. That's the only difference. Okay, makes sense? I think, yeah, all is clear. And now the equity, again, equity, we will cover it in study unit 12, study unit 12. So equity, this is common stock, preferred stock, as I said before, additional paid and capital, also known as share premium under IFRS. You have the retained earnings. Retained earnings, now there is a formula regarding retained earnings, and I will explain it to you. Okay, you have accumulated OCI, the accumulated other comprehensive income. Also, that will be covered today. Accumulated other comprehensive income, we covered it a little bit today. Tell me, no.
Okay, I'm saying about the accumulated other comprehensive income, the buffer, the word buffer.
The puffy ER. The puffier,
Yes.
yes, exactly. But by the way, you know what's the difference between accumulated OCI and OCI?
I think that okay. يعني حاعطيك one example about the revaluation of assets.
Yes.
Okay, يعني since last year بس 1 minute. Okay. بيكون عنا let's say مثلا reserve إنه surplus reserve.
Okay.
Then this is the balance of last year. When we add to the يعني the current year, when we add the amount, then this would be the accumulated one.
That's correct. It's, by the way, the same as retained earnings. Let us explain retained earnings in a simple way. So you started your business and you started with a loss of $10,000. What is your retained earnings now, Noor?
$10,000.
Yes, deficit, right? You are
Yes.
a loser. Next year, you incur an additional loss of 5,000. So now what is your retained earnings?
Is deficit 15,000 and the 5,000 is the portion of this year.
Exactly. So I have now in my retained earnings 15,000. It means the accumulated losses and gains. And the third year, you make a profit of 30,000. So now what is your total losses, total gains?
15.
15 gain. So now in your retained earnings, you have?
The accumulated is 15 and the
Exactly.
current portion is 30,000.
Exactly. So it means the result of year 1 plus the result of year 2 plus the result of year 3. Same. Accumulated OCI. It means OCI of year
Of
1
accumulated
plus the
year 1 plus
OCI.
2 plus 3.
Exactly. So it's the
OCI
same.
is the portion
OCI.
of this year.
Exactly. That's absolutely correct. So accumulated OCI, it's like retained earnings. Result of year 1 plus result of year 2 plus result of year 3. OCI, it's like the net income of this year. It's OCI of year 1 plus OCI of year 2 plus OCI of year 3. It will give you the accumulated OCI. Now I will dive into the details, okay, of the OCI because I did not explain it. But this accumulated OCI and other comprehensive income, it's a balance sheet equity account. And by the way, when we say there is an account called OCI, I will dive into the details of that account. But this is an account that is not yet ready to be incorporated within the income statement. It's not yet ready to be in the P&L. So they set it aside on the balance sheet and they put it in an equity section called OCI and accumulated OCI. But in a few minutes, I will dive into the details of that account. Now, just know that OCI is the account of this year, OCI of year 2025, OCI of year 2024. But when I say accumulated OCI, it's the OCI of year 2025 plus 2024 plus 2023 plus, etc., etc. All right? And by the way, it's always beyond the control of the management. It's not within the control of the management, beyond the control of the management. We will explain about it in a few minutes. And we have something called also in the equity section, which we will cover in study unit 12. We have something called the NCI, non-controlling interest. If you are looking at the balance sheet and you see something called NCI, the non-controlling interest, that means that this balance sheet is consolidated balance sheet. Because on the regular balance sheet, يعني Sarah Corporation, Tesla Incorporation, IBM, okay, if it's just solo, this company only, if you do not see NCI, that means this is the company. But if you are looking at the financials and you see NCI, that means this is a consolidated balance sheet. So this is an indicator. We also covered it, I think, in study unit 13, if I'm not mistaken. And you have treasury stock. Treasury stock, we will also study it in study unit 12. Treasury stock, this is when the company buys back its own shares and sells its own shares. So I buy back and I sell my own shares. And they do it on purpose. And I will explain it in study unit 12. Why does Tesla, for example, sometimes buy back its own shares? It's on purpose, but that will be covered in study unit 12 because it's a broad topic. So equity, we have the common stock, preferred stock, additional paid and capital, APIC. We have the retained earnings. We have the accumulated OCI. We have NCI in the consolidated balance sheets. And we have treasury stock as well. But all of these, don't worry about it. It will be covered in study unit 12. Today, I did not explain. I just gave you like small intro and small idea about the equity section. All right, this is, if you want, page 6. And now we're gonna start with the income statement. But again, as I said, we will explain the OCI today, I think. We're gonna have enough time to explain. The income statement or the P&L, profit or loss, sometimes they also call it the statement of earnings. In the exam, they can trick you by using multiple, if you want, terminologies. They can say income statement, they can say P&L, profit and loss, statement of earnings, it's the same. So that means this is the profit or the loss of this year. It means all of my sales and revenues minus all of my expenses plus the gains minus the losses. So everything that affects your P&L, it's gonna be your net income, the net profit, or the loss. And by the way, the net income end of each year, it's going to be closed against the retained earnings end of each period. And this is what you all do end of the year. So for example, if I think about it logically, let me ask Abdurrahman about it. Abdurrahman, how do you record expenses in accounting? In accounting, expenses are recorded in the debit or in the credit side usually?
That's right.
Exactly. And sales and revenues are usually recorded in the
Credit side.
exactly. So end of the year, let's assume that this company has $600,000 of expenses and $1 million of sales. End of the year, you close it. So when you close it, you reverse it.
Reverse it to the accounts.
Exactly. So what do you debit at the end of the year?
Profit for 100,000.
Yes, the sales and the revenues for $1 million. And what do you credit end of the year?
The expenses for 600,000.
Exactly. So expenses for 600K. You still have 400K in the credit side. That's gonna be retained earnings.
Retained earnings.
Yes. In Lebanon, we use 2 accounts. Okay, we put an account, then we close it against another account, but it's the 1-2. All right, so that's how it goes. So you see right here, retained earnings is in the credit. It means my equity is increasing or decreasing, Abdurrahman, if my retained earnings is in the credit side.
Equity is increasing.
That means this is a profit or a loss, the 400? Exactly.
Profit.
That's a profit. Also, we can tell that this is a profit because the sales, it's $1 million versus the expenses of 600K. So we are a winner in this case. And that's how we do it. End of each year, you always close the P&L account against the retained earnings. That's what it's meant by this sentence. All right. Now we have discontinued operations. When I say discontinued operations, it means for some reason you decide to discontinue a certain segment or discontinue a certain division or discontinue a certain subsidiary operating in a specific geographic area. So you stop the business. For example, I can have 3 different segments. I have the football division, the baseball division, and the basketball division. And for some reason, I decide to discontinue the baseball division. All right. So in my P&L, I'm gonna have discontinued operations that we discontinued, that we stopped, and you're gonna have continuing operations in your P&L. So you're gonna have 2 sections. Why? Because you need to present them separately. You need to present the discontinued operations separately from the result of the continued operations, the operations that are still running. Why? Because those readers of the P&L, they have to know that this result comes from the continuing operation and that other result comes from something that is considered as discontinued operations. I will dive a lot into the details, and this is a concept that can be tested the day of the exam. So they can ask you about the discontinued operations as part of the simulation or multiple choice question. And right here, we will dive into the details in a few minutes. Okay, but let me first introduce to you the format of the income statement. The income statement under US GAAP, we have 3 different formats. This is the first format out of 3. Zainab, what do we call the first format out of 3? We call it, what is the name? You see it? Single
income statement.
Yes, it's called the single
Single
step.
step.
Is it commonly used or not commonly used?
Not commonly used.
It is not commonly used. Honestly, I haven't seen it in my whole life. But how do we present the elements in that single step income statement? We put all of the
Revenues first.
yes, revenues and gains in one basket, revenues, net sales, other revenues, gains, etc. And in another basket, you
Okay.
put all
Expenses.
yes,
Revenues minus expenses. Net
yes,
income.
exactly. And by the way, right here in the expenses, they merge and they mix cost of goods sold, selling expenses, general interest, losses, everything, even the income tax expenses here. And this is not really commonly used in real life. It gets you to your net income. And there is something called the EPS, earnings.
EPC.
Yes, EPS, earnings per share.
Common share.
Exactly. By the way, the earnings per share, it's an important indicator to the investors. Why? Because that indicates, it's called earnings, يعني profit per share. So if I'm an investor and I have 10 shares, I know that my profit for those 10 shares, it's going to be 37.5 times 10. I have $375 of profit. Why? Because this earnings per share or EPS, you calculate it by taking the net income and divided it by the WACSO. We call it WACSO. And we study it in study unit 2. It means weighted average common shares outstanding. I'm talking about the common shareholders. I'm not talking about the preferred shareholders. So those common shareholders, they will take the profit, the net income of the company, and they will divide it by the weighted average common shares outstanding. For example, right here, they said we have 20,000 shares issued and outstanding. So when I take my calculator and I say 750,000 divided by 20,000, I'm gonna get 37.5. It means my profit per share is $37.5. That's why we call it earnings. Yani earnings, it means profit. Profit per common share, I have 37.5. And it's a good indicator for the investors. The investors, not investors, I prefer to say, if you want shareholders, because these are the shareholders. For the shareholders, they have to look at this indicator. Okay? That's the single step. Now, there is another presentation, which we call, what do we call the second presentation, Zainab? We call it the multiple step.
Multiple step income statement.
Yes. The first one, it was called single step. Single step, you put the revenues and the gains in one basket and all the expenses in another basket. Multiple step income statement, it's normal, we use it, but it's very detailed. So this is used, but very detailed. Yani it means, do they say net sales at the beginning or they give the breakdown? They give you the breakdown. So they tell you
Net sales.
gross sales minus discounts minus returns. So do they just give you total net sales or they give you the breakdown of the sales components?
They present the breakdown.
Exactly. And by the way, pay attention to something. Whenever we say net in accounting, that means you have something minus something else. So when I say net sales, it's the gross sales minus the discounts, minus the returns, minus the allowances. That's why we call it the net sales. Okay, make sense? So when I say net realizable value, it means something minus something else. When I say net book value, we'll see those designations later on. Means I have something minus something else. Net carrying value, net book value, net amount, something minus something else. So here they tell you my net sales, it's the total sales minus the returns minus the discounts that I gave to the clients. Cost of goods sold, they also give you the breakdown. What is the relationship between beginning inventory, cost of goods sold, ending inventory, etc., etc.? What is the relationship? What do we say?
Okay, so cost of goods sold is the beginning inventory plus purchases minus the ending inventory.
Okay. Purchases, if you are a retailer or a manufacturer, Noor?
If you are a retailer, if you are a manufacturer, you can use the raw materials and the consumables and so on.
Not just raw materials, right here you say the production, if you want. Because you have raw materials, direct labor, and also overhead. Factory.
Yes.
Exactly. And by the way, what do we call the beginning inventory and the net purchases or net production? What do we call it? You remember from the accounting classes before? Ahmed, do you remember what we call the beginning inventory plus purchases? We call it cost of goods available for sale. So sometimes they use the exam cost of goods available for sale. So when I say goods available for sale, it means the beginning inventory plus purchases or production. Why? Because this is what you can sell. Yani if you are a company, okay, and you have a client who wants to purchase an iPhone, what can you sell? You can sell him an iPhone from what you have already, the beginning inventory, or from what you purchase from the vendor plus purchases. So I can sell him an iPhone from these. That's why we call them the cost of goods available for sale. This is what I can sell. Make sense? And the formula is like really basic. Zainab, let's think about it. Let's assume you started this shop by having 20 iPhones. And then you purchased additional 10 iPhones and you sold 5 iPhones. Now, if you started your business with 20, you purchased additional 10 and you sold 5, what will remain at the end, the ending inventory? It will be, I started with 20 and I purchased additional 10. So how many iPhones do you have now? 30, right?
30.
And you sold 5. So 30, but you sold 5, remaining
30 minus 5, we're
Yes.
ending inventory
Exactly.
25.
This is 25. That's the relationship. You can do it in terms of quantity for a basic understanding. But what is the relationship between cost of goods sold, beginning inventory, purchases, and ending inventory? What do we say? Cost of goods sold is equal to beginning inventory plus the net purchases minus
ending of inventory.
Yes. Beginning and purchases, what do we call it? Cost of goods available for sale. Because what can we sell? We can sell the beginning inventory and what we purchase from the vendor, correct?
Okay.
So right here, they say, we have cost of goods sold, okay? And they give me the beginning inventory, the purchases, a lot of other things. I'm gonna write down the formula, all right? Just to see if it works. So cost of goods sold, Amir, is equal to beginning inventory plus the net purchases or net production minus ending inventory. Right here, what is the value of the beginning inventory?
1,200,000.
Exactly. So let's put 1.2 million plus the net purchases. When I say net purchases, it means the purchases from the vendors minus the discounts that the vendor gave to you plus transportation in.
So
So
450,000.
yes, right here you have purchases of
500,000 and then
But-
discounts of 100,000.
exactly. The vendor gave you a discount of 100. So your net purchases is 400. But you have to incur transportation in to bring the inventory to the warehouse. You paid 50,000. So what is the value of your inventory at the end?
450,000.
Yes. So this is the value of the net purchases is 450K. And they said when they did the stock count, the ending inventory was equal to, for example,
830,000.
yes. So now can I calculate the cost of goods sold?
Yes.
Yes, we can use our calculator and we can say it's 1,200,000 plus 450,000 minus
830,000.
how much?
820,000.
Exactly. So this is my cost of goods sold. Okay. By the way, this transportation in, let me just explain to you something. So for example, you purchased iPhones from the vendor. How much purchases did you make?
400,000.
Yes, 400. The original price is 500, but that vendor gave you a discount of
100,000.
Now, to bring, let's say, the mobiles from the US to UAE, you had to pay transportation of 50,000. And the goods themselves, they cost 400,000. So now when you receive the inventory, you're gonna record 400 or 450 plus the transportation in?
450, including the transportation.
Exactly. And that's why right here we see the transportation in, it's included. Okay? By the way, it's very detailed. That multiple step income statement, it's very detailed. We give the details of the sales and we give the details of the cost of goods sold. Then we present the operating expenses. We call them OPEX. OPEX, it means operating expenses. We have SG&A. When I say S, that stands for what, Amir?
It stands for Selling, General, and Administrative Expenses.
Exactly. SG&A, this is selling, general, and administrative expenses. Give me some example of selling expenses.
So sales, salaries, and commissions, freight out, traveling, advertising, and office supplies.
Exactly. By the way, these are selling expenses. You have the sales, the salaries of the sales people, the commissions paid to the sales people. You have freight out. I will explain the freight out. Travel, advertising, and office supplies are also considered selling expenses. What about the general and administrative expenses? What do we have?
Executive salaries, professional salaries, wages of office staff, depreciation, and office supplies.
So right here, the salaries of people other than
Sales
sales.
staff.
Yes. Depreciation is G&A. It's general and administrative. Office supplies also general and administrative. By the way, office supplies, it can be selling or general and administrative. Right here, office supplies, for example, attributable to the sales department. Right here, the office supplies attributable to other functions. Right here, the travel expense attributable to the sales people. Right here, you can have travel expenses related to CEO, for example, accountants, financial controllers, whatsoever. So we have those OPEX, operating expenses. The OPEX, it means, again, selling, general, and
administrative.
yes. But let me try to highlight this freight out. Who has an idea about the difference between freight out and freight in? Who has an idea about the difference between freight out and freight in?
Freight in, it's enter to cost of goods.
Exactly. It's included in the cost of goods. Freight out,
Write out its expenses for sales of goods.
Yes, but what's the difference between freight out and freight in? Why the other one is called freight in and this one we call it freight out and we say it's selling?
Freight in if we import something from outside. It's
Yes,
enter
but
for in goods of cost of goods.
you are close, Zainab. You are close. So it has to do with import and export. Let me explain it. By the way, it's gonna be explained in deep details in study unit 6, the inventories. But I will give you an introduction just to understand the Incoterms. We call it Incoterms. When we ship goods between countries, we have Incoterms. For example, DDP, CPT, CIF, FOB. There are a lot of Incoterms. And mainly in the CPA exam, they focus on the FOB. We have FOB destination and we have FOB shipping point. And I will explain to you the difference between FOB destination and FOB shipping point. We will explain it again, by the way, in study unit 6 related to inventories. But when we say we are shipping FOB, it means we are shipping free on board. I'm going to start with the FOB destination. FOB destination, for example, I have a seller in China who's selling goods to a client based in UAE. So the seller is China and the buyer is in UAE. And let's assume the seller in China is selling 10 laptops. The cost of each laptop is $500 to this client in UAE. And the shipping terms they agree upon, it's gonna be FOB destination. What does it mean? Why we call it FOB destination? It's called FOB destination because when the goods reach the destination, China removes the goods from the inventory and UAE records the goods in its inventory. Okay, I'm gonna explain it to you. So right here, we said we have 10 laptops and the cost of each laptop is $500, right? So 10 laptops times $500, what is the value of the goods of the laptops in total? It is 5,000, right? Noor. Now assume China is putting the goods on the ship and they are shipping by sea. When they ship by sea, what does China record? It's FOB destination.
Okay.
Does it record the sale or it has to wait until the goods reach the destination to record the sale transaction? At the goods, they just place the laptops on the ship.
Sorry,
They-
the connection was
lagging.
yes, yes.
So Noor, can
Okay.
they record the sales revenue when they put the goods on the ship or they cannot because it's FOB destination and the goods
Okay.
did not reach the
Since it's
destination?
FOB destination, then they are responsible for this items or يعني على هيدا shipment
Exactly.
until it arrives to its destination.
Exactly.
So the risk and rewards are on the seller, so they can't record revenue unless the shipment arrive.
Okay, that's absolutely correct. So as long as the goods did not reach the destination, they cannot record the sales transaction. But by
Yes.
the way, they can make a journal entry if they want. They can say inventory warehouse because they remove those laptops from the warehouse. And they can, if they want, they can debit inventory in transit,
Yes, for sure.
right? So they make a reclassification just to know that they have 5 laptops out of the warehouse and they are in the ship. Now, UAE records anything or nothing so far? Nothing.
Yes, nothing.
Okay, nothing. Now, when the goods reach the destination, what will
Okay.
China do?
Okay. Then they will record revenue,
Yes, so I have
Okay.
sales revenue,
accounts
$5,000.
receivable.
Exactly, accounts receivable, 5,000. And definitely, I'm gonna remove
The inventory in transit for sure.
exactly, I will remove it. And I will record cost of goods.
If it's حسب if it's perpetual or periodic.
No, whether it's periodic or okay. Now assume it's perpetual. Periodic, it's not the correct way of doing things.
Okay.
Okay. And by the way, there is this matching principle. Whenever the sales revenue is recorded, you also need to record,
Cost of goods sold.
yes, matching principle. And
Okay,
it's
so
one
you
of,
believe that perpetual way is the best way in
exactly,
order for matching principle, and other thing is to control the inventory, isn't it?
exactly. That's absolutely correct. So for matching principle, if you look at the multinational companies and also the big companies, they always make sure that whenever the sales revenue is recorded, you also recorded,
The cost of goods.
yes, because if you do not record it in the same period, that will affect the gross profit margin. You're gonna have a lot of ups and downs, and it's not normal because
Okay,
usually
but
they have
this if they are reporting on monthly basis or quarterly basis.
all of the multinational companies, they report on a monthly basis, all of them.
Okay.
Okay, so they make sure they use the perpetual system, which is like this. We're gonna talk about the periodic and perpetual that Noor is mentioning in study unit 6. And by the way, when the goods reach the destination, what will UAE record?
Okay, so they will record inventory
Yes,
for
debit,
accounts payable, the vendor.
exactly, and credit accounts payable. By the way, in such a shipment, who pays for the freight?
Okay, if it's for destination, يعني it's included. لا.
It's China.
Yes.
China will pay it. And by the way, we say that China is paying the freight expense to encourage to sell those laptops to the client in UAE. So to encourage the client to buy the laptops from China, we say we will bear the freight cost. And in this case, since the seller is paying the freight cost, what do we call the freight cost in this case? We call it freight
Out.
Freight out, exactly. Freight out expense. And it's an expense, it's a selling expense in the income statement. As G&A, it's selling. And
Okay,
we
so
credit
if
cash.
it was included in the statement of the buyer, then it will be freighted.
Exactly.
Okay.
I will show you right here.
Okay,
But
thank
freight out, it's paid by the seller to encourage the buyer to purchase. They will say, we will bear the freight cost. So it's like commission, it's like selling expense somehow. And we are encouraging. So who records the freight out, seller or buyer? In the FOB destination, who records the freight cost?
the seller.
Yeah.
Listen, exactly. And it's going to be reflected as a selling expense in the income statement of China. By the way, if the goods are damaged right here, if they are placed on the ship and the goods are damaged, who will
The
bear the cost?
responsibility, the seller for sure.
Exactly, China. UAE is fine. And definitely for similar shipments, they will be insured. All right? No problem. Now, the second one, I would like to ask now, Eme, if you want to participate, unmute yourself whenever you want. Amir, the second one, FOB shipping point. We did not say destination. The shipping point, it means the way of shipping the goods. It can be by sea, by airplane, by railroad, by truck, correct?
Yeah.
So this is the shipping point. Now, FOB shipping point, it means when the goods reach the shipping point, which is,
The ship or the airplane.
yes, whatsoever, the truck, the common carrier, okay, then the seller
Removes the goods from its inventory.
and UAE,
Has to record it in its inventory.
exactly, noting that the goods did not reach the destination. For example, the goods are still in the sea. And who pays for the freight? Who bears the freight cost?
The buyer.
The buyer. And what do we call this freight?
FOB, freight in.
Freight in. And remember, the freight in is included in,
Inventory of UAE,
yes,
of the buyer.
freight in is included in inventory of UAE. So I'm gonna give you an example. Now, right here we have the same example, laptops, but FOB shipping point. So China puts the laptops on the ship. What will China record when loading the goods on the ship?
They will remove the inventory from their
Exactly.
yeah.
And against it, in the debit side, what do you record?
Sales, right? Revenue.
Cost of goods
Oh,
sold,
got
and
it.
also matching principle, cost of goods sold. So I need to record,
Sales revenue, yeah.
yes,
Sales revenue credit, cash debit, right? Or accounts
yes,
receivable.
cash or accounts receivable, exactly. Now, UAE did not receive the goods. They are still in the sea. However, they will debit.
They will debit will be goods.
By the way, it's inventory, but they do not have it in the warehouse. So they label it GIT. What's the meaning of GIT?
Goods in transit, right?
Goods in transit, exactly. So we have goods in transit, and in the credit side, we
Accounts
record,
payable.
yes. But now let's imagine that on top of the $5,000, the freight in is amounted to 1,000. So right here, the inventory, the goods in transit is going to be the 5,000 or the 5,000 plus the 1,000 freight in.
5,000 plus 1,000.
Exactly. So that will be
6,000.
6,000. And accounts payable or cash, it will be for 6,000. Also the freight. That's why we say the freight in is included in the inventory.
Mm-hmm.
If the ship sinks, who will bear the loss?
If the ship sinks, then it should be UAE, right?
UAE.
Yeah.
Because it's called FOB shipping point.
So
So
it's
once
already
the
in
goods,
their ownership.
exactly. Once the goods are placed on the common carrier, the ship, the airplane, whatsoever, then it's all, the risk of loss is transferred to UAE, the buyer. Before that, it's going to be with the seller. Make sense, everyone?
Yes.
All right. Aimee, would you like to participate? I think we're not able to hear you. I don't know if you have a problem in the microphone. Try to check the volume or the settings. I think you did not join with the audio. Okay. Let me also check. Yes. Yalla, it's fine. We will find a solution. Anyway, so this is the multiple step income statement. And by the way, so we said we give the details of the sales, we give the details of the cost of goods sold, we give the details of the SG&A. And now we have income from operations. By the way, Noor, do we always say income from operations? Always? Or sometimes we change this terminology?
You mean in the
And the
okay
P and
in the
L.
income statement? Okay.
Yes. So it's always income from operations just like this. Or sometimes it's different.
It's gross profit, I think. لا
A
لا لا.
gross profit, it's the sales minus cost of goods sold only.
Okay.
But I think they
It's not
said,
profit. I think it's not profit.
okay,
Income, net income.
net income if you deduct the taxes. So far, look at this, because it's a multiple step and very detailed.
Okay.
They details of the sales.
So it's income before tax?
Exactly. Income before tax and before interest and before other revenues,
Yeah.
before other expenses. But by the way, if you see income from operations at this level, it means you have discontinued operations or no discontinued operations.
Oh, yes, we have then
If they don't put continuing operations, that means in this company, there is no
discontinued.
If they put income from continuing operations, it means this company
Has discontinued
yes.
operations.
Yes. And there are some MCQs sometimes they ask about this small little tiny detail. And students don't pay attention to it. Income, if right here, you can have income from operations or you can have income from continuing operations. If you just see income from operations, that says minus cost of goods sold minus SG&A. If you just see income from operations, that means this company does not have discontinued operations. But if they put income from continuing operations, it means this company has discontinued operations. And they ask about this little tiny detail. So after reporting the income from operations or continuing operations, we have other revenues and gains like gain on investments, dividend revenue. We're going to see those details in the upcoming lectures. And we also have other expenses and losses like interest expense, loss on disposal of equipment, whatsoever. And then they put the income before taxes. And then we have the income tax expense. The net income, we call it the net income because it's net of taxes. By the way, we can verify the calculations if you want. I will highlight the important information to see things in a better way. I can see net sales of 1,050,000. I can see cost of goods sold of 820,000. I see total SG&A of 148,000. I see other revenues and other gains of 1,075,000. I see other expenses and losses of 322,000. Okay, we can verify the calculation if you want. Now, this 1,050,000 minus the 820, it's 230, that's my gross profit. Always sales minus cost of goods sold is your gross profit. So if you take your calculator right here, you say 230,000 gross profit minus 148 total OPEX plus 1,075,000 other gains and revenues minus 322 other expenses and losses. I have 835. This is my income before taxes. You deduct the income tax expense paid to the government, and then you get the net income. By the way, if I divide the 85 tax expense but 835, we can do this calculation. Let me clear it. 85 divided by 835, the tax rate, it's around 10.18%. But tax, it depends, because not all of the elements are taxable, okay? We will see this later on in another study unit already. So that was regarding the presentation of the P&L. Again, when I say net income, it means net of taxes. And right here, you can see the EPS. EPS, earnings per share, profit per share. I take the 750K net income, and I divide it by the weighted average common shares outstanding, 20,000. I'm going to get 37.5. Again, pay attention right here. At this level, as I said before, if they put income from operations, it means this company does not have discontinued operations. If they add the word continuing, that means the company has discontinued operations. All is good, all is clear so far? So regarding the income statement, we have the single step, which is not commonly used. I group all the revenues, all the gains, all the expenses in another basket, and I say this is my net income. The multiple step income statement, it's used, but not that much because it's very detailed. It gives the details of the net sales, the cost of goods sold, the gross profit, the SG&A, other revenues and gains, other expenses and losses, the income tax expense. And we have the condensed. So single, multiple, and condensed. Condensed income statement, this is the one that is used the most. So that's the most common method of presentation, and it only includes the totals of the multiple step format. So it only includes the totals of the multiple step format. All right, right here, Zainab, what is our starting point with the condensed income statement? The starting point is
Cost of goods sold. Net sales.
Net sales. Do we give the breakdown, for example, sales, gross sales, minus discounts, minus returns, minus allowances, or just it's a lump sum total net sales, that's it? Do we give details?
No, not sales. He
Exactly.
sales minus a discount.
Exactly, but you just give the total. It's condensed. It's not like the multiple step. Where do you present the details?
Yes.
In the multiple step or in the condensed, the details?
At
The
multiple income
Yes.
statement, we present details.
Exactly,
But
details.
at condensed, summaries.
Exactly.
Net.
Summaries and totals. That's absolutely correct. So we also put the cost of goods sold. Now, always net sales minus cost of goods sold. That will give you your gross profit. By the way, if I ask you about the gross profit margin, how can you calculate the gross profit margin? The gross profit margin, it's always the gross profit divided by the sales.
By
So
20.
This is the gross profit. You divide it by the net sales of how much? 1,050,000.
Net sales.
So what is your gross profit margin? 22%, give or take. By the way, let me tell you something.
21.90.
Exactly. So almost 22%. When I say gross profit margin, so remember, gross profit margin, I take the gross profit and I divide it by net sales. Whenever a ratio has the word margin, That means you are dividing by net sales. Whenever you see the word margin in a ratio, that indicates that you are dividing by net sales. So when I say gross profit margin, it means the gross profit divided by net sales. When I say net margin, it means net income divided by net sales. But anything that has the word margin, it means what is your denominator in this case, Zainab, if it has the word margin? Your denominator is net sales. So when I say gross profit margin, you are dividing the gross profit by what? Gross profit margin by net sales. Okay, you see, Zainab? So when I say gross profit,
Okay.
what
Okay,
is
okay.
your gross profit?
Gross profit 2030.
Yes, which is net sales minus.
Okay. If you want
So net sales minus cost of goods sold,
cost
that's
of goods sold,
yes. But when I tell you
get
gross profit margin, what do we divide? The gross profit
divided always by net sales.
Exactly. So it will be 20%.
By net sales.
And
Yes.
then in this condense, after, okay, net sales minus cost of goods sold, this is the gross profit. Do we present the details of the selling expenses or just the total? Total.
Just a total.
By
Because
the way,
it's condensed.
yes, but sometimes, even in the condensed, they put net sales, cost of goods sold, but they say selling expenses, these are the selling expenses. Sometimes they give a breakdown. And then after the selling expenses, which category we have?
General and administrative
Yes.
expenses.
And that will be the income from operations. Is this income from operations or income from continuing operations? What do you see right here? You see continuing or just income from operations?
Just from operations.
So does this company have discontinued operations or it does not have discontinued operations? This company
does not have continued operation because
Exactly.
it's not listed at condensed income
Exactly.
statement.
Because they did not say income from continuing operations. And now you have the interest expense. So interest expense, it's other expenses and losses as well. We have our income before taxes. This one, it's called earnings before taxes, EBT you can call it. And then minus the tax expense,
Okay.
you're gonna get your net income. How do you calculate the
net
EPS?
income?
How do you calculate the EPS, the earnings per share?
Net income divided by 20,000, we get 37.5.
Exactly. So we take the net income, we divide it by the WACC, so the weighted average common shares outstanding, for example, or the number of shares issued outstanding, and we get 37.5. All right, all is good. So 3 different presentations. Again, a recap. The income statement, we have the single step, group all revenues, all sales in one basket, group all expenses in another basket. We have the multiple step. That means I give the details of the net sales, I give the details of the cost of goods sold, I give the details of the SG&A, I give the details of other revenues and gains and other expenses and losses. And then we have the condensed. Condensed, just totals, net sales, total cost of goods sold, total selling expenses. But you can give the breakdown of the selling expenses for sure, and the G&A as well. Now, let us try to do one MCQ. By the way, Abdurrahman, when you were not here, we explained the freight out and the freight in. So try to play the recording later on to understand the differences between freight out and freight in. All right? And now, I'm going to give you an MCQ related to the expenses. Okay? Amir, let's read example 6. What do we have in that MCQ?
Brock Corp reports operating expenses in 2 categories, selling and general and administrative. The adjusted trial balance at December 31st included the following expenses and losses. Accounting and legal fees, $120,000. Advertising, $150,000. Freight out, $80,000. Interest, $70,000. Loss on sale of long-term investment, $30,000. Officer salaries, $225,000. Rent for office space, $220,000. And sales and salaries commissions, $140,000. So one half of the rented premises is occupied by the sales department. So Brock's total selling expenses are.
So they just want the selling expenses.
Yeah.
Now, OPEX, operating expenses, we have two categories. We have the S.
G&A.
Exactly. They are targeting which category?
Only selling.
Only selling. So let's label these accounts S or G&A. Accounting and legal expenses.
This is G&A.
Exactly. So I will put an arrow right here. Advertising.
S.
Bravo. Freight out.
S.
Yes.
Interest is G&A.
Even I forgot about it. I'm not sure it's G&A. I think it's other. Let me go back to the book because I'm like really a little bit confused. Interest, is this G&A or neither?
No, this is neither.
Exactly. It's not selling. It's not general and administrative. It's in the other.
Other expenses.
Exactly. So I will set it aside and I will not label it. Loss on sale of long-term investment.
I think this is not an expense.
But it is a loss. So it affects your P&L. Look at the following. When we have, for example, loss on disposal of equipment, other expenses and the losses. So this one also other, exactly. So I will not label it. And now.
Officer salaries are G&A.
Bravo. Officer salaries, offices like CEO, CFO, COO, whatsoever.
Rent for office space. So one half is by sales. So half of it is S, half of it is.
Exactly. Pay attention to the rent for office space. They said one half is occupied by the sales department. Accordingly, the rent right here, you will say 110 is selling and 110 is G&A. And then
sales, salaries, and commissions is S.
Exactly. So this is, they asked about the selling. I know this is paid to the sales people. Here we have 110 because half of the space is occupied by sales people. We said we have freight out and we have advertising.
Yeah.
So now let's bring our calculator. And if we make that computation, 150 plus 80 plus 110 plus 140. I made a mistake. 150 plus 80 plus 140 plus 110. It's how much?
480.
Yeah. Exactly. So right here, you can see that $480,000 is the correct answer. Accordingly, we're done with MCQ number 6. All is good?
Yes.
All right. That was the income statement. So remember, what I said before, the cost of goods sold is equal to beginning inventory plus purchases or cost of goods manufactured minus ending inventory. And the beginning inventory plus purchases or cost of goods manufactured, we label this as cost of goods available for sale. I explained this during your absence, Abdurrahman. So when you watch the recording, you're going to make a recap why we call them cost of goods available for sale. All right. So let me erase this one and let us start selling expenses. We did it. So I told you selling expenses, it includes the salaries of the salespeople, commission paid to the salespeople, travel expenses of the salespeople, communication, internet costs consumed by the salespeople. Let's say we have also freight out. We have the depreciation of the sales department, advertising costs. All of these are selling expenses. G&A, insurance, for example, the salaries of the other employee other than the sales people. You have accounting fees, legal fees. And as I said before, the interest expense, it's another category. It's not SG&A. Loss on disposal of equipment, it's not SG&A, it's another category. But by the way, depreciation, if you scroll up, depreciation is G&A. Right here you see depreciation, it's in the category general and administrative. And right here we are talking about, by the way, depreciation of the sales department, you can find it right here, depreciation also. If you see depreciation under selling expense, it means that's the depreciation of the sales department, the space that is occupied by the sales people. And there is something also interesting. I've seen it before in one of the MCQs. They tell you these items must not be reported net of tax. Sometimes they tell you the items are reported net of tax, and sometimes they tell you the items are not reported net of tax. Pay attention to this, and I will explain it. If you look at the P&L right here, mainly the expenses. Abdulrahman, do you calculate the tax expense at this level? So you say 18,000 tax deduction is that much, remaining is this much? Do you compute the net of tax at this level, the expense? Noor?
No.
No. For example, when I say net sales, do I compute the net sales figure right here at this level without taxes? Not really, correct? When do we calculate the tax expense? At the end. So when they tell you the expenses and the revenues in the P&L, they are reported net of tax or not net of tax? Shah Abdurrahman, what do you think? The revenues and the expenses in the P&L, when we put the lines, are they reported net of tax or not net of tax? Right here, the elements. You see them?
Not
Exactly.
of course. Yeah.
Exactly, not net of taxes. Because sometimes in the exam, they will try to trick you. They will say net of taxes, and you will not focus on this sentence. This sentence is super important. When I present the P&L, the sales, the revenues, the gains, the SG&A, whatsoever, they are presented to not a net of tax. At the end, I present the tax expense, and I present the net income, my net result. So this is why right here, this is a super important sentence. They say these items must not be reported net of tax. Okay, it's one of the tricks that you can see the day of the exam. Accordingly, we're done with the presentation of the P&L from continuing operations. And by the way, I will share those Excels with you. That's the net income. Usually, the income presentation is as follows. In case the company has continuing operations and discontinued operations, the income statement is going to be presented in two parts. We have income from continuing operations, and we have income from discontinued operations. But in that specific P&L that we had in the book, you can only see income from operations. Okay, right here you see it's income from operations. If you see income from operations again, that indicates that there is no discontinued operations in this specific company. But if they have put right here income from continuing operations, that would have indicated the existence of discontinued operations. By the way, I'm going to continue with the discontinued operations after the break, because now we have a short break. Cancel. I'm not going to stop. I'm going to pause the recording. All right, so now we're going to talk about the discontinued operations. Right here, they talk about the discontinued operations, but I'm going to introduce it a little bit using the Excel. All righty. Again, if you go back to my Excel entitled Study Unit 1 Financial Statements, you can see the income statement presentation. You can see SG&A examples of selling, example of G&A. But definitely, when you do the multiple choice questions, things become better and clearer. And now we have the discontinued operations. When I have a discontinued operations, I need to check when, for example, that segment, that division is classified as held for sale. To be classified as held for sale, there are conditions. First, you need to have a plan to sell the component. So we have a plan to sell the baseball component, for example. Second, if you want to sell the baseball component, it's available for sale in its present condition. So now I can sell it. Accordingly, the baseball component is available for immediate sale in its present condition. That's the second one. Third, there is an active program to locate a buyer. We have a program to find a buyer, and we are actively looking for a buyer. So that's the third condition to have a component classified as held for sale. Fourth, the component is being actively marketed for sale, and company expects to complete the sale within a year. So you are actively marketing for the sale of that component, and you expect to sell it within a year. You're not expecting to sell it after 10 years, for example. Okay, this is the fourth condition. And the fifth condition, the decision, okay, to get rid of that component represents a major strategic shift in general, the day of the exam. When they want you to know that there is a discontinued operation, they will use the decision represents a major strategic shift. These are keywords, major strategic shift. And by the way, once the component is classified as held for sale, you stop the depreciation of the assets. Assets are no longer depreciated once the component is classified as held for sale. But you need to bear in mind that there are 5 conditions for a component to be classified as held for sale. We have a plan. We are able to sell it in its present condition. We are actively looking for a buyer, actively marketing for sale. We're expecting to sell it within a year, and definitely the decision represents a major strategic shift. This is super important. Pay attention to those keywords. And then, regarding the discontinued operations, if I go back to the book before diving into the details of the calculation, they tell you right here, are reported separately net of tax. What does it mean? It means when I talk about the income statement presentation, the component that is held for sale is presented separately. Its results are presented separately right here. Income from continued operations. And by the way, it is the net of tax. It means you have to present it net of tax. Okay, I will show you how we presented net of tax. That's the first point. And then they tell you, if the component of an entity, discontinued operation, is classified as held for sale, remember, classified as held for sale, there are conditions. We talked about those 5 conditions. We have a plan, we're actively looking for a buyer, we're actively marketing for sale, expecting to sell it within a year, major strategic shift. Okay, so there are conditions. But how do we measure that component? It's gonna be measured at the lower of carrying amount or fair value minus cost to sell. And I will explain this idea as well. But by the way, when I say fair value minus costs to sell, this is also being referred to as being the net realizable value. Because remember, in accounting, when I say net, it means I have something minus something else. So when I say net realizable value, it means the fair value minus the cost to sell. Okay, we will explain this reporting lower of carrying amount versus the fair value minus cost to sell. All right, we have an example. And that example, I will explain it using the Excel. But first, I'm going to introduce, if you want, the calculation of the discontinued operations in general. If you classify it as held for sale, for example, in year 2025, but you sell it in year 2026, okay, you're going to have 2 things. In the first year, when you classify it as held for sale, you're going to have 2 types of losses, if you want, of result. You have loss from operations. By the way, sometimes you can still have gain from operations and decide to discontinue that component. So I have the loss from operations, which is reported net of tax, and I have impairment loss, which is also reported net of tax. This is in the first year. And if the sale is completed next year, then in the second year, you also have loss from operations and loss or gain on disposal. By the way, you can have losses, you can also have gains sometimes. Very rare cases, the majority of the time it's going to be a loss. But you're going to have loss from operations in the year of decision and when you complete the sale. And in the year of decision, you're going to have an impairment loss. And in the year of sale, you're going to have loss or gain on disposal. You will have a better understanding with the example with numbers. But sometimes you take the decision, you classify it as held for sale in year 2025 and sell it in year 2025. If you make the decision and you sell it in the same year, then you're going to have loss from operations, impairment loss, and gains or losses on disposal. Okay, I will explain the 2 different scenarios. So if you didn't understand what I have just explained, that's absolutely fine. Now we will have a better understanding. Let's start with that first example, example 1.5. It's about the income statement presentation of discontinued operations, and I would like to ask Amir to read it. Amir, let's go ahead with the first one. What do they say?
On July 1st, year one, MK Co. approved a plan to dispose of segment X on October 1, year one. As a result, segment X, a component of the entity, was properly classified as a discontinued operation. It was sold on October 1, year one for $480,000. MK's income tax rate is 40%. The following data pertains to segment X. Operating losses were $110,000 for the period of January 1 to June 30, year one. Operating losses were $100,000 for July 1st to October 1st, year one. So the operating losses presented above do not include loss on disposal or write down to fair value minus cost to sell. The carrying amount on July 1st, year one was $600,000, and fair value minus cost to sell on July 1st, year one was $450,000.
So mainly this is the given, and then the next page, it's the solution. So
Yeah.
far, when I read something like this, the day of the exam, honestly, I do not understand anything because it's a lot of information and my brain cannot digest the information. So what I will do is, especially if you're starting preparing for your CPA exam, take a screenshot of this example. Okay, I'm gonna take a screenshot. So let me start new. Okay, and I'm gonna take this small screenshot and I will take it to Excel because I've just started my preparation for the CPA exam and it's not easy for me to understand this information. Now, when we read this, okay, Amir, July 1, year 1, the plan was approved to sell segment X on October 1, year 1, and we completed the sale also in
Year one.
year 1. So it seems that the decision, okay, and right here you can see properly, it was properly classified as a discontinued operation. I have discontinued operations. We made the decision in year 1 and we completed the sale in year 1. So if the decision is made and the sale is completed within the same year 1, then you're gonna have 3 components to be calculated. First, you're gonna have the loss from
Operations.
And by the way, the loss from operations, it's gonna be from the beginning of the year. It's not gonna be from when you made the decision. No, it's gonna be from the beginning of the year until you completed the
End of the year. So October 1st.
not end of the year, until you completed
The sale.
the sale. Why? Because right here, you made the decision and you sold it in the same year. So if I make the decision and I sell it in the same year, the loss from operations related to discontinued operations, it's gonna be from beginning of the year
till the sale date.
till the sale date. So right here they said loss from operations, okay? Operating losses, they gave you from January 1 to June 30 and from July 1 to October 1. Why they gave you those specific dates? When was it sold?
It was sold on October 1.
So when I want to calculate the losses from operations, I will calculate it from January 1 till
October 1.
Yes. So right here, what is the total loss from operations from January 1 till October 1?
It was 110,000. No, it was 210,000.
Exactly. We have 110 from January 1 till end of June. Then we have from July till 1st of October, we have 100. So total, it's going to be 210. And right here, I'm reporting loss from operations before taxes, 210. Losses, I'm putting it as a negative figure. That's the first thing. Then we said there is another loss. If I make the decision in year 1 and I complete the sale in year 1, I'm going to have something called
impairment loss.
Okay, impairment loss. Let me do something. I was reading few minutes ago this paragraph and I told you that we will interpret it later on. This sentence. We said if a component is classified as held for sale, then it is measured at
Held for sale.
Yes, it is measured at lower of
carrying amount of fair value minus cost to sell.
So right here, when I say fair value less cost to sell, minus the carrying value or the book value of the component, which is measured at lower. In other words, what am I calculating?
Net realizable value, impairment.
Yes, right here, this is net realizable value. So carrying amount versus net realizable value, that difference represents the
Loss.
yes,
The impairment loss.
exactly. It's the impairment loss. That's absolutely correct. And right here, if we focus on this, I'm going to calculate the impairment loss. Look, Amir, at the carrying amount of that component. What was the carrying amount of the component when we approved the plan to dispose of the segment?
600,000.
Yes. So right here, you can see the carrying amount at 600,000. And what was the net realizable value or fair value less cost to sell on July 1 when we approved the plan to dispose of the segment?
450,000.
Yes. So I have 600 and 450. Now, if you want to think logically whether there is an impairment, yes or not, think about it like this. You say, I recorded on the balance sheet for which value?
600,000.
But the fair value in the market, less cost to sell, I can sell it for only how much?
450.
Isn't it impaired?
Yeah.
Because
Loss.
in the market, it's worth less. So what is the value of your impairment?
150,000.
So this is my impairment loss of 150,000. And by the way, it makes sense. Now let me show you. So if you look at the balance sheet, that component, for example, it has a carrying amount, a book value of
600,000.
yes. So I have 600K on my balance sheet. And now it is impaired by
150,000.
so what will be the new value now on the balance sheet?
450,000.
450. So when I read the sentence, it is measured at the lower of carrying amount. What is the carrying amount?
450,000. Oh, 600.
600. And the fair value minus cost to sell, the net realizable
450.
value? 450. Now, after booking the impairment, it is reflected
The same.
the same, the lower of. You see why we do this impairment loss? Because the component needs to be reported at the lower of the carrying amount or
The fair value minus cost to sell.
exactly the net realizable value. So that's why right here we have this value. Make sense? Make sense to all, right? Zainab, Eme, is it okay? Already. So this is the second point. Now, the third loss, we made the decision in year one and we sold the component in year one. By the way, it's not necessarily a loss. It can be a gain. It's the result on disposal. So when I want to calculate the loss or gain on disposal, that's going to be the difference between the selling price, Amir, and what?
Now, selling price minus the fair value less cost to sell.
Exactly. So it's the difference between the selling price and the net realizable value. Now let's look at the following. For how much did we sell it?
We sold it for 480,000.
Exactly. And what is the net realizable value?
450,000.
Did you sell it for more or less?
We sold for more.
Exactly. We sold it for 480, which is more than 450. Am I a winner or a loser?
We are winner of $30,000.
Exactly. We are winners of $30,000. So now right here, I have a gain on disposal of 30,000. So we made a decision in year one. We sold it in year one. We found three things. Loss from operations of
Loss from operation
yes, of
of
210.
$200,000.
Exactly.
And then impairment loss of $150,000.
And yes,
And
we
gain on
have impairment
disposal
loss of 150,000 and
gain on disposal of 30,000.
exactly. So three components. And now this is before taxes. Pay attention, before taxes. What did I tell you in the presentation right here? We said the income from discontinued operations, it needs to be
Net of tax.
bravo. So Amir, is this the final result or we need to take it after tax?
No, we have to take it after tax.
Exactly. Pay attention. What is the tax rate, the income tax rate in this company?
40%.
So government takes 40%, you keep
60%.
If it's a gain. But remember, when we have losses, okay, when we have losses, we are also benefiting from something. Because if you have a loss, you will get a tax benefit if you are a loser. So right here, 210 before taxes, the government's share is 40%. Your share is how much? Your share,
60%.
yes. So right here, when I double click on the cell, I'm multiplying the 210 by 60%. Again, for the impairment loss, if we look at the impairment loss, the 150, remember, government share is 40%. Your share is
60%.
exactly. Exactly. And for the gain, you made a gain of 30,000. The government will take 40%. You keep
60%.
60%. So what is the after-tax final result, income or loss from discontinued operations? It's a loss or an income?
Loss of 190,000.
198,000. So that's regarding this exercise. If we scroll down, we're gonna see that at the end, we have a loss from discontinued operations amounted to 198,000. Amir, when you make the decision in year one and you sell the component in year one, how many elements are included within this loss from discontinued operations?
3.
3 elements. What are those 3 elements?
There's
First,
loss of operations.
exactly.
Impairment loss and
And
gain or loss on disposal.
exactly. By the way, as I said before, you can still have sometimes gain from operations and still decide to sell the segment or the component. It doesn't matter. So if you see a gain from operations, that's absolutely normal. This is in case the decision is made in this year and the sale is made also in this year. Now, there is another scenario. The other scenario is we make, for example, the decision in year one, but we do not complete the sale until year two. So right here, if I take down those screenshots, okay, let me take down the screenshot. This is the screenshot and this is the screenshot. In case I make the decision in year one and the sale is completed in year two, then for year one, you're gonna have 2 components, the loss from operations and the impairment loss. And in year two, you're gonna have the loss from operations and the gain or loss on disposal. So 2 different things, all right? I'm gonna give you examples which are definitely from the AICPA, and we will have a better understanding of that case when year one and year two, I have made the decision in year one but completed the sale in year two. Let us take a look at this one, example 5. Example 5, it's somehow easy. It's not that challenging. And I would like to ask Noor to read it. Noor, let's try example 5.
Okay. Current liabilities $500,000. Long-term liabilities.
No,
Eight.
this one.
Oh, okay.
5.
During January, year 6, Leo Corp agreed to sell the assets of product line of its hard division. The sale was completed on January 15, year 7, and resulted a gain of disposal of $900,000. Hard's operating losses were $600,000 of year 6 and $50,000 for the period from January 1 till January 15 of year 7. Okay. Disregarding income taxes and assuming that the criteria for reporting a discontinued operation are met, what amount of net gain or loss should be reported in those comparative year 7 and year 6 income statements?
All right. Whenever you have a similar situation, because this is like a real life example, real exam, yani real MCQ from the real exam. If you have something like this, try to proceed like a math equation, like 1 + 1 = 2. So first step, since I'm preparing for my CPA, I'm gonna take a screenshot and take this MCQ to Excel for a better understanding. That's the first step. Now let us open the Excel. Right here, I will put Control V, and this is the exam. Usually, no, the first step is I ask myself, did I make the decision in the same year and sold it in the same year, or I made the decision in this year and sold it in another year?
Okay, so I made the decision in year 6 and then the sale occurred in year 7.
Exactly. So I have just like this, year 6 and year 7. If you make the decision in year 6 and sell it in year 7, then in year 6, how many components you're gonna have?
Okay, so I'm gonna have two components.
Exactly.
Wait, sorry.
Yes. First, the gain or loss from operations, the majority of the time it's gonna be loss. And the other component, it's gonna be?
The impairment loss, you mean?
Yes, the impairment loss. Because usually we report that segment held for sale
Okay,
at lower
at the
of.
lower between the net realizable value and the cost.
Exactly. So this is regarding the year of decision, if you will. So right here when I read, they said during January of year 6, they agreed to sell the assets and product line of its hard division. Then they said it was completed in year 7, that's fine. And we have a gain on disposal, that's fine. They said Hart's operating losses were 600K for year 6 and 50K for this period. So right here, can I tell the value of the losses from operations for year 6? Because we have year 6 and we have year 7. So what is the loss from operations related to year 6 when we made the decision to dispose of the hard division?
Okay, the operating losses was 600,000.
Exactly. So right here, what will you put? You will put $600,000. Make sense?
Yes, makes sense.
All right. This is the first step. The second step, we have impairment loss. Fair value less cost to sell. Did you see anything related to fair value less cost to sell?
Okay, so if we, okay, the sale was just 1 second.
By the way, I only see three
Gain
numbers.
on disposal.
Okay, gain on disposal. Gain on disposal, this is when you sell the segment. This is when you sell the component. This is when you
Okay.
sell the division. It's gonna be in
Yes.
year 6 or year 7 that gain on
That's
disposal.
in year 7 for sure.
Bravo. Bravo, year 7. I see nothing about fair value less cost to sell or net realizable value, and I see nothing about the carrying value or book value. So it seems it's like if they already reported the component at lower of cost, a carrying amount, or net realizable value. So right here,
Exactly.
they mentioned nothing. I will put 0.
The cost.
No, you put 0 because
I mean the impairment loss is 0, but it's reported at cost.
exactly, it's reported at lower of carrying amount or net realizable value. So right here, they mentioned nothing about it. I'm gonna assume it's 0, but definitely on the balance sheet, that component is reported at lower of cost or
Not realizable value.
exactly. So we're done with
Or
year 6.
should we say it that the recoverable amount?
Okay, you can, yes, under IFRS, you use the word recoverable amount.
Okay, so under US GAAP, it's not realizable value. So
We say, yes, fair value less cost to sell or net realizable value, and we use the terminology carrying value or book value of the component.
okay, so for me in the diploma, I studied that the net realizable value is just used for the inventories.
Used for what?
For the inventories.
Right here, it's different because even in the CPA, if you use the word it's not just with inventories, by the way. Net realizable value, whenever you have something minus something else, it's gonna be net realizable value. For example, for inventories, you have the net realizable value, selling price minus cost to complete the sale, or it's different for the inventories. What is the net realizable value?
It's the net realizable value is the less between the fair value less cost to sell and the
Fair
cost,
value
less cost to sell.
or selling price minus cost to sell for the inventories.
It's selling price less cost to sell. Yeah.
Yes, this is net realizable value. If you say fair value less cost to sell, this is also
Okay, this is
also not
the net
realizable.
realizable value. Okay.
Yes. So whenever I have something minus, let's say, cost to sell to complete the sale, it's gonna be net realizable value.
Okay.
We will cover inventories, by the way, in study unit 5, if I'm not mistaken. So now, I'm assuming that I have 0 impairment loss. Regarding the year of sale, do you have loss from operation? And by the way, pay attention to something that is super important. In the year of decision, you take the loss from operations or the gain from operations from beginning of the year till end of the year, the full year. the full year. But in the year of sale, you take the loss from operations from the beginning till the selling date, cutting date, selling date. If you make the decision in year 1 and sell it in year 1, you take it from beginning of the year till the year of sale. But if you make the decision in year 6 and you sell it in year 7, then year 6, the loss from operations is going to be for the full year. Year 7, you take it from beginning of the year until the selling date. Right here, did they give you the loss from operations from beginning of the year to the selling date or not? Did they give you, when did they sell it? They sold it, they said.
On January 15.
Yes. Did they give you the result from beginning of year 7 till January 15, year 7?
Actually, no. Actually, no.
Now, look at this.
It's
Look.
for... Okay, okay. I thought that we should take it pro rata as per dates.
No pro rata at all, unless they mention it.
Okay.
So they said Heart's operating losses are
50,000.
from January
From 1 to January 15 till the
is-
date of the sale.
Exactly, which is until the date of the sale. So that's absolutely correct. Accordingly, right here, what do I have to put in the cell?
650. 50 only.
50 only. It may only put the loss from operations of the year of sale only exclusively. It's not cumulative.
Okay.
This is like P&L. And
Okay.
did they mention the loss or gain on disposal of the component of the division?
Yeah, they mentioned. They
Yes.
mentioned that the 900,000 are gain on disposal.
Exactly. So right here I have 900,000. Well, it's too much. 900,000.
It
Okay, let us
was
adjust it. 900,000. Already. So now when I look at the following, they said something important. Usually the discontinued operations are presented net of tax or not net of tax.
I represented the discontinued, you mean, sir? Not
Always,
net of tax, I
yeah,
think.
always net of tax. Always net of tax. Always net of tax in the exam. But right here, they said in this specific MCQ, they want you to disregard the income taxes. But if they don't tell you to disregard the income taxes, how do we report the income from discontinued operations? Noor, how?
Sorry?
Net of tax. You see?
Okay, you mean in the it's presented as in the part of the continuing operations. We always know that we present before tax, then we present the income tax and then net profit or loss.
Okay.
Regarding that, discontinued operation is directly presented net of tax without presenting the tax
No,
amount.
it's the same. So you can put, for example, okay, loss from discontinued operations. You can put before the taxes, then minus the taxes, then you put the net. But it has to be reported net of taxes in all cases.
Okay.
Okay, it's the same. But usually in the exam, they don't go in such details. They just ask you loss from discontinued operations and they put a cell. So you have to put, for example, minus 198,000, enter. So you give the final answer and they don't tell you that this is with or without tax. You have to report the final loss from discontinued operations. It has to be net of tax.
Okay.
You
Makes
see?
sense.
So right here, they told me in that specific MCQ, disregard the tax expense. So this is good. Accordingly, in year 6, what is my total loss? Okay, I made a mistake. You see, I made a mistake because I reported losses as positive and I reported gain as positive. This is wrong. Gains and losses need to be reported in opposite signs. You can decide, for example, you want the gains as positive or negative?
The loss
You
is negative.
Okay, you can do it the way you want. Okay, for example, if you want to put right here gain as negative, then you keep the losses as positive. But usually we report the losses as negative and we report the gains as positive. So you see this little tiny mistake that I made? It's related to the signs. Be careful. Report losses as, for example, negative and gains as positive, but the important is opposite. So right here in year 6, because we do not have year 1 and year 2, we have year 6 and year 7. What is my final result for year 6? It's a loss of,
$600,000.
and for year 7,
Okay, 850.
yes. So I have minus 600 and 850. Right here, you see the correct answer, minus 600 and 850. And pay attention. Sometimes they put year 7, then year 6. Sometimes they put year 6 and year 7. They switch years. So read carefully. Right here, they put year 7, then year 6. And in my Excel, year 7 is $850. And year 6 is
minus 600
yes.
though.
So that's the correct answer. Option D. So as a recap, when I have income from discontinued operations, first thing you ask yourself, did I make the decision in year 1 and sold it in year 1? If yes, this is what Amir did in his MCQ. We have 3 components: operations, impairment loss, gain or loss on disposal. If you make a decision, for example, in year 6 and sell it in year 7, then right here you have 2 components: the loss from operations or gain from operations sometimes, and the impairment loss. And in year 7, the year of disposal, you have loss from operations and gain or loss on disposal. All right, pay attention to the loss from operations. It's from beginning till end of the year, the full year, the decision year. Right here, it's from the beginning until you sell it. Okay, and you know the impairment loss and the gain or loss on disposal. Now, Aimee, would you like to do this upcoming MCQ regarding the discontinued operation?
Yes.
Yalla, okay. So we have MCQ 7. Let's read.
Okay. On January 1, year 4, DART entered into an agreement to sell the assets and product line of its J division, which met the criteria for classification as an operating segment. The sale was consummated on December 31, year 4, and resulted in a gain on disposal of $400K. The division's operations resulted in loss before income tax of $225K in year 4 and $125K in year 3. For both years, DART's income tax rate is 30%, and the criteria for reporting a discontinued operation have been met. In a comparative statement of income for year 4 and year 3, under the caption Discontinued Operations, DART should report a gain or loss of...
Definitely, I'm lost. Okay,
Okay.
Again, I cannot read and understand immediately. I need to structure my MCQ. This is the same strategy. We have to use this strategy the day of the exam. So far, I will take a screenshot, okay? But which topic they are talking about right now? They are talking about which topic? The discontinued operations or not? It seems
Discontinued
so,
operation.
right? Because they said they entered into an agreement to sell the assets and product line of the division, okay, which met the criteria for classification as operating segment. So we are talking about discontinued operations. So discontinued operations, the first step, always ask yourself, when did I make the decision and when did I complete the sale, right?
Right.
So Amy, when did you make the decision? Look at this.
On year 4.
January 1, year 4, right?
January.
They said January 1, year 4, you entered into the agreement to sell. So it means that the decision was made on January 1, year 4. And then they said, when was the sale completed?
On December.
Exactly.
Year
The
4.
sale was completed on December 31, year 4. So isn't it within the same year I made the decision and I sold it?
Same year, yes.
Yes. And then they said resulted in a gain on disposal. Usually when we have a gain on disposal, right here, I made the decision in year 4 and I sold it in year 4. Remember, you have 3 components usually. You have the loss from operations because you made the decision and you sold it in the same year. Then you have
impairment loss.
Then you have
and loss or gain on disposal.
Exactly. So now it's not gonna be year 6 and year 7. It's gonna be only year
6.
Exactly. Year 4. Okay, so I will delete this. I will say year 4. And definitely right here we can merge.
And it can be the 3 of loss in 1 year.
Exactly, because you made the decision
Okay.
and you sold it.
Okay.
So خلاص, it's 1 year. I have one loss from operations. I know that my gain on disposal is right here. Your gain on disposal.
400.
Yes, pay attention to the sign because we learned from the MCQ of Noor that the sign is super important. And then they said the division's operations resulted in losses before income tax.
Before income tax.
But they give us year 3. Do we care about year 3?
No, no.
No,
We
it's
don't
only
care.
year 4.
We take only 225.
Okay, only 225. I will put it right here. You can put it in this cell or in this cell. Minus because it's the
Okay, it's a loss.
okay, and right here, remember, it's we can delete this line if you want. We can delete it. And then they said the income tax is
30%.
30%. Let us make a recap. Okay, loss from operations 225. They mentioned nothing about impairment, so I will put 0.
0.
Yes, they mentioned nothing. Right here, gain on disposal, all right. Now, if I make the sum, because everything occurred in 1 year, which is year 4, what is the final loss or gain on from discontinued operations in this case? It's gonna be this plus this plus this. Do I have a gain or a loss?
Gain. We have a
Gain
gain.
of 175. But pay attention. It has to be reported net of tax. The government takes
30%.
You keep
70%.
Yes. So I'm gonna keep 70% of this. I will keep
122.5.
yes.
Okay.
122.5K for which year? Year
4.
4. Exactly. Now let us think about it. There is a trick, and I did not explain that idea to you. If you read carefully, the call of the question is, they said, in a comparative statement of income under the discontinued operations. Now, you know, under the discontinued operations, you're gonna report for year 3 how much? 122.5K, right? But year 3, we said they did not make the decision in year 3. Am I correct, Eme?
Yes.
Okay, but listen carefully.
The decision was made in year 4.
Yes. So a lot of candidates right here put 0. But it's not 0 for a reason. I will explain it to you. When they say comparative statement of income regarding the discontinued operations, then even if you did not make the decision in year 3, you have to report the loss from operations net of tax of year 3. Why? Because the statement of income that you are presenting are comparative. This is exceptional. For
Just one
comparative.
question. Even if it's comparative, the conditions in year 3 was different.
Yes, but now remember, it's like if you are doing a retro adjustment, Noor. It's like if you are doing a retro. Since year 4, you made the decision to classify it as held for sale and you made the sale. Okay, we have loss from discontinued operations or gain, which is right here, it's a gain. Then because it's comparative statement of income, you have to report the operations of that segment in year 3 separately.
What if the decision was taken in year 4 before the reporting? Let's say you are reporting year 3, okay? And the decision was made in year 4 before the reporting period. Should we restate the income statement as continued and discontinued?
Right here, yes. In a comparative, you have to present retro effect, like retro adjustment for year 3. And you have to show this loss from operations related to the segment from year 3 as discontinued. Yes, you do this retro adjustment.
Makes sense.
Okay, this is a new idea. We learned it now from the MCQ. So right here, exceptionally, this 125,000 in year 3, aren't you gonna report it in the comparative statement of income? Aren't you gonna report it? Comparative, it means I'm presenting figures, this figure versus this figure.
Okay, I got this one. Okay.
Yes. So now you say this is the income statement of year 3, this is the income statement of year 4. For year 4, I know we said it's 122.5K. It's a gain. Okay, gain from discontinued operations or on discontinued operations. Now, exceptionally, year 3, we did not make the decision. We
So
made
it's
the
a zero?
decision year 4 and sold it. But exceptionally, because it's comparative, then you have to show this under
The
discontinued.
caption discontinued.
Yes. Again, net of tax. Remember, the government's share is 30%. So your
30%.
share is 70%.
70%.
The government share is 30%. Remember, discontinued operations always net of tax, unless they tell you disregard the income tax. So right here, 125K times 70%, it's 87.5 maybe, right? We can take the calculator and verify the calculation. 125 times 0, sorry, I did a mistake.
125.
How much?
125.
125, yes. Yeah, I made a mistake. It's 80. Clear.
As clear.
Yes. 87.5, right?
87.
Exactly. But
Okay.
it's a loss. So we will report it as negative or positive figure?
Negative.
Exactly. So here I will report minus 87,500. And for year 4, we're going to report plus
122.5 gain.
Yes, it's a gain. Now, if I come back to my MCQ, you see the options right here. Year 4, as we said, it's a gain on discontinued operations. Year 3, it's a loss. And you see the trick right here. You have year 3, 0, because a lot of candidates will report 0 since they say we did not make a decision in year 3. So I will report 0. But here, exceptionally, because it's comparative income statement, then I have to show and make a retro adjustment to show the result from operations for year 3. How is it?
Okay.
Make sense.
Good.
Okay.
Yes.
What about the others? All is clear? All righty. Yeah. So again, now I'm gonna interpret it again just to make sure that I understood the full picture. I can look at this income statement. Okay, income statement, you see right here, net income. Okay, that's fine, net income. But you see two categories, income from continuing operations. As I said before, when you see continuing right here, the word continuing, it's an indicator that you have discontinued operations. And look at this, we have loss from discontinued operations. And this is our net income. If you compare this to the Excel, it's the same. Why? Because in the Excel, we said, look at the net income presentation. It has two components, income from continuing operations and income from discontinued operations. By the way, if I'm studying on my own and I want to elaborate further, I can take those lines. I can say Control C, and right here, I can put Control V. If I do not have discontinued operations, if this line is not there, okay, if this line is not there, let me delete it. Then right here, what will change? What will change? Will I say income from continuing operations, or I will say income from operations in this case? We will omit the word. I will only say income from operations because you do not have discontinued operations in this case. So you see how you can also adjust the notes and make them look better? Because if there is no discontinued operation, you will not call it income from continuing operations. You will call it income from operations. You see right here, we have continuing because there is a discontinued. But above, if I scroll up, right here, what did we say? What did we say, Ime? Income from operations.
Operations.
Yes.
And we don't have discontinuing.
Exactly. Okay. So pay attention. They love to test those little tiny details again in the CPA exam. So we can see. And right here, if you look at the discontinued operations, you presented, for example, loss than the income tax benefit. We say income tax benefit if I have a loss. We say income tax expense if I have a gain. So it all depends. The word benefit is used with losses. The word expense is used with gains. And that's the loss from discontinued operations. My net income, we can verify the result. This and this, it will give me 60,000. And by the way, the EPS right here, the earnings per share, they are presenting the EPS from continuing and discontinued separately. And then they are presenting it in full, the net earnings, okay, the EPS. Make sense? All righty. Any question before we continue? Okay. Now, we start with the comprehensive income. So remember, comprehensive income and other comprehensive income are not the same. These are two different concepts. The comprehensive income is equal to your net income, which we have just covered, the P&L, the final loss from continuing operations, or profit from continuing operations and loss from discontinued operations, or gain from discontinued operations. So this is my net income plus the OCI. OCI, it's a balance sheet equity account. We only find it on the balance sheet. And a few minutes ago, when we started with this lecture, Noor mentioned the puffier. Okay, puffier, by the way, that's an abbreviation to show what is included in the OCI. What is included in the OCI is the puffier or puffy ER. But pay attention, we are preparing for the CPA exam. And for the CPA exam, we use the US GAAP, not the IFRS. There are small differences nowadays between US GAAP and IFRS, not like in the past. In the past, there were a lot of differences. But this R is still a difference between US GAAP and IFRS. Why? Because US GAAP, they don't make a re-evaluation of the assets. So I don't have this re-evaluation surplus right here in the CPA exam. Because the re-evaluation surplus, it's only under IFRS. So you forget about it for the CPA. The CPA, you only have the puffy E. So when I say P, pension adjustments, we're going to talk about these in the upcoming lectures, by the way. So pension adjustments, you unrealized gains and losses on available for sale debt securities, debt, only the debt. We covered this in study unit for, okay, the unrealized gains and losses on available for sale debt security. But pay attention to something. If the day of the exam, now you are memorizing in study unit 4, you will understand it. If they say in the exam, we have unrealized holding gain and loss on available for sale equity security, it does not go to the OCI. If it's an unrealized holding gain or loss on available for sale equity security, it goes to the income statement. It does not go to the OCI. Right here, the U in the OCI, it's only unrealized gains or losses on available for sale debt securities. Today, you will memorize it. Study unit 4, you will understand it. Okay? F, it's the foreign currency translation. We study the foreign currency translation in the upcoming studying units. It's super important, that topic, the foreign currency, translation and transaction. And pay attention, I still remember that MCQ from my exam. In my exam, they said, which element is not included in the OCI? And they gave me options. They said, for example, pension adjustments. I know it's included, it's the P. Then said, unrealized gains and losses on available for sale debt security. I said, okay, I know it's included. Then they said, number 3, foreign currency translation. And 4, they said foreign currency transaction. So you need to be careful. The one that goes to the OCI is the foreign currency translation. It's not the transaction. Because the foreign currency transaction, this one, it goes to the income statement. I will explain those in another chapter. I think it's study unit 2 and study unit 13. Okay, but pay attention. The one in the OCI is the foreign currency translation, tarjama. It's not the transaction. Okay? This is important. And the I is the instrument-specific credit risk. I explained the instrument-specific credit risk in study unit 4 with an example with numbers. So you will understand it perfectly. Okay, but we will see it later on. Today, it's just an intro session. And E, that's the effective cash flow hedge. We study the effective cash flow hedge derivatives. Okay, it's also another chapter. Now, at this level, you memorize it like a parrot now. In the upcoming lectures, you will start understanding those elements. But when I say OCI, the balance sheet equity, it's an account that is not yet ready to be incorporated in the income statement, not yet ready to go to the income statement. And by the way, it's beyond the control of the management. What is within the control of the management, usually it's going to be in the income statement. But beyond the control of the management, it's going to be reported in the OCI. So OCI, it's like a student who is not prepared for his CPA exam. Can he go to the income statement to the exam? No. Sit in the OCI. Sit and wait. Sit and wait until you become very well prepared so that you can take the exam. It's like parking somewhere. And the auditors definitely, they pay attention to the OCI account because sometimes the management, they use the OCI just to hide things. If they don't want to reflect it in the P&L, they will put it in the OCI for not to have an impact on their P&L. That's why this account, it has to be very well examined. Make sense so far? So let's memorize. What are the elements of the OCI? The puffier. Okay, R, it's only under IFRS, only. P, pension adjustments. You don't have to dive into the details. U, unrealized gains and losses on available for sale debt securities only. It's not the equity. Equity, it goes to the P&L, to the income statement. F, foreign currency translation, not transaction. I, instrument-specific credit risk. We will study it separately. E, effective cash flow hedge. Okay, R, as I said, it's only under IFRS, not explained in the CPA curriculum. And the OCI, it's also presented net of tax in the balance sheet in the equity section. It has to be net of tax, just like the income from continuing operations and just like income from discontinued operations. Also, the OCI is reported net of tax. And again, on the balance sheet, we're gonna see, let me show you again, we see accumulated OCI. Accumulated OCI, it means OCI of this year plus OCI of last year plus OCI of the previous years. This is the meaning of accumulated OCI. So right here, they give you a presentation, reporting. Okay, you look at the reporting. Same as we saw before. Remember, I'm not talking exclusively about the OCI. Now I'm talking about comprehensive income. Comprehensive income, Amir, what is the formula of the comprehensive income? It's equal to?
Net income plus other comprehensive income.
Exactly. It's the net income plus other comprehensive income. So if you are using the single statement presentation, you're gonna start with the
Statement of income, which has net income, and then
and by the way, do you see details? Do you see breakdown like net revenues? Yes, we see revenues and gains, tatatu, expenses and losses, income from continuing operations, income tax expense, and net income. By the way, here they use the word continuing, and I don't see any discontinued operation. Okay, I prefer not to use the word continuing, but if you are using it, it's still okay. All right, but as we said before, usually we use it if we have discontinued operations. So the R breakdowns. What about the OCI? Is it broken down?
Yes.
Yes. So what is the first element? And by the way, net of tax. What is the first element?
First element is net of tax, OCI.
Yeah, OCI. But what is the first element in the OCI itself?
Foreign currency translation adjustments.
Did they say transaction or translation?
Translation. So
Translation. If they said transaction, does it go to the OCI?
no.
No. And then?
And then unrealized holding gains.
Yes.
And
minus
reclassification of gains from AOCI.
Yes. By the way, unrealized holding gains, if it's available for sale security, is it gonna be debt or equity?
If it's available for sale.
Yeah, it's gonna be
Not
debt.
sure.
Only debt. Remember, what did I say about this U? I said it's only unrealized gains and losses on
available for sale debt securities.
Yes. By the way, let me give you just a small, smooth example to understand this available for sale debt security. Okay, I know it's not our topic for today because we will cover it, let's say, in study unit 4, but I will give you just a quick understanding. Usually, when we say investments, you can invest in what? You can invest in commodities like gold, crude oil, livestock, mawashi, whatsoever. You can invest in cryptocurrency. You can invest in private equity and startup companies. You can invest in stocks. You can invest in bonds, right? Amir, am I correct?
Yes.
Okay, so we have these types of investments so far. But now when I think about stocks by nature, are these equity or debt? The stock, the shares?
Equity.
Equity. But when I say bond, it's a debt instrument or equity instrument?
Debt instrument.
Yes, it's a debt instrument. Now, let me ask you another question. You might laugh at my question, but it makes sense. Have you ever seen A 5 years stock, 5 years share, 10 years shares, 100 years shares?
No.
No. So does the equity instrument have maturity?
No.
No. In general, there is no maturity for the equity instruments. Have you ever seen 5 years bond, 10 years bond, 6 years bond or not?
Yes.
Yes, the bonds, they always have,
A date of maturity.
exactly, they always have maturity. So now, when I say I buy stocks and bonds and I trade, so buy, sell, buy, sell, buy, sell, buy, sell, buy, sell. This is trading security available for sale or held to maturity? I buy, I sell, I buy, I sell, I buy, I sell, I make gains, I make losses, I buy, I sell again, trading. So what do we call my investment? Trading
sale.
security.
Trading security.
If you are selling and trading with stocks and shares, you say this is trading equity securities. If you are trading with bonds, buying and selling bonds, buying and selling bonds, allo buy and sell, buy and sell, buy and sell, you say I have an investment in trading debt securities. Yes. By the way, held to maturity. Can it be held to maturity equity securities, or we can never have held to maturity equity securities?
You can never have held to maturity.
You can never have held to maturity equity security. Never. Because the equity do not have a maturity. The held to maturity investments are only investments in
debt securities.
debt, only investment in debt securities, the held to maturity. So I only invest in bonds, for example. And when we say held to maturity, it means you have the intent and the ability to hold it until maturity. So if it's a 5 years bond, you have the intent and the ability to hold it for
until the maturity.
5. Yes. Available for sale, this is like the category in the middle. I don't want to hold it until maturity if it's a bond, for example, or any debt instrument. And I don't want to trade, buy and sell, buy and sell. Maybe I don't know what to do with. I put it as, or I classify it as available
for sale.
For sale. Now, if it's stocks, you say I have an investment in available for sale equity securities. If you have a bond, you don't have the intent and the ability to hold it until maturity, but also you don't want to trade with, you say I have an investment as available for sale debt
security.
Which one goes to the OCI? The change in fair value. When I say unrealized gains and losses, it's the change in fair value. We're gonna see this in study unit 4. But this is the unrealized holding gains and losses related to which type of securities? Only
debt security.
Exactly. It's only the available for sale debt security. And by the way, pay attention to something, because what I'm saying is easy, but if you try to read it on your own, it's not that easy. Regarding bonds, you have two different perspectives. You have the investor and you have the issuer. You remember that example when I said Coca-Cola is issuing Tesla is issuing bonds? Yes, Tesla. Tesla will record a liability, correct or not?
Yes.
Tesla records a liability. So for Tesla, it does not have an investment and it does not have an asset. Okay, for Tesla, this is a liability. This is bonds payable. For Tesla, it debits cash and credit bonds payable. But for the investor, imagine, Amir, that you invested in Tesla. Okay? Okay, Amir?
Yeah.
If you are investing in Tesla, will you receive cash or you will pay cash?
You'll pay cash.
Yes, you will pay cash. So what will you credit?
Credit cash and debit bond receivable.
La, here that's the difference. I credit cash, that's correct. But remember, you are the investor. You are the investor, so you have an asset. What do you call it? Investment in Tesla bonds. This is an investment in Tesla bonds. And by the way, your investment in Tesla bonds, you can say 3 categories: trading security or available for sale or
Held to maturity.
held to maturity. Amir, if you have the intent and the ability to hold it until maturity, how will you classify that investment in Tesla bonds?
Held to maturity.
Bravo. If you want to trade with the Tesla bonds, allo, buy and sell, buy and sell, buy and sell.
Trading securities.
You classify it as trading security. If you don't know what to do with, you're not gonna trade, but you don't have the intent and the ability to hold it until maturity. The category in the middle,
Available
Equity.
for-
available for sale. Noor, Tesla bond, equity versus debt. Look at
But you mean fair value reported
A.
gain? Wait a minute. It's financial instruments, okay? So reported at amortized cost, fair value, through profit or loss or other comprehensive income.
Yeah, wait a little bit. This is gonna be covered in study unit 4. Okay, I will explain to you the amortized cost and the fair value, etc., in study unit 4. But now I'm just giving you an intro.
Okay.
Usually, when I say you can invest in commodities like gold, gold, livestock, crude oil, etc. Okay, silver, whatsoever. You can invest in cryptocurrency. You can invest in private equity. You can invest in mortgage. I don't know. You can invest in, for example, stocks, and you can invest in bonds, right?
Mm.
Okay, if you are investing in stock by itself, shares, is this equity instrument or debt?
It's equity instrument for
It's
sure.
equity. If I tell you bonds by itself, it's a debt instrument or equity
It's
instrument?
that instrument.
Okay. Have you ever seen 5-year stock, 10-year stock, 20-year stock, or never?
Didn't understand the
Have you,
question.
when you, يعني if you have shares in the company, do you see, for
Okay.
example, $10 par value,
Yes.
5 years?
No, not we
Never.
don't see the.
Never. Equity
Okay.
instruments, do they have maturity or they do not have a maturity?
They don't have maturity
They
date.
don't have maturity. Tesla bonds, 5 years bond, 10 years bond, 100 years bond.
Yes, for sure. They have maturity date.
So when you invest in Tesla bonds, bond by itself, it's a debt instrument. Can it be equity?
No.
Never. Never. It can be trading debt security, investment in trading debt security. It can be investment in available for sale debt. It can be investment in HTM. But can you have this investment in that bond as equity? No, because bond, it's a debt instrument. It has a maturity. Equity, they
It's
do not have a
liability
maturity.
considered as liability.
Yes, it's like a liability for the issuer. And this
Yes.
is what we said. We said for Tesla, they record this bond as bonds payable as a liability. But if you invested in Tesla bond, you are the investor. So you will
Assets.
classify it as investment in Tesla bond. This investment in Tesla bond, it can be trading or available for sale debt security or HTM debt security. It depends. If you want to trade with buy and sell Tesla bonds all the time,
Speculation. Okay.
trading. If you
Okay.
have the intent and the ability to hold it until maturity,
Okay. Available for sale.
if you have the intent and the ability to hold it until maturity, it will be,
HTM.
yes. If you don't know what to do with it, it's not for trading. And
Okay.
I
It's
don't have
available for sale.
Yes,
Okay.
yes, the middle. Exactly. This is how you classify your investment. And by the way, in study unit 4, we covered this, but the change in fair value, if it's available for sale debt security, the change in fair value, it's gonna result in unrealized holding gains and losses, and that will be reported in the,
Other comprehensive income.
exactly. Make sense?
Makes sense. Yeah.
Did you see the difference in the perspective?
Actually, I understood why it's called trading securities available for sale. The reason behind
Exactly.
the name.
Yes. And can you have, for example, available for sale equity security investment in Tesla bonds? Can you have available for sale equity? Can I have available for sale equity?
No, since
Since
no.
Tesla bonds, it's a debt instrument, and debt instruments, do they have maturity?
The bonds have maturity, but the
Yes.
equity, لا ما عندهم.
Exactly. So it cannot, that investment in Tesla bonds can never be classified as available for sale equity or trading equity. Make sense? All right. So again, when I make a recap, let me now ask Amy. Amy, what are the elements included in the OCI? What are the elements included in the OCI? What did we say about the abbreviation? Puffy ER. Okay. Zainab, P. What does it mean, the P? Pension? Pension, adjustments. Okay, Zainab, P, that's the pension adjustment. What did we say about the U?
Okay.
U, unrealized.
Unrealized holding gain
Yes.
and
And losses on what? On which type of investments?
available
Only
for sale debit.
debt. Exactly. Only
Available for
equity.
sale.
So when I tell you available for sale equity securities, is it gonna be included in the OCI or the income statement for the equity securities? Investment equity security. Equity securities, it will be in the income statement, never in the OCI. Okay, it's only the unrealized gains and losses on available for sale debt securities. The F, what does it mean? Foreign currency. Foreign currency, what, Zainab?
Translation adjustment
Yes.
for a foreign operation.
Just foreign currency translation, that's enough. If I tell you foreign currency transaction, foreign
Not
currency,
correct.
yes, not OCI, transaction, it will be in the income statement. We will study it later on. The I, instrument specific credit risk, we covered in study unit 4, and E, that's the effective cash flow hedge. Do we report the OCI net of tax, Zainab, or not? Is it net of tax or not net of tax? The OCI.
Net of tax.
Exactly. It has to be presented net of tax. Is the OCI income statement or balance sheet account? OCI, it's always
Balance sheet.
yes. Assets, equities, or liabilities?
Equity.
Equity. Okay. So you see, this is the single statement that we were presenting. And right here, we have the presentation. Amir started with this one. Now, Abdurrahman, you're going to continue. Abdurrahman, look at this comprehensive income. So we said we start with the statement of income. Do we put the details or not?
In
You
the
see?
statement, yes.
Yes, we put the details, revenues and gains, etc., etc. Then we, at the end, we put the net income. Now, what about the OCI? Do we present the details?
Yes, we present them.
Yes. Okay, so let's look at the following. I'm gonna write PUF here, and then you will tell me which one is this. Foreign currency translation adjustments.
Okay, it's the F.
F, that's the foreign currency translation. And now I say unrealized holding gains. It seems they are talking about what?
Available for sale debt security.
Yes. So this unrealized holding gain, it's which letter in the PUF here?
It's the U.
Exactly, it's the U, the unrealized holding gains. And by the way, there is a reclassification. You know why there is a reclassification? We study this in study unit 4. Because you see, gain on sale. If you sell available for sale, there will be an amount that will be moved from the OCI to the income statement. Okay, we studied the details in study unit 4. Don't worry about it. But when you see minus reclassification, it's because you sold some available for sale debt securities. And usually when you sell available for sale debt securities, you have to close the OCI because now it's finalized. I told you OCI is the guy who's not prepared for the CPA. So OCI is the guy who's not prepared to go to the income statement. Now, since it's sold, it will go to the income statement. And that's why you have this reclassification. So what is the net amount reported in the OCI? 14 minus 14, it will be?
26.
Yes. And right here, they said loss on hedging instrument designated as cash flow hedge. This is which letter?
That's the E.
E, effective cash flow hedge. We studied this later on. So it's a loss, they reported as a negative figure, and that's the total OCI. OCI, this 25, is it net of tax or not net of tax?
Net of tax.
Net of tax, always net of tax. And you have finally the comprehensive income. Comprehensive income, what is your net income?
$110.
Yes. And what is your OCI?
25.
110 and 25.
135.
Exactly. And by the way, this is the single step. If they tell you the comprehensive income is used presenting two-statement presentation, refer to what is in green. If they are using the two-statement approach, they will report what is in green. So do they give the breakdown of the net income, or just they start with the total net income? That's it.
Total net income.
Yes. Single statement, you give the breakdown of the net income and you give the breakdown of the OCI. But the two statement, you start with, look at the green. So you start with what?
With the net income.
Total net income and breakdown of the
OCI.
Yes. So right here, the full approach is single statement. What is in green is the two statement. And right here, I said refer to what is highlighted in green.
Yeah.
Everything is clear to all? Okay, did you understand it? So we said accumulated OCI, as we said before, it's the cumulative OCI through the years. So it's the OCI account that we used in year 2025, plus the OCI that we used in year 2022, plus the OCI that we used in year 2023, 2022, 2021, etc., etc., etc. It's the cumulative. It's like retained earnings, but for the OCI accounts. Who has a question as when it comes to that part? All is good, right? Yeah, perfect. So statement of changes in equity. I'm a little bit lost because so far we covered a lot of information. So I'm going to go back to the first page. If I go back to the first page, right here we had the full set of financial statements. Financial position, balance sheet, we saw it together. But definitely we will dive into the details in the upcoming study units. Then we covered the P&L, 3 different presentations. Then we talked a little bit about the OCI and we presented the comprehensive income. Remember, balance sheet, financial position, comprehensive income, that's the second full set of financial statements. The third one is the statement of changes in owner's equity or stockholders' equity. This is not heavily tested, okay, but I'm gonna give you an idea about it. If you look at page 16, they give you the changes, beginning balances and ending balances. So they say treasury stock. We started with minus 20 and we repurchased additional common stock. So we ended with 35. Right here, it's study unit 12. We see it in study unit 12 and we understand it perfectly. Additional paid in capital common stock, also study unit 12. And you see it also in consolidation. And as I said before, additional paid in capital is known as share premium under IFRS. Accumulated OCI, we saw it today, but we will see it in more details in study unit 4 mainly, because we focus a lot on the accumulated OCI in study unit 4. All right, retained earnings, we see it in study unit 12, but I will give you the relationship between the beginning retained earnings and ending retained earnings today. Okay, we're gonna take an idea about it. We will apply it in more details in study unit 12. Usually, what is the relationship, Eme, between beginning retained earnings and ending retained earnings? Let me ask you some questions. So if in the company you have a profit, where do you close that profit end of the year? You close it against what? The profit. If you have a profit, you close it against Noor. Where do you close the profit?
Sorry.
If you have a profit in the company, where do you
Yes.
close that profit end of the year?
To the retained earnings.
Exactly. You close it against the retained earnings.
Okay.
So if I have a profit, what will happen to my retained earnings? It will go
It
up
will
or down?
increase.
Yes. So right here I start
The
with
credit
beginning.
side for sure.
Yes. Plus net income minus net losses. If you have a losses, it will decrease your retained earnings. If you have a profit, it will increase your retained earnings. Then the dividend, the declaration, do they increase or the
Decrease.
Yes. So minus dividends declared. By the way, they need not to be paid, not necessarily paid. Declaration enough reduces the retained earnings, because upon declaration, what is the journal entry that you do when you declare?
Okay, so retained earnings for debit side.
Exactly. And credit.
Dividend payable.
Bravo. So this is the journal entry. That's why we say minus, because you're debiting the retained earnings. And that's why your retained earnings is going down. And by the way, with the error adjustments, we're gonna learn that the error adjustments, they affect the retained earnings. It can be a plus or minus. Retained earnings adjustments, they, by the way, if you have an error and you are adjusting, it will have an impact on your retained earnings. We're gonna study this, and it's heavily tested the day of the exam, the adjustments. They love adjustments. And also treasury stock transactions. Sometimes the treasury stock transactions, which we will cover in study unit 12, they affect what? They affect
Treasury stocks.
they affect the retained earnings. We're gonna see in study unit 12 that the treasury stock transactions, sometimes they have an impact on the retained earnings. So if I want to take a look at the relationship between my beginning and ending retained earnings, what is the final relationship between beginning and ending retained earnings? What do we say? Beginning plus
Okay,
net income
mine is the dividend declared and then the adjustments of the treasury stocks.
لا, adjustments of the errors and the treasury stock transactions. They can two elements right here. Plus or minus error adjustments. We're gonna see this in the upcoming study units. And the treasury stock transactions, they can also affect the retained earnings. Let me show you something, okay? You should not study it today, but I'm gonna give you an idea about the treasury stock, just to let you see how it can affect your retained earnings, okay? It's not our topic for today. I repeat, this is another topic. Remember, today it's like an intro session, but I'm gonna show you the Excel related to the equity. This is treasury stock. Okay, we're gonna learn about the treasury stock and about the journal entries, etc., etc. But right here, you see in this transaction, for example, Noor, what are we debiting?
We are debiting the retained
Retained.
earnings.
Exactly, we're debiting the retained earnings because sometimes when you do the treasury stock entries, it will have an impact on your retained earnings. And also for the error adjustments, which we will study later on, we will see that for the error adjustments also, they can affect your retained earnings.
Retained earnings,
I think
yes.
it's study unit 3, if I'm not mistaken. But if I want to summarize beginning retained earnings and ending retained earnings, definitely if I have a profit, it will increase. If I have a loss end of the year, it will decrease. Dividend declaration, it will decrease. If I have error adjustments, it can be increased to the retained earnings or decreased to the retained earnings. We will see. And if we have treasury stock transaction study unit 12, it will also have an impact on my retained earnings. And that's how we obtain the ending retained earnings. And as you can see, they tell you the error adjustments, we will cover it in study unit 3. The treasury stock, we cover it in study unit 12. Also, the appropriated retained earnings, we study it in study unit 12. But let me tell you something about appropriated retained earnings. Appropriated retained earnings, it means restricted retained earnings. Some companies, they have retained earnings. By the way, retained earnings, it's like accumulated profits and losses in simple words, but there are other elements like dividends, adjustments, treasury stock, etc. If they have, for example, accumulated profit of $1 million, they can say, we will restrict 800,000, we will not use it. It's appropriated just to acquire a new subsidiary. So they are setting aside out of those accumulated profits 800K to purchase a new subsidiary. We call that this is appropriated or restricted retained earnings. And the remaining 200K, we can do whatever we want. We will distribute dividends, etc., etc. So when we see appropriated retained earnings, it means restricted retained earnings. And I'm going to show you, this is the Excel related to study unit 12. It's not our topic for today. Okay, but I'm just showing you, I explained the difference between authorized, issued, and outstanding shares. I explained to you about the dividends distributions. You see, this is related to the retained earnings appropriations. But it's not our topic for today, so I will not explain it. All right, make sense?
Makes sense, yes.
And finally, there is something called the special purpose frameworks. When we say special purpose frameworks, there is another designations related to it. It's the OCOBOA. When I say OCOBOA, it's other comprehensive basis of accounting. And I will explain to you a lot about the OCOBOA and the special purpose frameworks. Why? It's important somehow. Usually when I'm making this accounting, for example, matching principle, I record the revenue, I record the cost of goods sold, we say prepaid, then we record the insurance expense, matching principle. Is this cash basis or accrual basis of accounting? What am I using? Abdurrahman, Zainab, Eme, Amir. What are we using when we say debit, for example, prepaid, then credit cash, then record insurance expense prepaid, insurance expense prepaid, or record
Accrual
revenue,
basis.
record cost of goods sold? Accrual basis, right? So this is accrual basis. But there are some other bases of accounting. The other basis of accounting other than accrual, what do we call them? We call them special purpose frameworks. We call them OCOBO, other comprehensive basis of accounting. You can have cash basis, modified cash basis, regulatory basis. There are a lot of other things. For example, in the US, there are a lot of farmers who use the cash basis. And you know how the cash basis works? It's not like accrual basis. Let me give you an example. Okay? So, Amy, let's say you sell an iPhone to someone and he does not pay. He will say, I will pay you after 6 months. You agree with him on the deal. So when you sell that iPhone, what do you debit, cash or accounts receivable from the client?
can you please repeat لأنه ما عم تقطش الكونكشن عندي. Okay.
All right, no problem. So we have a client. That client decides to purchase an iPhone. You told him it's $1,000, but he said, okay, I will take it today. I will take the iPhone from the shop, but I will pay you after 6 months. And you say it's absolutely fine. So are you gonna debit cash or AR, accounts receivable?
Accounts receivable. It's not cash. He didn't pay yet.
Because he will pay after 6 months. Exactly, that's correct. He will pay after 6 months, but he took the mobile. So can you recognize a sales revenue right here?
No, it's يعني
you can.
It's
Why? Because you delivered the goods. Hey, you delivered the goods, right? It's with him now.
Yes.
So you can recognize a sales revenue of 1,000 because he took possession of the mobile. Now, after 6 months, as agreed upon, he comes and pay you the 1,000. When he pays you the 1,000, what do you do? What do you debit? What do you credit?
Receivable. Okay, credit accounts
Exactly.
receivable.
I close the receivable.
And debit cash.
And you debit, what did you receive? Bravo. So this is what I do when I receive the money from that guy. Now, imagine this is a farmer, and the farmer is using the cash basis. So when you deliver the crop, let's say, you do not record anything because it's cash basis. When cash is received, you make an entry. When cash is paid, you make an entry. At this level right here, they make nothing. When the guy comes and pay after 6 months, the farmer, what does he do if he's using the cash basis? Debit, cash, and credit, sales, revenue. This is not commonly used, cash basis. Cash basis, يعني it means the accounting, it's not like the regular accounting, the accrual that we know. It's not GAAP, it's not IFRS. Cash basis is specific. So they say, I receive cash, I debit cash, I recognize revenue. That's it.
Okay.
You see the difference, guys, between the accrual basis and the cash basis? Okay, let me give you another example. So you have a prepaid insurance of $12,000. It's related to the full year, to the whole year. Okay. When you pay it, do you record under the accrual basis, under GAAP, under IFRS? Do you debit, for example, insurance expense 12,000, or you debit prepaid? Matching principle. What do?
It's for 12 months.
Yes, okay, it's for 12 months. Yes. You credit the cash because the cash is out, the cash is decreasing in the credit side.
I have paid before the insurance.
Exactly. You paid for the full year. Okay, but January 2, you paid for it. Okay. On a monthly basis, what do you record on a monthly basis?
Okay, each month I debit prepaid, credit, prepaid.
Yes.
Okay, each يعني credit January, credit February.
Exactly. For which value? 1,000. Now, if you are a farmer, for example, using the cash basis, it's all about the cash. How much cash did you pay?
It will be only insurance expense and cash.
Bravo. Cash basis.
There's no prepaid.
Exactly. That's absolutely correct. Bravo. For the farmers, if they are using, for example, cash basis, they will debit insurance expense 12,000 and credit cash 12,000. It's like if they are making a cash flow immediately. Cash basis, it's like cash flow. Cash in, I recorded. Cash out, I recorded. That's it. Do they apply matching principle, accrual basis, etc., or no? No. This cash basis, what do we call it?
Special purpose framework.
Yes. Also known
Other comprehensive.
Yes,
Can you
basis
repeat
of.
the abbreviation of the OCBOA?
Yes, it's other comprehensive basis of accounting. Okay, it's the other comprehensive basis of accounting. There is an Excel related to it. I will open it and I will share it with you. Definitely after the session, I'm gonna share all of the Excels with you. It's called special purpose frameworks. Okay, so you can see it's called right here OCBOA. And I will add, if you want the abbreviation, other comprehensive basis of accounting. We have, for example, cash basis, we have modified basis, we have income tax basis, and there are regulatory basis and other basis. By the way, they use fancy names for the balance sheet and the income statement. The balance sheet, Zainab, for the cash basis, for example, if a farmer is using the cash basis, what do they call the balance sheet? They call it, what do they call it? Statement of cash and equity. And the P&L, the income statement, they call it statement of cash receipts and disbursements, payments, that fancy names. For example, modified, they call the balance sheet statements of assets and liabilities, or they call it statements of assets and liabilities arising from cash transactions. And the income statement, by the way, they call it statement of revenues and expenses and retained earnings, or they call it statement of revenues collected and expenses paid. Fancy names. The income tax basis, you do not study the income tax basis and the modified cash basis, but I'm telling you about the balance sheet and the income statement and the fancy names they use. The income tax basis, the balance sheet is known as statement of assets and liabilities and equity. Sometimes they call it balance sheet parentheses income tax basis. The P&L, they call it statement of revenues and expenses and the retained earnings. Sometimes they call it statement of income, into brackets, they put income tax basis. But usually with the OCBOA, the other comprehensive basis of accounting, the special purpose frameworks, we don't use the word balance sheet and we do not use the word income statement. Instead, we select fancy names. Make sense? What do you think? All is good? All right. By the way, it is not covered in details, but cash basis, I will cover it in details. So right here, they give you an idea about the modified cash basis. They give you an idea about income tax basis. By the way, in regulation, we're gonna study that the tax depreciation is called MACRS, Modified Accelerated Cost Recovery System. You see this in regulation, okay? The regulation part, not in financial accounting and reporting. But after the lunch break, I'm gonna dive into the details of the cash basis, because cash basis, they can test it. Why? Because cash basis is similar to preparing a cash flow. So that's very similar. All right, so we're done with study unit 1, but definitely after the lunch break, as I said, I'm gonna dive into the details of this formula. Okay, I will explain to you this formula. I'm gonna have multiple choice questions solved together. And this is also, by the way, when I explain cash basis, it's a preparation for the statement of cash flow, which we cover in study unit 14. But if you understand the cash basis and the formula and the way it's done, you will not face problems with the statement of cash flow in study unit 14, because there are a lot of similarities, especially when it comes to the operating section, because right here I'm focusing on the operating section of the statement of cash flow. So after the lunch break, we're gonna make a recap regarding that part, and we will start with study unit 2. Study unit 2, it's super interesting. We talk about the foreign currency transaction. So I will elaborate further and I will remind you of the OCI. We will talk about the EPS in deep details. By the way, the EPS, sometimes it's a simulation the day of the exam, sometimes it's only one MCQ, and definitely the revenue recognition. We'll study the revenue recognition with customers and also for overtime for the construction projects, like the percentage of completion and other things. A lot of interesting topics in study unit 1 and study unit 2, and we will practice simultaneously multiple choice questions. And as of next week, we will start also with the simulations. Today, it's just MCQs to get used to the rhythm. So what we did prior to the lunch break was covering study unit 1. Study unit 1, it was about the financial statements. We talked about the balance sheet, the statement of income, comprehensive income statement of changes in equity, and special purpose frameworks. But for the special purpose frameworks, we did not practice anything, okay? Let me do something. We will make a recap, okay, just to make sure that everything is clear. Regarding the balance sheet, we said the other name is the statement of financial position. So in case they ask us about the full set of financial statements, we have 4 sets of financial statements. We have the balance sheet or the statement of financial position. We have the comprehensive income. And remember, we said comprehensive income, it's equal to net income plus OCI. We said we have the statement of changes and stockholders' equity or owner's equity, and we have the cash flows. Definitely cash flows, it's going to be covered in study unit 14. And we also explained that the notes to the financial statements, this is supplementary, further explanation, further information on the face of the financial statement. So that was presented. Then we said the balance sheet, the equation is assets equals liabilities plus equity. And right here, you know, we classify the assets as first, it's like a T account. To the right side, we have the liabilities and the equity. And to the left side, we have the assets. Assets, we start with current and non-current assets. As when it comes to the current assets, also from most liquid to least liquid. So we put the cash and cash equivalents first, and then we put, for example, available for sale, accounts receivable, inventories, prepaid, whatsoever. Regarding the liabilities, it's the same presentation. We said we first put the current liabilities, then we put the non-current liabilities, and below this, we have the equity. Now, right here, you can see that the details of the balance sheet are gonna be covered in study unit 4, study unit 5, 6, 7, 9, 10, and 12. So all of the details will be covered later on. And I showed you that IFRS is different, okay? Because the presentation, IFRS, it's a column, and they start with, for example, non-current assets, then current assets, and current assets from least liquid to most liquid. But then you saw the presentation, it's totally different. But right here, this is US GAAP. Also, if you want to take a look at IFRS, for those who were not here at the beginning of the session, I'm just gonna show you. This is the IFRS. So non-current assets, then current assets, then they put the equity, then they put the non-current liabilities, then they put the current liabilities. That's how it works under IFRS. But definitely the content, it's the same. The standard is pretty much the same. Current assets, we talked about it. Non-current assets, we did the same. We explained the current liabilities and non-current liabilities. And as I said before, we will cover the assets and the liabilities in different study units. So that's just an intro section. Also, we explained this exception regarding the short-term liabilities that can be classified as non-current liabilities. And we did 2 MCQs related to that concept. Then after talking about this part of the financial statements, we dived into the details of the income statement, mainly the continuing operations and discontinued operations, okay? Now, just to make sure that you grasped the discontinued operations perfectly, I'm gonna give you one additional MCQ. So remember, regarding the discontinued operations, what we did was the following. We said, first, to be classified as held for sale, there are 5 conditions. And usually the day of the exam, they use the keywords major strategic shift. So if they tell you that this decision represents a major strategic shift, that means we have discontinued operations. And we said, if I make the decision, for example, in year 4, and I also sell the component in year 4, then I'm gonna have 3 components in the discontinued operations. We're gonna have the loss from operations, which is the same. We're gonna have impairment loss, and we're gonna have gain or loss on disposal. But we said, if we make the decision, for example, in year 3, and then we complete the sale in year 4, then you need to be careful. In year 3, there will be 2 components, the loss from operations and impairment loss. And in year 4, we will have loss from operations and loss on or gain on disposal. By the way, as I said before the break, right here, it's not necessarily a loss. It can be a gain from operations, okay? Even if you have a gain from operations, sometimes you decide to, for example, sell that component or sell that division. So just to make sure that this is clear, we have one additional MCQ. We did 1, 2, 3, 4, 5, 6. We also did 7 together. But I want to take a look at this specific MCQ, which is question number 14. Okay, 14, it's related to the discontinued operation, and 15, it's related to the comprehensive income. So I will make a recap and we'll try to solve those MCQs together. Let's start with, who would like to do this MCQ? MCQ number 14. Anyone? Volunteer? Sacrifice? Come on, yalla, let's be motivated. I need to select someone. Noor, you unmuted yourself, and then Amr. Yalla. Noor and Amr. Let's
Okay.
start. What do we do?
So, on December 31, year one, the board of directors of Maxi Manufacturing Inc. committed to plan to discontinue the operations of its Alpha division.
Yes.
The decision represents a major strategic shift. Okay.
You see keywords, Noor?
Yes, this is a keyword.
Exactly. Major strategic shift and discontinue. صحتين نور كفي.
Thank you. and will have a significant effect on its operations and financial results. Maxi estimated that Alpha's year 2 operating loss would be $500,000 and that the fair value of Alpha's facilities was $300,000. Okay, less than their carrying amounts. Okay, this is an indicator that we have impairment loss.
Yes, we have an impairment loss exactly because we said if there is a difference between the net realizable value and the carrying amount, that means we have an impairment loss. Let's continue.
Okay. The estimate for year 2 turned out to be correct. Alpha's year 1 operating loss was $1,400,000 and the division was actually sold for $400,000 less than the carrying amount of Maxi's effective tax rate is 30%. In its
Okay, so
year
what's the
2
call?
In its year 2 income statement, what amount should Maxi report as loss from discontinued operations?
By the way, the day of the exam, when you have multiple choice questions in front of you, always read the call of the question. And right here, I say in year 2, what amount lost from discontinued. So I know that they are talking about the discontinued operations. It's a good strategy to read the call of the question first. So now, since this MCQ, it's a little bit challenging because it has a lot of information, we're gonna take it to Excel. So that's the first step. This is MCQ 14. Okay, it's a screenshot of MCQ 14. Now, always ask yourself, when you have discontinued operations, when did we make the plan and when did we complete the sale? So right here, what did they say? The board of directors committed to a plan when?
In year 1.
Exactly. Even if it's the last day of the year, even if it's December 31, year 1, but it's considered year 1. And when did they complete the sale?
In year 2.
Exactly. So I have year 1 and year 2. Accordingly, I will write down year 1 and year 2. Usually in the year of decision, how many components do you have in the discontinued operations? You have?
2 components.
Yes. The first one.
The first one is the loss from the operations and the impairment loss.
Yes, and the impairment loss. But pay attention to something. The date of decision, it doesn't matter. Yani, even if they tell you December 31, year 1, they made the decision. When it comes to the loss from operations, you have to take it for the full
amount.
Full year, exactly, full amount, full year. And even if the decision was made on December 31, I'm gonna take the loss from operations from beginning of the year till end of the year.
Okay.
Right here, the loss from operations net of tax is reported for the
full amount, full year.
Full year 1. So now let's take a look at the following. Did they inform us about the value of the loss from operations in year 1?
Yes, the value $1,400,000.
Okay, Alpha's year 1 operating loss was 1.4 million. Yes. So right here, we will put $1.4 million. But definitely, this is not net of tax. We did not take into consideration the tax. They said the effective tax rate is
30%.
The government's share is 30%. Your share?
70%.
Yes. But remember, loss, let's report them as negative figures to avoid any error in the calculation. So I will say it's minus 1.4 million times
70%.
Exactly, times 70%. And now impairment loss. Impairment loss, this is if there is a difference between the fair value less cost to sell and the carrying value or book value.
Okay, so it's $200,000.
$200,000. Why $200,000?
It's the difference between, sorry. Okay, I missed the, okay.
Yes.
Year to the, wait, okay. The fair value was 300. I thought that it is 300,000. Okay.
So
So
what
it's
did they say?
300,000. The recoverable amount is 200,000. So the loss is 300.
Okay, they said the fair value was 300 less.
Then the carrying amount.
If the fair value is less than the carrying value, that indicates?
There is impairment loss.
Exactly. That indicates the impairment of 300K. But again, 300K, remember the tax rate is 30%. So you keep
260.
70%. Yes, 70%, 210, right?
Okay.
Okay, let us insert a column right here. So I'm gonna make a right click and I will say insert. We agreed on the following. We said right here, it's minus $1,400,000, correct? And we said for the impairment, it's minus 300.
Yeah.
But we need to take into consideration the tax effect.
Sorry, Sarah, I have to leave just for a second.
Yalla, okay, no worries. Let us continue, Amir. So I need to also calculate the tax. Now, regarding the tax, you have to multiply this 1.4 million by
70%.
exactly, and the 300K.
Also by 70%.
Yes, so let me remove it from here and let me say times 0.7 and we need to add equal. Okay, and right here we say equal 0.7 times this value. All right, we're gonna get minus 210. So what is the total loss from discontinued operations for year one?
1,190,000.
Exactly. And now let's try with year two. Year two, they said we have first the operating loss. And by the way, the operating loss for year two, it has to be from beginning of the year till the selling date.
Yeah.
Okay, it's not for the full year like year one. It's from the beginning of the year till the selling date. So what is the selling date? Did they specify the selling date or they just said?
No, they just said year two.
Exactly. Year two operating loss would be?
$500,000.
Yes.
We assume that that is still selling day.
Exactly. So I'm gonna say it's equal to minus $500,000. But again, the government's share is 30%. You keep
70%.
exactly. We keep 70%. Accordingly, right here, I have a loss from operations net of tax of 350. But there is a challenge. It's the gain or loss on disposal. Amir, what did we say about the gain or loss on disposal? How do we calculate it?
That is the selling price minus the net realizable value.
Yes. So it's the selling price minus the fair value less cost to sell. And right here, fair value less cost to sell, it's the net realizable value. So if I look at the information that is given to me right here, what did they say? They said
it was sold for $400,000 less than its carrying amount.
So can I say that this is the loss on disposal? It's 400K?
No.
No. Bravo, Amr. Why? Because we said the gain or loss on disposal, it's the difference between
selling price and the NRV.
Yes, NRV, the fair value less cost to sell. But right here they said it was actually sold for 400 less than the carrying amount.
Yeah.
What shall I do in this case? In this case,
here we know that the NRV is also, we don't have the carrying amount. We know that NRV is 300,000 less than carrying amount. So we can do 400,000 minus 300,000 to get 100,000.
Exactly. You can do it like this, or you can make assumptions. So if you are there the day of the exam and you find some difficulty solving such an MCQ, what you can do is the following. You can say right here, they said the fair value is 300 less than carrying amount, right? So you make assumptions. You say, let me assume that the carrying amount is 400. If the carrying amount is 400, Amr, what will be the fair value if it's 300 less?
0.
It will be 100.
Oh, 100, sorry.
Right? Because 100 is 300 less than 400. So that's fine.
Yeah.
And then if they say it was actually sold for 400 less than the carrying amount, I know right here that the carrying amount and my assumption, it's how much?
0.
In my assumption, 400, right? In my assumption at the beginning, when they said the fair value was 300 less than the carrying amount, I said, let me assume the carrying amount is 400. If the carrying amount is 400 and the fair value is 300K less, that means the fair value is
100K.
100. Now they said it was actually sold for 400 less than the carrying amount. You are correct. So if the carrying amount is 400 and if the selling price is 400K less, that means my selling price is
0.
0. 0 minus fair value less cost to sell. Do you have the net realizable
Loss of 100,000.
100.
Yeah.
So 0 minus 100, what is the gain or loss?
Loss of 100,000.
Exactly. It's a loss of 100,000. Or as you said before, automatically you can say 400 minus 300, it will be 100. But if you feel a little bit scared the day of the exam, make assumptions. So let me assume, even if you change the assumption, by the way, it's going to work. I'm going to give you another assumption. Let me now assume that the carrying value is 500. So Amir, if the fair value is 300K less, that means right here, the fair value less cost to sell, it's how much?
200,000.
200. So now when I tell you selling price was 400 less than the carrying amount, 400 less than 500, the carrying amount, it's how much selling price?
100,000.
100 minus the fair value less cost to sell in your assumption.
Again, 100,000.
Exactly, 100 minus 200. Again, the loss on disposal will be the
100,000.
same answer, 100.
Yeah.
So even if you change your assumptions, you're going to reach the same result at each time. So now when I look at this, 100, it's before taxes. Remember, the government's share is 30%. We keep
70%. So 70%.
exactly. So 70% times 100, and I will report it as a negative because it's a loss. So I'm going to get this value. So now what is the loss from discontinued operations in year 2?
420,000.
In year 1?
1,190,000.
Yes. And now what's the call of the question? They are asking about the loss of year 2 or the loss of year 1?
Year 2.
Exactly, year 2 income statement. So how much we will report in year 2?
For loss of 420,000.
Exactly. We will report a loss of 420,000. So now when I scroll down, you can see that among the options, the correct option is
420,000.
yes. Makes sense, that type of question. So sometimes if you are there the day of the exam, as we learned, the first strategy is always start with the call of the question. That's the first step. The second step, when you understand right here, you know how to proceed. So for example, discontinued operations, try to understand the situation. When did we make the decision to discontinue? When did we sell that component? And work accordingly. If you face some difficulties understanding such type of information, try to make assumptions. So say, let me assume that this is the carrying amount. Let me assume that this is the fair value less cost to sell, and you build your answer accordingly. We have another MCQ. Amy, MCQ number 15. Would you like to do it?
Yes, I will try.
Yeah.
A company reports the following information as of December 31. Sales revenue, 800,000. Cost of goods sold, 600. Operating expenses, 90. شو؟
$1,000.
Okay. Unreleased holding gain on available for sale. Debt securities net of tax, 30,000. What amount should the company report as comprehensive income of this as of December 31?
So remember, what is the call of the question?
Comprehensive income.
What is the formula? It's like a math equation. Comprehensive income is equal
the sale.
Yes, net income.
Net income.
Plus the OCI. So when they ask you about the comprehensive income, read carefully. Did they ask you about comprehensive income or other comprehensive income? Did they put the word other?
No, so it's only a comprehensive income.
Exactly. And what is the
So
formula?
I don't take the operating expenses.
We will take it. Let's take it step by step. So as a formula, we said it's the net income plus OCI.
Other
Comprehensive income. Exactly. Let us start with the net income. Net income, do you include in your P&L the sales revenue?
As a net income?
Yes.
It's not net.
Okay.
Bala.
You see, we take it. Okay, let us go back to the first page. Okay, I forgot. And I'm preparing for my CPA exam. So right here, I see an income statement. What did we include in that income statement? Look at the following image. Did we include net sales?
Yes.
Yes. Did we include cost of goods sold?
Good
Also
sold.
yes.
Yes.
Definitely yes. It's always there in the P&L. P&L, it means your profit or loss. You include
Okay.
all revenues, all sales, all expenses, all cost of goods sold, all gains or losses. And you say, this month I have a gain, this month I have a loss.
The
So
others,
also in the others, but in the others, we had different presentations, the way of presenting the P&L. You see? It's
Okay.
just the presentation. But if we want to simplify the P&L, what is your P&L? P&L is your profit or loss. So usually it's the sales and the revenues minus cost of goods sold minus all expenses. And definitely
Yes.
plus other gains, minus interest expense, minus depreciation, minus amortization, minus taxes. So everything. Accordingly, the revenue, ask yourself, is this balance sheet or income statement account?
Okay.
Revenues, income statement, right?
Income statement.
When I say cost of goods sold, is this balance sheet or income statement account?
Income statement.
Income statement. When I say OPEX, operating expenses, SG&A, selling, general and administrative expenses,
Uh,
income statement or balance
income.
sheet? Exactly, income statement.
Okay.
So unrealized holding gain, unrealized gain on available for sale debt security.
It's balance sheet.
Yes,
Not of tax.
balance sheet OCI. So now remember, we said comprehensive income equals to my net income, my profit, plus the OCI. Right here, net income, look at everything related to the income statement. So sales revenue, this is 800. It's in the P&L.
Yes.
Minus cost of goods sold, right?
Minus 90, the
Exactly.
expenses.
So 800 minus 600 minus 90. This is how much? What is your net income? We're gonna make the calculation and we will obtain, I think, 110. Am I correct?
140.
110.
لحظة.
Yes, let's verify. Okay, we can verify.
110. Yeah, 110.
Simply the day of the exam. Also, don't put the zeros. Simply say 800 minus 600 minus 90 to gain time. So it's 110K. Plus OCI. Is this unrealized gain included in the OCI or not? Debt. What did we say about OCI? The elements of the OCI are puffier. Puffy. Puffy E, forget about the R. So you unrealized gains and losses on available for sale, that security. And I said we studied this in study unit 4. But if you have any unrealized gain or losses on available for sale, that this 30 MA, it will be reported where?
Unrealized gain.
Yes, unrealized gain. Where do you report it? Income statement or balance sheet OCI? Where do you report it?
هلا هي it must be BS بس هلا بتصير income statement.
No, it will
أو
be.
بالعكس.
Okay, let me tell you something. It will be in the OCI. Now,
Okay, OCI, it's for balance sheet, right?
Yes, equity. Remember, if you sell those available for sale later on, then you will
it become income statement.
Exactly. When it's
Okay.
realized, when you sell
Yes.
it later on. We said OCI is the guy who's not prepared to take the CPA exam. So we will put him aside, waiting to take the CPA exam and study it. Once he finishes, he can go to the income statement and take the exam. OCI is the guy that is not yet ready to be incorporated within the income statement. Right? So this 30, it will sit in the OCI. Now later on, if they tell you those available for sale debt securities are sold, you take this 30 out of the OCI and you put it in income.
The income statement.
Yes, but we study this in study unit 4. Again, I repeat. So don't panic if you did not grasp the concept perfectly now, because this is just intro section. So far, we memorized that in the OCI, we have pension adjustments. Do you?
Unrealized.
Holding gains and losses on available for sale debt. If it's equity securities, do you put it in the OCI or in the income statement if it's equity?
Balance sheet.
If it's equity, it's in the income statement.
Uh,
Which study unit is this?
grade
4.
4.
We study it later on. Okay, don't worry about it. I will explain it from scratch. F, foreign currency translation or transaction, the F.
Translation.
Bravo, translation. I, instrument specific credit risk, also study unit 4. And we said E, effective cash flow hedge. We covered this in derivatives. But so far, my comprehensive income, it's 110K net income and 30K OCI. So what is your total comprehensive income?
140.
140. And right here, it's a gain. So I reported it as a plus. And my net income is a gain. That's why I reported the 110 as a plus. So Emil, let's make a recap. What are the elements of the OCI? We call them
Puffier.
puffier, exactly. Or it's under IFRS, the reevaluation surplus. We don't have to study it now. So P, pension, adjust.
ما حفظت.
Yeah, you can memorize it. P, pension adjustment. We are old. We are old. Pension plan, baby.
والله I am old والله.
We are old. Pension adjustment. The U,
Unrealized holding gain. Unavailable for sale debt.
Debt. Okay, remember, debt. F, we need a translator to understand the CPA language. It's the foreign currency. Translation. ترجمة in Arabic. Translation. The I, instrument specific credit risk. This one you cannot memorize it now. You will study it in study unit 4. And E, effective cash flow hedge. By the way, if they tell you we have ineffective cash flow hedge, the ineffective portion goes to the income statement, the ineffective cash flow hedge. Okay, but we will cover this later on. Okay, don't worry about it. For the last time, I'm gonna repeat it. I want you to name the elements of the OCI, other comprehensive income. It's your old MA and you started to forget. Go get which plan? Pension. Bring your pen and write it down. Pension adjustments. Okay, MA?
ما مركز بعد الغدا. بس
يلا،
في شيء ما فهمته.
Tell me.
unrealized holding gain on available. Okay.
Yeah.
It's unrealized يعني why it's يعني
Okay.
اوكي قلنا هي بعدها OCI لانه
we covered this in study unit 4 but I'm gonna explain it just for you to understand it and memorize it.
لا انا فهمتها بس
Yeah, I will explain it. Okay, let me give you a small example. For example, you decide to invest in a certain available for sale debt security. Okay, for example, you decided to invest in a Tesla bond. You originally purchased it for $100, and now at the end of the reporting period, the value of that investment is worth 110, but you still have that investment, you still hold it. So right here, you bought it at 100, now it's worth 110. Are you a winner or a loser in this situation, Ime?
I'm not a winner yet.
You are a winner, but it is
unrealized
because you did not sell it. But now, instead of having something that is worth 100, you're holding something that is worth 110. So far you are a winner and you have an unrealized gain of 10. You see? You have an unrealized gain of 10. Did it make sense now? If you sell it, you're not gonna say this is unrealized. If you sell it, you say it will be realized. And everything that is realized goes to the income statement all the time. The realized things, when you sell something, the result will be reflected in the income statement. But as long as you hold it, it's unrealized. But you have a gain. You are a winner in this situation. So let's assume you bought it at 100 and now the fair value is 90. Are you a winner or a loser in this case? If you bought it at 100 and now the fair value is 90,
Unrealized loss
unrealized loss of 10. So
of
you
10.
see, as long as you have it, as long as you hold it, it is unrealized. But you have it. By the way, same for gold. Let's imagine that years back, you purchased 1 ounce of gold at the price of $2,000. Today, it's worth, let's say, $3,900. Don't you have a gain, Eme?
Yeah, sure, I have a gain.
You have a gain of how much?
1,090.
Yes, $1,900. But is it realized or unrealized?
Unrealized.
Unrealized, because you still have that ounce of gold. When you sell that ounce of gold, your gain, the $1,900, will be
Realized.
realized. You see the difference? So
Yes.
unrealized, it means I still have that investment and I have a change in the fair value, but it is affecting me positively. And instead of having something that is worth 2,000, for example, now I have something that is worth $5,000 or more. That's the idea. So now, when I say OCI, what are the elements of the OCI? We call them puffier. Bring a pen, Eme. Pen,
Yeah, I like it.
pen, pension, adjustments. This is the famous unrealized holding gains and losses on available for sale debt. F, foreign currency translation. I, instrument specific credit risk, which we will explain in study unit 4. And E, that's the effective cash flow hedge. As I said, if they say the day of the exam, ineffective cash flow hedge, the ineffective goes to the income statement. It's the effective portion that goes to the OCI. Make sense now a little bit?
Yes.
Alrighty. So I want you to memorize this puffier. It's super important. Accordingly, so far we're good. So we did some MCQs related to the different parts. But now I'm gonna start with the new thing, which is the OCBO. One of the challenging concepts that the CPA candidates face is the conversion from accrual basis to cash basis. As I said before, accrual basis, this is the gap. This is like IFRS. This is what we do. So for example, if I pay an insurance expense in advance, I debit prepaid. I do not debit the insurance expense itself. So accrual basis, this is GAAP, this is IFRS, which is different than the cash basis. Cash basis, it's like preparing a cash flow immediately. It's like making journal entries just like a cash flow. And by the way, cash basis is OCBOA, other comprehensive basis of accounting. It's special purpose framework. Now, remember, I'm going to teach you a formula. It's a silly one, but it works all the time. And it will always give you the correct result. If they ask you to convert from cash basis to accrual basis or vice versa, I will do like 3 MCQs or more. You have to memorize something. Today, is it cold or hot? What do you think? It's cold or hot? I'm sweating. Cold or hot? It's hot.
Hot.
Hot. Yalla, come on, we're gonna make a joke together. So when it's hot, what do you turn on? The ACs, right? AC. We don't need a fan. بلا المروحة, without a fan. Let's rely on ACs. So I'm gonna start my formula with AC. It's super hot. And remember, I always say it like this. We have a guy who is preparing for his CPA exam and he's depressed because a lot of studying hours, a lot of information. Usually when you are depressed, you eat chocolate, right? Correct or not? Chips, Pringles, Lays, I don't know, eat whatever you want. But this guy, his name is Mika. Mika is so depressed and it seems that he does not like sweets. He prefers pickles. So Mika will eat pickle for the sake of this CPA exam. Now, what does it mean, Mika and pickle? When I say Mika, it means minus increase in current assets. And I will explain to you what's the meaning of minus increase in current assets. And when I say pickle, plus increase in current liabilities. Okay? So now you're gonna tell me, okay, this is stupid. It's a super wonderful formula. It will also help you prepare the statement of cash flow. So if you memorize this AC and the depressed Mika who is eating pickles, you're gonna be able to prepare the operating section of the statement of cash flow. We have an example or too many examples to explain that formula. I'm gonna start with MCQ 8. Khadija, would you like to do it? Give it a try?
Okay, sure.
Yalla, let's go ahead.
So say if your company had 100,000 in cash basis pre-tax income for year 2. At December 31st, year 2, account receivable had increased by 10,000 and account payable had decreased by 6,000. From
then?
their December 30th,
Yes.
Okay,
Yes, let's
from
continue.
their December 31st year 1 balances compared to the accrual basis method of accounting, Savers cash pre-tax income is.
All right. So when they mention accrual basis and cash income basis, it's like if they are asking you to convert from to.
Accounting method from accrual to cash.
Exactly. So I'm gonna start this formula AC, and in between we have Mika who's eating pickles.
Okay.
Saverco had 100 in cash basis pre-tax income. This is the cash basis figure. So where will you put it in the formula?
In the end.
Exactly. It's below the line. This is the 100,000.
Okay.
And then they said accounts receivable increased. Let us think about it. Accounts receivable. Is this current asset or current
asset.
Current asset. Exactly. So I'm gonna say I have an increase in current asset. If you have Mika increase in current asset, what will you do?
Minus.
Minus.
So maybe.
Bravo. So our report minus $10,000 because I have an increase in AR. And then they said accounts payable. Accounts payable, is this current liability or current asset?
Current liability, so plus.
Exactly, plus if it's increase. And right here, what did they say?
Decrease.
Decrease. You do the opposite. So I'm not gonna do plus because I don't have increase. I will do
Minus.
minus. Now you have the accrual basis figure X. X minus 10 minus 6. I'm gonna write down this formula. X minus 10 minus 6 equals to 100. How to calculate
So put all
X?
together.
Exactly.
Remove the 10 and 6 to the right side, which in positive figure, so they will have 116 accrual
Bravo.
basis.
Bravo. So 100 plus 6 plus 10, it's 116,000. So right here, if I look at this at that MCQ, by the way, it's MCQ 8. But let us try to read the call of the question. What is the call of the question? The exact call. Compared to the accrual basis, cash basis is. So let us look at this. Khadija, compared to the accrual basis, the cash basis is lesser or higher?
Cash basis is less than the accrual base by 16.
Bravo.
So when they say compare, we have to minus the both of them?
Yes. And by the way, I'm gonna tell you how to read it. When they say compared to the accrual basis method, cash basis, I don't care about compared to accrual basis. I just say cash basis figure.
Mm-hmm.
Cash basis figure is 100. So is it higher or lower?
Lower.
Lower. Right here, I have the cash basis, which is 100, which is lower. Lower by
16.
16, simply. So when they say compared to something, this is, focus on the this is.
Okay.
So the focus point is cash basis figure. It's lesser. And the difference? Yes, 16,000. Did you get it?
Yes.
All right. So this is the AC, and that's the Mika and the pickle. Now, we have another figure, another question related to how to convert from cash basis to accrual basis and vice versa. Zainab, would you like to do it? Question number 9.
Okay.
Let's go ahead.
Young and Johnson modified cash basis financial statement indicate cash paid for operating expenses of 150 expenses 15,000 and accrued liabilities of 25,000. At the
Alright.
beginning of the year, Young and Johnson had prepaid expenses of 10,000, while acquired liabilities were 5,000. If cash paid for operating expense is converted to accrual basis operating expenses, what would be the amount of operating expenses?
I'm lost, to be honest, because I think that when I read those 4 or 5 lines, I have a lot of information and it's a little bit challenging. So usually, because
Yes.
I'm preparing for my CPA exam, I will take this information to Excel. Okay, so let's put it right here. I'm just copying and pasting the MCQ. This is MCQ number 1.
Okay.
Now, they said cash basis. And we have operating
Okay.
expenses, prepaid, whatsoever. And right here, compared to accrual basis. So when they mention the cash basis and accrual basis, which formula comes up to your mind immediately? AC.
Mika,
Yes, Mika, pickle, right?
Pekka. Yeah.
So we have AC, Mika, and pickle. Now I start with A and I end with the C. This is accrual. So if I want to write it down, that's the accrual figure. And the C, this is the cash
Oh, wait.
basis.
Yes.
Okay, what's the meaning of Mika? Minus increase in current assets. Minus increase. By the way, if you have decrease, you do the opposite. You do, what is the opposite to minus?
Cash basis.
But what is the right here, Mika? It means minus increase.
Minus increase current assets.
Yes. So if you have decrease in current assets, you do
Plus.
plus decrease in current
Plus.
assets. Exactly. What's the meaning of pickle? Plus
Increase
in
the current liability.
exactly. So if you have
And current
decrease,
liabilities.
if you have decrease, what do you do?
Minus.
Exactly. We do the opposite. Now, when
Okay,
they
Tyra, I
Minus
analyze it
decrease
in a
current
different way.
liabilities.
yes, I will explain the different way. Tell me. Yalla, Noor, tell me about the different way. The impact on the cash.
Okay. So sorry. Okay, so for me, I always analyze as if the accounts receivable decrease, this means that I have collected my cash. I have collected cash. So when I collected cash, then this would be positive as a cash basis. Regarding the
Yes, when your AR go lahza, the other way,
increase,
let me do it like this. So this is the analysis
okay,
of the cash
yeah.
flow. So when when your AR goes down, that means it's a plus or minus. When you prepare the cash flow, Noor, what? Noor, you were saying the AR, right? If your
Yeah.
AR is going down, it's gonna be plus or minus in the statement of cash flow.
Okay, since the accounts receivable decreased, then the collected money, it's positive.
Exactly. It's positive. And when your AR goes up, you have more receivables. It means you are not collecting. The impact on your cash is negative.
Would be negative.
Yes. And for example, accounts payable, if accounts payable goes up, it means you are not paying to the vendors. This is good for your cash. So the impact on your cash
So
is
it's positive.
exactly. But right here, the formula that I'm writing is just to convert from the accrual basis to cash basis or from cash basis to accrual basis. And I will tell you that at the end, I'm going to reach your same result. I will show you in few minutes, okay? Because I did not incorporate the income statement figures. Okay, I will prove that you are right. Give me like a few minutes so that we can continue. So right here, when you have such an information, Zainab, they told you beginning of the year that was the prepaid and that was the accrued liability. Then they said end of the year that was the prepaid, that was the accrued liability. When you have something like this the day of the exam, try to arrange your information in a tidy way, tidy manner. This is the tidy manner. So what I do is that I put the balance sheet accounts, the current assets prepaid, and I put the current liability, which is the accrued. and I add the beginning balance and the ending balance. But I want to see things in a tidy way to focus more and answer my MCQs correctly. So right here they said, end of year prepaid, it was how much, Zainab? End of year prepaid expenses?
15,000.
So I put right here at the end 15,000. And they said ending accrued liabilities.
Ending accrued 25.
Yes, so I'm putting 25 in my table. And then they said beginning of the year. What was the prepaid beginning of the year? Beginning of the year, right here, 10,000, right? Let me erase it. What was the beginning of the year prepaid?
Right.
Yes. And the accrued beginning of the year? 5,000. You see the numbers? So I'm arranging my numbers in a table. Now, let me ask you something. Prepaid
Yes.
expenses, is this current asset or current liability? Prepaid expense, prepaid. Always a current asset. So prepaid, what is the nature of the prepaid account?
The expense
Not
asset.
but okay, but by the way, this is
Asset.
prepaid. Yes, it's a current asset. And
Okay.
accrued
But
liability.
it increase يعني minus.
Okay, take it step by step. But I'm analyzing the nature of the account.
يعني
Accrued
هي current
liabilities.
assets وهي
Yes.
من البيجنينج للأند هي increase فنحن minus الفرق اللي increase.
Exactly. So from beginning, from 10,000 till 15, I
سوري بس
have
عم بقتل.
increase. It's fine, خلاص, no worries. So you have an increase. Accordingly, remember Mika minus the increase. So I will put minus 5,000. And now regarding the accrued liabilities, from 5 to 25, increase or decrease? From 5 to 25?
It's increase 20,000.
Yes, so
Increase
pickle,
20,000 plus
increase.
increase.
So plus 20,000. Okay, so far we did the Mika and the pickle in between. Now, if you go back right here, they said cash paid for operating expenses. Cash paid, is this the cash figure or the accrual figure, the cash paid for the OPEX? When they give you the cash paid, cash or accrual basis figure? Abdul Rahman, I think Zainab is facing connection problems. Abdul Rahman, cash paid. Is this the cash basis figure or the accrual figure?
Cash basis.
Yes. And by the way, it's inflow, you collected, or you're paying outflow?
Cash paid to outflow.
Outflow. So you will report it right here in the cash basis figure as
Negative.
negative. So now I have the accrual Mika pickle equals minus 150. Can I calculate the accrual basis figure, this figure?
Yes.
Yes, by the way, the accrual figure, it's always net income or revenues or expenses or cost of goods sold, and it's an income statement figure. It's always income statement figure. The accrual figure right here, it cannot be a balance sheet figure. And by the way, the cash basis, it can be cash basis net income, or it can be cash basis expenses paid, or it can be the cash collected from customers, cash inflow, cash outflow, or the cash net income. So the net income prepaid based on the cash basis. And right here, the accrual figure, it can be the net income prepaid based on the accrual, or it can be the expense, or it can be the revenue, or it can be the cost of goods sold, or whatsoever. So now you have X. X minus 5 plus 20 equals minus 150. Can you calculate X, Abdul Rahman?
Yes.
Yes, you will say it is
150.
minus 150, then
Minus 20. Plus
exactly, exactly, plus 5. So now when I say minus 150 minus 20, this is minus 170. Minus 170 plus 5, what will be the accrual basis figure?
Minus 155.
Exactly. So Noor, look at the following. The accrual figure right here, it's your operating expenses. So for example, SG&A, for example, okay? It's a figure extracted from the income statement. Now, your analysis for the AR and the AP, it's absolutely correct.
Okay.
But I'm using right here Mika and Pickle because my accrual figure is, if it's an expense, I report it
As negative.
if it's a sales revenue,
Positive.
if it's cash paid,
It will be negative.
And if it's cash received right here?
Positive.
Exactly. That's why you see how I'm playing the game? The
Okay.
yes. So it's also used, by the way, the same formula. You can use it to prepare a statement of cash flow. So that was MCQ 9. Do you have any question regarding those MCQs, MCQ 8, MCQ 9, and how did we convert? We're going to have an additional MCQ, by the way.
All is clear.
Yalla, perfect. Let us try MCQ 11. Okay, this is MCQ 11. We're gonna read it from here if you want. We also have time, we can do it, but this is MCQ 11. Amir, would you like to read it, MCQ 11?
Yes.
Let's go ahead.
A company records items on the cash basis throughout the year and converts to an accrual basis for year-end reporting. Its cash basis net income for the year is $70,000. The company has gathered the following comparative balance sheet information: beginning of year and end of year. So accounts payable is $3,000 in beginning of year and $1,000 in end of year. Unearned revenue 300 and 500. And then wages payable 300 and 400. Prepaid rent 1,200, 1,500. Accounts receivable 1,400 and 600.
Okay. The call of the question.
The call question is, what amount should the company report as its accrual-based net income for the current year?
All right. So when they say accrual basis, cash basis, which formula comes up to your mind immediately?
Micah and Pickle.
Yes, is AC, Mika, and Pickle. What I'm gonna do is the following. I will take that MCQ to Excel. This is my famous Excel, right? So I'm putting beginning of the year and end of the year balances. So I have accounts payable, unearned revenue, wages payable, prepaid rent, and accounts receivable. This is what I copied and pasted from here. It's the same information. And right here they said cash basis net income is 70. Is this the A or the C in AC?
This is the C.
C. And they want you to calculate
the A.
The A. So right here in my formula, I'm adding something. I'm saying the C is the 70,000. This is a net income. It's a profit. I report it as positive. Do you know the value of A, or you need to calculate it? It's a question mark right here.
No, it's a question mark.
Exactly. Right here, it's a question mark. Now, if you have Mika and Pickle, for me, the best strategy is to do the following. I'm going to go to each item and label it current asset or current liabilities, and then make the decision at the end. So when I say accounts payable, this is?
Accounts payable is
CL. A current liability. Everything that has the word payable is a liability. Everything that has the word receivable is?
Asset.
Asset. Unearned revenue, deferred revenue, contract liability.
Current asset, right?
Current?
Oh, current liability, yeah.
Yes, the unearned revenues are always current liabilities. We will study them in study unit 2. Wages payable.
Current liability.
Exactly. So it's also a current liability. Prepaid.
Current asset.
Bravo. Prepaid is always current asset. Accounts receivable. Everything
current
that has the word, yes, current asset. Everything that has the word receivable is a current asset. So now what I will do is that I will take total current assets and total current liabilities. Let's take our calculator. This is the famous calculator, and I will use it. Okay, this is my calculator. And I'm going to start with the beginning. Beginning for the current liabilities, it's how much accounts payable?
3,000.
3,000 plus unearned?
300.
I will put it 0.3. Okay, plus wages payable?
300, so another 0.3.
Yes. So in total, my total current liabilities are
3,600.
Yes, this is, you see this $3,600, I'm going to highlight it. Then the ending current liabilities, I'm going to clear my calculator. The ending, I'm starting with
1,000.
Yes, 1
plus 5,000. Plus 500, sorry.
500.
Plus 400, so 1,900.
So what is your total current liabilities?
1,000. Total like starting minus ending.
Okay, but now I'm just putting the totals. Beginning balance and ending
1,900. Yeah.
Yes. Let's work on the current assets. Current assets, I only see this one, Control U, let's underline it. And this one, accounts receivable. What is the total beginning balance? Beginning?
2,600.
Exactly. I have this 1,200 and this 1,400. So this is a total of $2,600. And the ending?
2,100.
Exactly, you have
هي
1,100.
مرة عطانا
Yes, so it's 2,100. So now let's analyze from beginning to ending. From 2,600 to 2,100, did it go up or down?
It went down.
Down, decrease. If I have increase, I do minus. Now it's decrease, I will do
Plus.
plus, the opposite. And you see the difference between those two numbers, this minus this, it's 500. So I will put plus 500. Current liabilities from 3.6 to 1.9. Did it go up or down?
Down.
Down. Decrease.
Yeah.
Remember, if it's increase, I do plus. If it's decrease, I do the opposite. I do,
Add it. You'll add it.
if it's increase, you add it. But right here, look at the following. It's a decrease, right?
Oh, yeah, yeah, yeah.
So I will minus it. Always remember. So when I say pickle, it means plus increase in current liability.
Liabilities. Oh,
If it's decrease,
minus.
you do the opposite. And right here from 3.6 to 1.9, increase or decrease?
It's a decrease.
Decrease, so I will do
so-
minus. That's
so
why
you
it's a
minus.
minus.
Yeah, sorry.
Exactly. So now you have x plus 500 minus 1.7 equals to 70. Can you calculate x?
Yeah, it's 70 minus 1,700 plus 500.
Minus. You always do minus. So you take that value and you say minus this, minus this.
Oh, yeah, because of opposite
Exactly. It's like a math formula. It's like if I'm
side.
saying,
Algebra. Yeah.
exactly, x plus 500 minus 1,700 equals to 71.2, and I calculate x.
Yeah.
So right here, you're gonna reach an accrual figure of,
71,200.
so what is your net income prepared under the accrual basis?
71,200.
Is it higher than the cash basis in this case or lower?
Higher.
Higher, exactly. So right here, what is the correct answer? It's 71,000 and
200.
makes sense to all?
Yes.
All right. Cash basis, accrual basis figure, always remember AC, and in between we have the Mika and the pickle. But if this is an income statement figure, the accrual, okay, if it's income statement figure, expenses are negative, revenues and sales are positive. If it's a net income figure, then this is positive if it's a profit. If it's a loss, you report it as negative. The same for the cash.
Can you repeat that?
Yes. So when I say AC, they can ask you about the conversion from cash basis to accrual basis in two different circumstances. They can ask you to convert a net income prepared under the accrual basis, okay, to a net income prepared under the cash basis.
Yes.
If it's a profit, those values right here will be positives, positive or negative. If it's a profit,
Positive.
yeah. But if they tell you, for example, right here you have a loss, how will you report it?
Negative.
Negative.
Yeah.
Sometimes they don't ask about the net income. They ask about specific, for example, a payment for an expense. If right here the C is a cash payment for an expense, the accrual figure will be an expense from the income statement. So expenses in the income statement are reported as positive or negative? Expenses, negative. And right
So
here,
it will
pickle
be
does not
negative.
change.
Yeah. So it'll already be at negative from before.
Okay, let me give you another example. All right. So first, let me check if we have something similar, and then I will do mine. Don't worry, I will explain it further. I think we can do. No, this one we can do. I'm gonna give you some example. Okay, let us add an Excel and let us make it 20. So I'm telling you, the sales and the revenues in this company, the sales, for example, are amounted to how much? You decide about the value. Amir, pick up a value. How much?
100,000.
100,000. Okay, $100,000. All right. And let's say I'm gonna give you AR, accounts receivable. Beginning AR, give a number, whatever you want. Beginning AR,
10,000.
10,000, and ending AR,
Ending year 6,000.
6,000. Okay. Let's assume that you have unearned revenues. Okay. Beginning, it was 0. You didn't receive any advance. So it was 0. And at the end, pick something, ending balance, for example, for the unearned. 3,000. Heck, roughly. Okay. Now, what can they ask you in this case? They can ask you about the cash that you collected from the customers. By the way, if you are working in a company, the managers can ask you this simple question, and it's extracted from the cash flow, because cash flow under the direct method, you say how much cash you collected from clients. This is the famous question they ask all the time. What is the cash collected from the clients? When they ask you about the cash collected from the clients, it's the same strategy. It's the AC, and in between,
Mica and pickle.
yes, Mika and Pickle. So A is the accrual figure, and C is the cash basis figure. So when I tell you cash collected from the clients, you're answering which question in the AC, Mika, Pickle?
C.
See, exactly, we're finding the answer to this. Now, accrual, when I talk about cash collected figure, what is the income statement figure that is associated with the AR? It is the
Sales. Yeah.
sales. Sales is associated with AR. Whenever you have a sales transaction, you debit AR and credit sales all the time. Which current asset is associated with sales? Now I said you credit sales and you debit
You debit revenue.
AR,
Oh,
right?
okay.
You're selling on credit. And
Yeah.
if you receive advance payment from a client at the beginning of the session, we said you use unearned revenue. So this is the pair that goes together as when it comes to the cash collected from clients. Now look at the following. What is your sales? Sales are reported as positive because these are sales revenues. It is
100,000.
100. Let's look at the AR. From 10 to 6, is it increase or decrease?
It is decreased.
Decrease.
So
Increase, I do minus. Decrease, I do
plus.
plus. So it's gonna be plus $4,000. Unearned, it was 0, now it's 3. Increase or decrease in unearned revenue current liabilities?
Increase. So plus.
Fine, plus, exactly. So it's plus $3,000. So now what is the cash collected from your clients?
100,000 plus 4,000 plus 3,000.
How much cash did you collect?
107,000.
Yes, you can quickly answer the question of the management by saying we have 107,000 collected from the clients. Now, they can ask you this question in a different way. They can tell you how much salaries did we pay to the employees? It's easy. If they ask you how much salaries did we pay to the employees, always take the same formula, which is, what is this formula, Amir?
It's Mica pickle.
Yes. But for the salaries, it's going to be a little bit different. Why? Because when I tell you cash paid to the employees, you're going to answer which figure?
The C.
The C. What is the accrual income statement figure related to the salaries? The income statement figure. I said A is always income statement figure or net income, but it's not balance sheet. So what is the expense associated with the employees?
Wages.
Wages, exactly. Salaries, salaries expense, wages. And Mika, usually, do you have an asset from the employee in case you gave them advances? Advances to employees are assets to the company. Okay? Because usually, if, for example, Amir, you go and say, I want $1,000 advance from your employer. What will your employer do? He will debit?
He will debit
advance to Amir.
okay.
What is the nature of advance to Amir? It's a current
asset.
Asset, because he will receive it later on from you, and they will credit
Cash.
So advances to employees are current assets. And now what is the liability associated with salaries? It's the salaries payable. Or we can call it wages.
Deferred wages also.
Exactly, wages payable. So right here, let me give you an example. Let's assume the salaries expense. It's how much you decide about the value. How much you want salaries expense?
5,000.
Ooh, it's a very small company, $5,000. And now, do you have any advances?
Yeah, 2,000.
Okay, beginning it was 2,000 and then ending
1,000.
1,000. It seems he returned $1,000. Then let's say salaries payable. How much did you owe to those employees at the beginning?
6,000.
6,000 and ending
4,000.
4,000. Okay, now, if I want to calculate the cash that I paid this month to my employees, I will say, what is my salaries expense, my wages expense?
Wage expense 5,000.
5,000, but pay
But it's
attention.
negative 5,000.
Bravo, because it is an expense. All expenses are negative. Only revenues and sales are positive at the level of this line. So now when I say advances to employees from 2 to 1, increase or decrease?
Decrease.
Decrease. If it's increase, I do
You
minus. But here it's a decrease, so I will do
addition.
addition. Exactly. It's this minus this. It's 1,000. Now pickle salaries payable from 6 to 4. It went down. So increase or decrease?
2,000. Decrease of 2,000.
Decrease. If it's increase, I do plus. Now I have to do
Minus.
minus. So this minus this. It's minus 2,000, the difference. So now what is the cash paid to the employees? This plus this plus this. How much?
6,000
And why it's negative? Because it's a cash inflow or cash outflow?
outflow.
Exactly. It's a cash outflow. Make sense?
Yes.
So pay attention to something. This A, it can be the net income prepared under the accrual basis. And it can be right here, the net income prepared under the cash basis. Or if we're not talking about the net income, we can talk about specific figures. So for example, cash collected from clients, right here, it's an income statement figure, it's the sales. If I tell you salaries paid to the employees, right here, cash paid to the employees, right here, you're gonna have the salaries expense. Let us take other pays. So for example, if I tell you interest paid to the bank, okay, I'm gonna take the same, and I will tell you what will change. So right here, cash, which is interest paid to the bank, okay? What will be the accrual figure, the income statement figure related to interest? What do we call it?
Interest expense.
Exactly. Mika, the current asset is interest receivable in general, right? If you have any interest that is receivable, that's the current asset. And for the current liability, it's going to be the interest
Payable.
payable. If I'm talking about vendors, so cash paid to vendors, and let's assume trade. So this is within the core business itself, cash paid to vendors. What is in general the accrual income statement figure related to vendors? It is cost of goods sold. Cost of goods sold, because I'm talking about the vendors related to the core business itself. Cost of goods sold, how do we report it? As positive or negative right here?
Negative.
Bravo, it's a cost. Usually, what is the asset? What do you purchase from vendors? You purchase?
Inventory, yeah.
Bravo. And what is the liability? The accounts, yes, the accounts payable to the vendor, the trade payables. So that's how you can calculate the cash paid, for example, to vendors. Or you can calculate also the cost of goods sold if you have the cash paid to vendor, the inventory and the trade payables. So it depends, but you can move in multiple ways. Just as a recap, A, it can be the net income prepared under what? Accrual basis. And C, it can be the net income prepared under the cash basis. Or we can have right here, it's an expense, and right here, cash paid or collected for that specific expense. Make sense?
Yes.
Okay. Amir, the others, is it clear? Abdurrahman, Emeh, Khadija, Noor, Zainab, all is good?
Yes, yes.
Yalla. All righty. Let us also try MCQ number 10. Okay, so far, let me just verify if we did everything. We did 1 at the beginning of the session. We did 2, 3, we did it. 4, we did it. 5 discontinued operations, we did it. 6, we did it. That was related to the income statement. 7, we also did it, discontinued operations. 8, Khadija did it. 9, yes, I think Zainab, you did it, right? The question number 9. Or Abdurrahman. Who would like to do question 10? We did 11. Yes, we did 11. That's 2. So now question number 10. I want someone, a volunteer. Come on, be motivated. Yalla, you can do it. By the way,
Me, Zainab.
CPA exam, CPA exam, it's 50% motivation and positive vibes, 50% hard work and commitment. But you need this positive energy and you need to feel proud about what you're doing. So positivity comes first. You can do it. If other people did it, that means that you can do it. Believe in yourself. This is the key to succeed. Let's do question number 10. Yeah, let's go ahead. Zainab.
Me?
Yeah,
On
yeah.
April 1, Julie began operating a service proprietorship with an initial cash investment $1,000. The proprietorship
By
provided.
the way, this word, it's called the proprietorship. Okay, so proprietorship, it's a type of business.
Okay. Provided 3,200 of service in April and received a payment of 2,500. Okay.
Yes.
In May, the proprietorship incurred expenses of 1,500 in April that we are paid in June. During May, Julie, okay, drew 500 from her capital account. What was the proprietorship income for the 2 months and ended May 31 under the following methods of accounting?
Okay, so we need to check the cash basis figure and the
الbeginning والending. أول شيء بدنا نشوف من الكاش assets ومن current asset من current liabilities.
Okay, but let's first take this given because this MCQ, by the way, it's a little bit twisted and it's a little bit different from the other MCQs. Okay. What I will do is that I will take it like this, okay, Control V, and I will arrange the format of that MCQ. April 1, Julie started lying. April's Fool's Day, right?
Okay.
Okay, and you say, okay, Zainab, she started lying, April 1. Anyway, so April 1, Julie, she began operating a service proprietorship. How much cash investment did she make?
1,000.
Yes. Usually the initial cash investment, it's part of the capital or not?
Part of capital.
Yes. So right here, I'm going to write down capital. Yani it's part of the equity, correct?
Correct.
Okay, I'm starting my business. And then they said the proprietorship provided 3,200 of services in April and received a payment in May.
Current liabilities.
Okay, but let us try to understand what's going on. I don't know. I will try to make some journal entries just to learn from this example. When I say provided services in April, when the service is rendered, when the service is provided, can you recognize a revenue under the accrual basis? Under the accrual basis, usually, as if you want a simple rule, revenue is recognized, I say revenue is recognized when I deliver the goods, right?
Yes.
And or when I render the service. Yes. So you recognize the revenue when you deliver the goods or when you render the services, in simple words. So right here under the accrual basis, they rendered the service and provided the service in April or May?
In May?
La, they said, let's read this specific sentence.
Okay. Provided of service in April, April.
Exactly, in April. So right here under the accrual basis, in April, what will you debit?
In April, we provided the service, يعني الكاش عنا debit is 3,200.
You did not, pay attention. Zainab, you did not receive the payment in cash. You received the payment in May. So I will not debit cash. I will debit receivable. I did not collect from my clients. I debit AR, but I rendered the service. So can I recognize the revenue?
No, recognize the revenue, yes, because we provided.
Because you provided. So for which value? It's gonna be for $3,200, right?
200.
This is accrual basis figure. So that's what we do in April. Now, after April, you have the month of May. What happened in the month of May? You collected. So when you collect, what
Yes.
happens to your cash? It increases.
Debit.
Yeah, I'm gonna debit my cash.
Increases.
Exactly. I will debit my
Okay,
cash.
we credit the account receivable.
Bravo. And I will credit my AR because my AR is going down. By which value?
Okay.
How much?
2,500.
Yes. So let's put 2,500.
2,500 we collect in May.
Okay. This is the accrual base.
It remains 700.
Yes, 700. It's receivable from the clients. Maybe you receive it in June, July, August. Maybe you will never receive it if it's a bad customer, right? So this is under accrual.
Okay.
Under cash basis, we said cash basis is this gap, is this like IFRS or it's OCBOA, other comprehensive basis of accounting, special purpose framework. What did we say about the cash basis? It's OCBOA.
Okay, Zaprota.
So it's other comprehensive basis of accounting. Cash basis, it always depends on the cash. I collect cash, I book an entry.
ساري عم يقطع شوي الكونكشن.
Everyone is getting disconnected or it's just from the end of Zainab?
I think
Just
from
for
the
me,
end
maybe.
of Zainab.
Okay,
just.
I think, yes, it's from your end. So cash basis, when I collect cash, I make an entry. When I pay cash, I make an entry. That's why we call it cash basis. But definitely the capital, forget about it. Okay, capital does not affect the P&L end of all. Capital means like equity. I'm giving cash to the company and increasing the equity. Okay, so I will not make a journal entry related to the capital. I'm just focusing on the revenues and the expenses. So cash basis, when will you record the journal entry, Zainab? When did you receive the payment from the clients, in April or in May? Look at this sentence
In May.
bold. In May. So under the cash basis, the journal entry will be done.
Received in May.
In May, خلاص, only. You don't record anything. So May, how much did you receive? 2,500.
2,500.
Yes, but by the way,
pay 500.
by the way, pay attention. You collected money. So you debit cash and you record revenue. Revenue is recorded when it's collected under the cash basis. That's why we call it cash basis. Expenses are recorded when they are paid. Revenues are recorded when they are collected. So under the cash basis, when do you record the revenue? Revenue is recorded when it's collected. And expenses, we record them when they are paid. So when you
received.
okay, you do not credit receivable, you record a revenue. So you say debit cash credit?
Collected or received.
Yes, sales revenue. خلاص, sales revenue. Is it okay? Did you understand the difference between the revenue recognition under the accrual basis and the revenue recognition under the cash basis? Under the accrual basis, revenue is recognized, okay, when the goods are delivered or when the services are rendered. Cash basis, it's crazy. Cash basis, I collect the cash, I recognize the revenue. I do not collect, I do not recognize, and I do not book any revenue. Make sense?
Makes sense, Saira.
Yes.
And usually the NGOs, you use them at cash basis, isn't it?
Yes, the NGOs, they use the cash basis. But by the way, the NGOs in Lebanon, they do not apply the correct accounting. You will see the accounting of the NGOs. Let me check with you. If we go, I think it's study units 15 or 16. Let me check right here. This is the last one that I delivered last time. Study unit 15, governmental, not-for-profit, governmental and not-for-profit. Not-for-profit, they have a special way, and I will teach you how to do the entries because they have this satisfaction of time restriction or donors restriction. They use the cash basis, but it's also based on the restrictions. We learn it. Super interesting. Study unit 15, by the way. And it has a FASB standard related to it. It's standard 958. Standard FASB, it's like IFRS 15, IFRS, for example, 9. They have their own standards under US GAAP. The not-for-profits, we follow FASB Accounting Standards Code 958. This is the last study unit 15. But it's cash basis, yes. But it has this specialty, if you want.
Okay.
Noor, you can continue. I think Zainab was disconnected. So now, I'm gonna talk about the expenses. What do we have regarding the expenses right here?
Okay, so as we see, the
The proprietorship,
incurred expenses $1,500 in April that were paid in June. Okay, so we record the expense in June in the cash basis,
bravo.
while in accrual basis we record the expenses in April and we record the payment in June.
Let me write a summary. Okay, this is the summary. Under the accrual basis, like we did with the revenue, expenses are recorded when
In accrual basis, you mean?
yes,
When incurred.
exactly. And under the cash basis, the
When
expenses,
paid.
bravo. So right here, expenses when paid, we record them. Okay? So accrual basis, when you make any journal entry in April or in May?
And the accrual basis in April.
Exactly, because the expenses were incurred in April. So in April, what will we debit? We will debit?
The expenses.
Exactly. And what will we credit?
The payable.
Yes, accounts payable, for example. And in May, you close that liability because they said it's paid not in May, in June.
In June,
So
yeah.
in June, what will you make in terms of journal entry under the accrual basis of accounting when you set
Okay,
it?
so we should credit cash and debit the account payable.
Bravo. So I close that liability in the debit side, I close the accounts payable, and I credit the cash. This is under the accrual. Now, cash basis, I only recorded when I pay it. So when will it be recorded?
June.
June. What do you debit?
Debit the expenses and then
Bravo.
credit the cash.
Exactly. I debit the expense and I credit the cash. So these are the different journal entries. And now when I read the call of the question, they want the cash basis versus accrual basis income. Income. But income for what?
Income for 2 months. Wait. Okay. So this should be splitted for two months as per accrual basis.
By the way, they are calculating the P&L of 2 months. What are those 2 months? May and June or May and April?
Okay, so June, January, April and May.
April and May. Why? Because they said for the 2 months ended May 31. Ended. Yani the
Yes.
last month it's gonna be May 31. So it's May and the month before it's April. April and May. Look at this accrual. April and May, what affects the P&L? Right here, debit AR, credit sales revenue. What affects the P&L?
The expenses.
The expenses
The revenue.
and the revenues, the expenses and the revenues. But just focus on April and May, only April and May. Do we look at June or we disregarded?
We disregarded June.
They don't want June. So April, AR sales revenue, I will take sales revenue, right?
Yes.
Cash and AR, these are balance sheet accounts.
Balance
Do
sheet
they affect the
accounts.
P&L?
No.
And right here, you're debiting expense, crediting AP.
Come in.
Expense, exactly.
Expense,
By the way, the
yes.
value of the expense, we did not write it down, but it's 1,500. Exactly. So now look at this. You have a revenue of 3.2K and an expense of 1.5. What is your income, net income, your profit under the accrual basis?
Okay, 1.7.
Exactly. Because right here, revenue of 3,200 minus the expenses, it's 1.7K. That's under the accrual. Let's write it down. Accrual. What about the cash basis figure? This is cash basis. That's May and June. Remember, we're only focusing on which month?
Just May and April.
Exactly, just May and April. So will I look at this June?
No.
I
we
will disregard
disregard
it. That's offset, okay? Or let's remove it, red. So simply cash basis, you will only report a revenue of?
Of $3,200.
La, pay attention. You collected only 2,500 out of the 3,000.
Okay, perfect.
So it's based on the collection. How much did you collect revenue?
Okay. $2,500.
Yes.
So this is the amount reported in P&L.
Exactly. So accrual, it's 1.7. Cash basis, it's 2.5.
2.5.
Exactly. Make sense?
Yeah, makes sense.
So that's the challenge. Remember, in real life, in the corporate environment, everywhere, we use the accrual basis of accounting. And it doesn't matter if we collect from the clients, yes or not, but we recognize the revenue if we deliver the goods or render the service. Under cash basis, no, it's different. You collect, you record the revenue. You do not collect, you do not recognize the revenue. The same for expenses. Under accrual, I book the expense when it's incurred. It's related to this month. But the cash basis, when I pay it, I record it. I do not pay it, I do not record it. Simple. And you know now the relationship between your accrual basis figure and the cash basis figure. You have the AC, and in between, it's the Mika, the pickle. That was a good practice regarding that part. By the way, now we can take another coffee break of 15 minutes, and then we continue with the study unit 2. So during the break, we were discussing together about what we were covering and what we were explaining. We did study unit 1 from A to Z. Again, as discussed, I think we're gonna give you access on Monday or Tuesday maximum, inshallah. So I will send you the credentials and the details, and you will have access to the Gleim platform. Then we will discuss how you can solve MCQs and task-based simulations from the Gleim platform. Also, on the other hand, when you solve simulations, when you solve MCQs, and you do not understand why this is the correct answer, bring it to me, okay? Send it by email, send it to the WhatsApp group, and we will solve this issue together in class so that everyone can learn from your experience. But it's very important to study on a timely manner. All right, today, also, we're gonna start with study unit 2. Definitely, we will not finalize study unit 2. I will introduce a few pages from it, and then next Saturday, we're gonna continue with study unit 2. Study unit 2, it's about the income statement items. The first one, it's the foreign currency transaction gains and losses. So now, I will try to ask you something. Abdurrahman, foreign currency transaction versus foreign currency translation. Which one is in the OCI? Which one is in the income statement?
Foreign currency translation is in the OCI, and the
Bravo.
transaction is in the income statement.
Exactly. So the translation is in the OCI, the transaction is in the income statement. Translation, we're gonna learn it together. Okay, I will show you the foreign currency translation later on, but now we're gonna focus on the transaction. All right, let's scroll down a little bit to take some examples and some definitions into consideration. We have functional currency, and foreign currency transaction. When I say functional currency, it's the currency in which you're doing business. Okay, so let me give you an example. I am a company based in Lebanon. If I am a company based in Lebanon, what is my local currency? My local?
LBP.
Exactly, LBP, Lebanese pounds. Khadija, if I am based in KSA, what is your local currency in KSA?
Saudi riyal.
Exactly, the Saudi riyal. Amir, if you are based in UAE, what is the local currency in UAE?
AED.
Exactly, AED or dirhams. Now, when I ask you about functional currency, it means the way you're doing business. For example, in Lebanon, even if the local currency is LBP, we issue invoices to clients in dollars, US dollars. We pay to the vendors in dollars. We buy from the vendors in dollars, and we pay salaries in Lebanon in dollars. So what is the functional currency in Lebanon? It is dollars. Yes, exactly, Abdurrahman. It's the dollars, the primary economic environment, the currency in which you are doing business, and you have to take into consideration the volume. So, for example, all of the invoices are issued to the clients in dollars. All of the invoices are received from the suppliers in dollars, and all of the salaries are paid in dollars. So it's dollars. That's our functional currency. By the way, if I look at UAE, Amir, for example, if you issue the invoices to the clients in dirhams, and you pay to the vendor in dirhams, and you pay salaries in dirhams, what is the functional currency in UAE?
Dirhams.
Dirhams, AED the same. So now, Khadija, when I look at UAE, the functional currency and the local and reporting currency, for example, they prepare the financials in AD, aren't they the same?
No, they're not.
In some companies. If some companies have dollars as functional currency, then the local currency and the functional currency will be
Same.
different. But it depends. For example, in Lebanon, are they the same or they are different, LBP versus dollars?
They're different.
Yes. Let's assume you are based in Saudi Arabia, in KSA. Okay, you're doing business, you're issuing invoices to the clients in SAR, you're buying from the vendors in SAR, you are settling salaries in SAR, and your local currency is SAR. So can I say in your company, the functional currency and the local currency are the same?
Yes.
Yes, in this case, they are the same. And by the way, foreign currency, it's any currency different than the functional. Any currency different than the functional, we call it foreign currency. So for example, in Lebanon, if I tell you British pounds is, it's a foreign currency. Why? Because the British pounds is a currency that is different than our functional currency. And you know that we have exchange rates. And now we're gonna talk about the foreign currency transaction. Sometimes we have specific transactions denominated in different currencies. Let's say I am in UAE. All of my sales invoices, all of my purchases are in dollars, but I have this specific vendor based in France from which I buy in euros. So in this case, I have a specific transaction denominated in euros, noting that my currency, the currency that I use is dollars. And right here, they tell you foreign currency transaction. It means you have a transaction that is in a currency that is different than your functional currency. So for example, I am a company and my functional currency is dollars because I pay in dollars, I pay salaries in dollars, I pay to the vendors in dollars, I collect in dollars. So my functional currency is dollars. So any transaction denominated, let's say in euro, it's gonna be, or it's gonna result in a foreign currency transaction. We're gonna have a gain of exchange or loss of exchange. We have an example for a better understanding. Right here, it's example 2.1. But before I do that example, I'm gonna take you to my Excel and solve the example that we have in Excel, and then I will explain it using, let's say, the book. Who would like to read that example? This is the example. That's the fact, by the way. Let me highlight. Yalla, let's go ahead.
I can do it.
Let's go ahead, Noor.
Okay. Facts. On January 2, 2020, Sarah Co. purchased goods on credit for 100,000 Namibian dollars. Sarah
Alright.
Co. paid for the goods on January 02, 2021. After 1 year, this means the exchange rates
And
were...
then, what are the exchange rates given to
Okay.
us?
At the date of the purchase was $0.1. The Namibian dollars to dollars is 0.1. At the end of the year of 2020 is 0.08. At the date of the payment, which is to January 21, is 0.09.
Okay.
So it decreased.
By the way, this is a company based in the USA. USA, what is the functional currency in the US?
US dollars.
Exactly. So I'm gonna write down functional currency is the dollar. And if I have transaction denominated in Namibian dollars, isn't it another currency other than the dollar?
Yes, it is.
Yes. So I'm gonna have a difference of exchange. We're gonna have a gain of exchange or a loss.
Gain or loss.
Exactly. And by the way, right here in Lebanon, for example, we use the word DOE. What's the meaning of DOE?
Difference of exchange.
Exactly. There will always be some differences of exchange. January 2, 2020, what did Sarah Corporation, which is an American company, do?
Okay, the purchase of goods for 100,000 Namibian dollars.
Exactly, but the currency in the accounting software that they use, do they have Namibian dollars or they put everything in dollars?
US dollars.
Exactly. So they're gonna debit inventory or purchases, and they're
Okay.
gonna credit accounts payable to that vendor based in Namibia. All
Yeah.
right?
Yes.
How will they record it when they purchased the goods? January 2, 2020, what was the rate?
0.1.
Yes.
So 100,000 divided by 0.1.
Divided or times?
It's times 0.1.
Exactly. because definitely the dollar, the US dollar, is stronger than the Namibian dollars.
Yes.
So I'm gonna have 100,000 times 0.1. It will be
$10,000.
yes. Usually, Noor, you work as an auditor. So
Yes.
end of each year, when you go to visit your clients, what is the question that you ask them regarding the difference of exchange? What do you ask them? Did you run the
If they-
DOE? Don't you ask them that? Did you run the
Yes.
difference of exchange in the accounting software?
Yes.
All right. So end of each month or end of each year, if you are reporting on a monthly basis, you have to run the difference of exchange end of each month and adjust the numbers. But
The
if you
monetary items.
monetary, right?
Yes.
Exactly. So right here, end of the year, end of year 2020, I have to look at the new rate. Now, the 100,000 Namibian dollars, if I calculate the counter value in US dollars, it will be how much?
It will increase the amount in US dollars.
It will be less in US dollars, right?
Okay. Yes. Yes.
Because 100,000 times 0.08,
It will be $8,000.
yeah, 8,000.
So
But
the
as you said,
inventory should be reported based on the rate on 30 on the spot rate, which is 0.08. The same time for the accounts payable, which is also a monetary item, so it should be reported at the new rate at the end of the reporting period.
exactly. So Noor is mentioning something important. She told me when we run the difference of exchange, we segregate between two categories, the monetary items and non-monetary items. By the way, the inventory is a non-monetary item. Why? Because of the risk of obsolescence, the devaluation, and other things. So it's non-monetary. But accounts payable, at the end, you have to pay it, right? So the accounts payable is a monetary item. Now, the difference of exchange, we run it on the monetary items or the non-monetary items?
Monetary items.
Exactly. It's only the monetary. So right here, the inventory, I will not touch it. I will leave it as is. It's recorded at the spot rate, the original one. It will remain $10,000 on my balance sheet. But this accounts payable, I will adjust it. So I say it was $10,000. Now it's 0.08 times 100,000 Namibian dollars. Now it is how much? $8,000. So did that liability go up or down in value? Liability.
It decreased
Exactly. It decreased. By how much did it go down?
by 2,000. This will generate for
Exactly.
me.
So when your liability is decreasing, you're gonna debit that liability or credit that liability?
I should debit it for sure.
Debit, because it's getting reduced. And definitely you are a winner. It's a liability, it's an obligation. It went down from 10,000 to 8,000. So what is the gain on exchange?
$2,000.
Yes, this gain on exchange, it's on a specific transaction. So where do we report that specific gain? In the
Income statement.
exactly, in the income statement or in the net income. That's how we report it. Now, when did you settle that liability? When did you pay to the vendor?
Okay, we paid on 2 January 2021.
Exactly.
Where the rate was
The date of payment.
0.09.
Yes. How much will you pay the date of payment, the 2nd of January, to the vendor?
Okay.
Yes, you're gonna go to the bank, and the bank is
So the rate increased.
yes, 9,000. Now think about the following. I will have a cash outflow of $9,000.
$9,000.
Yes. And remember, you close your accounts payable because now it's settled. No more payables to that vendor in Namibia. Right here, we had 10,000 and it was reduced by how much? By 2,000.
By $1,000.
10 minus 2. So what is your liability on the balance sheet?
$8,000.
Yes, you have now to close it.
I have to settle it.
Yes, you have to settle it. You have to back it out. You have to close it. I will reverse that accounts payable for 8,000. I still need $1,000 in the debit side. That's gonna be my, again,
Loss on difference
yes,
of
yes, you have a loss of
it's
exchange.
loss on difference of exchange.
Exactly, it's a difference of exchange. It's a loss of exchange. It goes to the P&L. It goes to the income statement. It goes to the net income. You can call it statement of earnings. We're gonna repeat.
Can we go back to one idea you
Yes.
mentioned before regarding the inventory? Okay, I am okay that it's compared the less between net realizable value and cost. But what if the selling price decreased due directly and related to the change in US dollars rate or Namibian rate?
You will not sell it for less. Why? Because when you extract your balance sheet, Noor, in the American company, you're gonna see that you purchased that inventory for $10,000. Are you gonna sell it for less?
Okay. So it will be treated on the US dollars.
Exactly. Because now you are reflecting your books based on the US dollars. Khalas, now when I sell it, I'm gonna sell it maybe for 13,000. If I sell it for 13,000, I'm gonna make a gain of 3,000. This is my gross profit.
Okay, makes sense.
Alright. So let's make a recap just to understand, because it's a little bit complex at the beginning. So we have this American company, it's called Sarah Corporation, and it's buying goods from a vendor in Namibia. Khadija, the question is addressed to you. When did we make the purchase? January?
On January 2nd.
Exactly. January 2, 2020. So January 2, 2020, what was the rate?
0.1.
Exactly. So 100,000 Namibian dollars times 0.10. This is how much in dollars?
10,000.
All right. So now you purchase goods. What will you debit?
Good. Inventory.
Yes,
Account
balance
payable.
sheet. Exactly. And what will you credit?
Account payable. So
Alright.
this is the normal transaction as every purchase, right?
Exactly. Every purchase. I'm going to debit the inventory or the purchases, and I'm going to credit the accounts payable. We dive more into the details in study unit 5.
Okay.
Second step. Now, end of the year, when the auditors come to visit your company, what do they ask you to do? To run the difference of exchange, or also on a monthly basis. Am I correct?
Yes.
So usually when you are using, for example, Oracle or SAP or Microsoft Dynamics or any other software, when you run the difference of exchange, it runs the differences of exchange at the level of cash and cash equivalents, the banks, the AR, the accounts payable. Why? Because usually we run the difference of exchange at the level of the monetary items only. And by the way, monetary, it means value is fixed. And if you have to pay $10,000, you have to pay $10,000. If you have to pay 100,000 Namibian dollars, you have to pay 100,000 Namibian dollars. Maybe you will purchase more euros, less euros to settle it. Maybe you will purchase more dollars, less dollars to settle it. But the value is fixed. It's denominated, for example, in Namibian dollars. So the difference of exchange and the companies, it's always run at the level of the monetary items only. But when I say property, plant and equipment, fixed assets, inventory, are these monetary or non-monetary items?
Non-monetary.
Non-monetary. So right here, you say inventory, it's non-monetary. So do you run a difference of exchange at the level of this account or no DOE?
No DOE.
No DOE, no difference of exchange. But when I say accounts payable, it's monetary item. Yes. So I run the difference of exchange on that. So end of the year, when the auditors come and they want to see everything is perfect, you have to re-evaluate into brackets. So you have to see this accounts payable. When you made the purchase, your liability was 10,000. Now, end of the year, it went down. Is this in your favor or not? Khadija?
No, it's not in my favor because
let's calculate.
I purchased يعني دفعت فلوس أكثر.
لا, it's the opposite because it's a liability. Look at this. Your liability.
ما دفعت يعني. Okay.
Exactly. So right here, your liability, if you compute it, it was worth in American dollars how much?
10,000.
Yes. Now you are based in the US. If you want to pay 100,000 Namibian dollars, how much you should pay?
8,000. Which is good.
8,000. Less. So your liability in dollars went down. How do you reduce the liability, in the debit or in the credit side?
Debit.
Bravo. I will debit. I will reduce it by the difference. What is the difference between the 10 and the 8?
2.
Yes. And you have a gain or a loss of exchange?
Gain. Okay. يعني أقفل الأكاونت بالgain حقي.
Exactly. You close it with the gain. And that gain, because it's related to a specific transaction, where do you report it? OCI or income statement or net income?
Net income, because it's exchange. Yeah.
By the way, if you are using Oracle or SAP or Navision or QuickBooks or other software, when you run the difference of exchange, the system automatically creates the loss of exchange and the gain of exchange in the income statement automatically, and automatically adjusts the value of the accounts payable. You don't do those entries manually because it's run by the system. But when the system runs the DOE, the difference of exchange, you can go to the chart of account and check this difference of exchange, and you will see that it was run on the AP, AR, cash and cash equivalents, banks, etc. Make sense? Now, when did you pay to that vendor in Namibia, Khadija?
2021.
Yes. So you went to the bank, to your American bank. I said, I want to transfer 100,000 Namibian dollars. And I would say, okay, the rate today is
Okay.
0.09.
09.
So how much you should pay in dollars to settle that liability to the vendor in Namibia?
9,000.
Yes. This is your cash of, this is the money that you have to pay to the bank because the date
Okay.
of settlement, they said it's 0.09. So what will you credit?
Account payable.
Yeah,
No.
credit, you're paying. You're
Cash.
closing. Cash. So your
Correct.
cash is going down. Now remember that accounts payable, it needs to be closed because you're paying the dues. I had 10,000 adjusted by 2,000. So
باقي
what is
فيها الحساب باقي فيه 8,000 أصلا فأقفله اللي باقي فيه.
exactly? You close the remaining balance. So 10 minus 2, how much is remaining in that account payable?
8.
You close it as is. خلاص. Remove it from the balance sheet. It's settled. Now look at the entry, 9 in the credit, 8 in the debit. I still need,
1.
this is a gain of exchange or loss?
Because it's in the debit side, it's loss.
Bravo. All losses are in the debit side and all gains are in the credit side. Since this is a loss, it's going to be in the debit side. Income statement or OCI?
Income statement.
Income statement. All of the gains of exchange on transactions are reported in the income statement and all the losses as well. So this is the first example. Make sense? Yeah. All right. Abdurrahman, let's try example 2.1. It's very similar and we've got the logic. What do we have in example 2.1?
On November 15, year 1, JRF Corporation, a U.S. entity, purchased and received inventory from South Corporation, a French entity. The transaction was fixed in euros and cost for JRF to pay France 500,000 euros on January 15,
Sorry,
year
Abed,
2.
can you raise your voice?
I think Abed
Yeah,
has
okay.
a problem in his microphone. The voice is low, but he fixed it a few minutes ago. Yes, it's fine.
Yeah, right now. So,
Yeah,
I
that's fine.
repeat, okay. The
Okay.
transaction is fixed in euros and calls for JRF to pay Paris 500,000 euros on January 15, year 2. On November 1, in November 15, year 1, the euro-dollar exchange rate is 1.2 to 1 euro.
Okay. Usually when I used to see similar questions, I used to panic because I don't like to see something like this. But that's super simple. Okay. Simply, the way you read this is that to buy 1 euro, you need $1.2. Okay. Or يعني to buy 1 euro, I need $1.2. This is how I can read the euro-dollar exchange rate. But in this simulation, or if you want, in this scenario, I need to understand what's going on. November 15, year 1, we had this corporation, which is a U.S. entity. Since this is a U.S. entity, it's going to be reporting its financial statements and the functional currency, everything will be in what currency? It will be in?
US dollars.
Exactly, in
Dollars.
US dollars. But we purchase a specific inventory from Paris, European country, and they said we have to pay to that vendor in
Euro.
Now, November 15, year 1, the American company is recording the purchase. It has a liability to that vendor in France, and it purchased goods. So what will we debit? What will we credit?
Debit the inventory
Exactly.
and the credit accounts payable.
100%. The inventory or the inventory, is this a balance sheet account or not?
Balance sheet account.
Current assets, current liabilities, non-current assets, non-current liabilities, or equity, the inventory?
Current assets.
Exactly. And the accounts payable, what is the nature of the accounts payable?
A balance sheet account, current liability.
Yes. So November 15 year one, they said €1 is worth $1.2. That if you have to pay 500,000 euros to that vendor in France, how much dollars you should have?
500,000 times 1.2.
Exactly. By the way, you can do the rule of three. Rule of three, you can say $1.2, it purchases €1. If I had 500,000 euros, I need how much dollars? It will be 500 times 1.2. So that will be $600,000. Now you tell me, end of year one, should we run the difference of exchange at the level of the monetary items?
Yes.
Yes. Inventory, do you run the difference of exchange at the level of inventory, or you keep it as is, recorded as $600,000?
No, we keep it recorded at $600,000. It's
Exactly.
non-monetary item.
Exactly. It's a non-monetary item. So now for that accounts payable, I need to run the difference of exchange on that accounts payable. If we go back to the continuity, they said end of December, what was the exchange rate now?
1.55.
Okay, $1.4 to
1.4.
yes, to €1. But if I think about it, I have a liability. That liability is 500,000 euros. So now the 500,000 euros, if I want to go to my American bank and settle the 500,000 euros, how much dollars do I need? I need 500,000 times 1.4, correct? It will be $700,000. Too
700.
much. Oof. So the value of my liability in dollars, it went up from 600K to how much?
700.
Exactly. Winner or a loser?
Loser. You have to
Loser.
pay 100.
Exactly, loser. You have $100,000 loss of exchange. So your liability is going up because you are recording your liabilities in dollars. How do you increase your liability, in the debit or in the credit side?
The credit side.
In the credit side, I will increase my accounts payable and I will book against it in the income statement.
A loss on foreign currency.
Exactly.
Don't actually.
The loss on this foreign currency transaction, that loss of exchange. That loss of exchange, it goes to the OCI or income statement because it's on a specific transaction.
Income statement.
Exactly. It goes to the income statement. And by the way, the date of settlement is,
January 15 year 2.
yes, date of settlement, January 15, year 2, when you paid. How much did you pay? $1.55 to €1. Yani right here, if you have 500,000 euros, how much did you pay in dollars? If I take the calculator, 1.55. Eh?
775.
Exactly. It's $775,000. So the cash in the credit side, the cash that you paid when you went to the bank, you said, I need to pay to that vendor 500,000 euros. And the bank said, this is the rate. So the bank withdrew from your account 775. This is the cash. Now remember, liability, you close it. Previously, we recorded accounts payable of
600,000.
and then we increased it by
100,000.
so how much total liability you have on your balance sheet? 600 and 100?
700.
700. Now you close it. So you close it in the
Accounts payable on debit side.
exactly as is. I close it. It's out of the balance sheet because now it's settled. I still need 75,000 in the debit side for this transaction to balance. It's gonna be
Not on foreign exchange.
exactly also in the income statement. By the way, if you look at this specific transaction, that company incurred a huge loss, 175. They incurred $175,000 because of this transaction denominated in euro. We will talk later on about the derivatives and the hedging and these kind of things, but it's important. All right. Also nowadays, if you look at the euro rate, euro is appreciating against the dollar. Euro is becoming stronger. So if you have a liability in euro, you'll be a loser because if you have dollars on hand, you have to pay more dollars now to close that liability in euro. Make sense? But for example, if you are based in Europe, let's say you are based in Luxembourg, When you are based in Luxembourg, how do you get paid? In euros or in dollars?
In euros.
In euros. If your salary is $4,000, okay, you are, for example, working remotely and operating, let's assume in UAE. UAE, it's a big question mark. You know why? Because in UAE, the dollar is pegged. So when I say dirhams and dollars, it's pegged. For example, 3.65 or 3.66 or 3.67. But the euro, it fluctuates a lot and they don't give you the rate of the market. But let's assume in Lebanon, it's the same. So in Lebanon, before, when it was equal, let's say the rate was $1, it used to purchase, for example, 1.08 euros. Now, is this correct or it's the opposite? So 1 euro buys $1.08 few months ago.
The $1 buys $1.08 euros.
Euro, few months ago, 1 euro used to purchase $1.08. But now, with 1 euro, you can purchase more dollars. You can purchase around $1.16 with 1 euro. So if you used to get a salary of 4,000, if you convert this 4,000 to dollars, it will be more dollars in the past. Yani, if I make that calculation, okay, let us take a calculator just to understand the rates. So 4,000 euros, it was 1.08. And how much dollars? 4,320. But now, if you are working remotely to a company based in Luxembourg and you are getting 4,000 and you are taking the 4,000 to the exchange house here in Lebanon to get dollars versus it, they will give you based on the rate of 1.16. So they will give you 4,000 times 1.16. You're gonna get now 4,640. You are a winner. Your salary in Lebanon is worth more in dollars. You see how we should read things? Make sense? So right here, 1 euro used to purchase $1.08 few months ago. Now, the 1 euro can buy $1.16. You can check the rates on Owanda. You can check the rates on Bloomberg. So you can say euro versus dollars today. It's 1.16 something for sure. You see, it's 1.16. Now, if you try to check it few months back, you see it was at a certain point in time, it was 1.08 in March. Then it went up to 1.09, then 1.10, 1.13, 1.14. It went down a little bit, then up again. And by the way, nowadays, the euro and the gold are moving in the same direction. So whenever the euro is appreciating, the gold is appreciating as well. For political reasons, okay? I'm not gonna dive into the details. We studied this in bar discipline. If you are interested later on to learn more about those things. But that's how it goes. Okay, makes sense? All right. I will assume it's clear. We still have 45 minutes and right here also you can see the examples that we have in Gleim also drafted on Excel. If you want to have a better understanding or if you want to check the formulas, you can double click and check the formulas that we did in order to get the correct answers. Now we will start with the earnings per share. I will cover as much as possible during the 45 minutes and then we're gonna continue next week. Earnings per share, by the way, which is known as EPS, it must be followed by the public entities and by other entities that choose to report. So the private companies, they can decide not to report the EPS, but for the public companies, they will report the EPS. Also, you can make some searches. So you can say EPS for, let's say, Tesla, for Tesla. And right here, they tell you the EPS for Tesla, Tesla EPS, earnings per share, 2010, 2025. So you see, Tesla 2023 annual EPS was $4.3. That's the profit per common share, earnings per common share. In 2024, it went down to 2.04. So there is a decrease. If I am an investor, will I be happy with that result or I will be a little bit upset? What do you think? For the investors, they're not gonna be happy with this. Okay, they're not gonna be happy with this. And by the way, look at the EPS for the quarter ending June 30, 2025. It was $0.33, 17.5% decline. I'm not really happy with the results. I don't like it. This is the earnings per share. Okay, I'm not talking about the value of the share itself. The value of Tesla share, it went up. You see, today it's $329. Definitely, it wasn't worth $329 back then. But we're talking just about the earnings per share. By the way, the earnings per share, if you want to understand the formula of the earnings per share, it's gonna be simply this one. They tell you the basic EPS, the basic earnings per share, it's the income that is available to the common shareholders divided by the WACSO, weighted average common shares outstanding. So that's the formula of the basic EPS. Let me ask Amir, the income that is available to the common shareholders, is it the full net income, or we need to back out the dividends paid to the preferred shareholders?
Yeah, we need to subtract that.
Exactly. So the income that is available to the common shareholders is the net income excluding the preferred dividends. And the WACSO, this is the weighted average common shares outstanding. Do we include the preferred shares number in that denominator?
No.
No, we do not include. Let's take a look at this example. Example 2.3, what do they say?
At the year end, an entity's capital structure consisted of 10 million shares of $1 par value common stock. The entity issued no new shares during the year. Its income from continuing operations and net income for the year were $1,278,000 and $1,141,000 respectively.
Yeah, if you're calculating the basic EPS and your numerator is the income from continuing operations, which is we're going to assume that this is the income available to the common shareholders. Accordingly, I will divide this income available to common shareholders, the income from continuing operations, by the WACSO. How many weighted average common shares outstanding do we have?
10 million.
10 million. So I'm going to get 0.128. This is similar to Tesla. The Tesla's number that we have checked a few minutes ago, right? It was 0.13 right here.
Yeah.
0.33. My bad. I did not focus. Okay. And now, if we use the net income as a numerator, what will be the basic EPS in this case?
Yeah, that'll be the net income divided by the WACSO.
Exactly.
0.114.
Yes. So this is the basic EPS. Is this a mandatory reporting for the public entities?
Yes.
Yes. For the private?
No.
That's you decide. If you want to report it, report it. And by the way, do we calculate EPS for preferred stock, or it's only for the common stock?
It's only for common stock.
Exactly. It's only for the common stock. And now they said, if an entity has no discontinued operations, the income from continuing operations equals net income. By the way, this makes sense. You know why? Because we said net income is the income from continuing
operations, yeah.
plus
Other comprehensive income.
plus discontinued operation, not the comprehensive income. Remember, study unit 1. Okay, I will close those unnecessary pages. Let me go back right here. We said it's income from continuing plus income from discontinued. Is the discontinued is 0, then the income from continuing operations will be equal to the
net income.
Yes, and this is what they are trying to say. They said if no discontinued operation, if discontinued operation is 0, then the income from continuing operations will be equal to the
net income.
Net income. Okay, makes sense?
Yeah.
All right. And now, I want you to pay attention to something.
Yeah.
When it comes to the preferred dividends, some preferred dividends are cumulative and some other preferred dividends are non-cumulative. What is the difference between the cumulative preferred dividends and the non-cumulative preferred dividends? What is the difference? Let's think about it. Who has an idea about it? The difference between cumulative and non-cumulative.
The cumulative, the preferred dividends, if it was cumulative, then we calculate it for the next year.
Okay.
Move it also for the next year.
Okay, and
non-cumulative, it's allocated for each year for the amount that is declared.
Okay, so pay attention to something. Cumulative, if we declare the dividends, you are entitled to it because it's cumulative. And even if the dividend is not declared, aren't you entitled to it even if it's not declared? It's fine. It will accumulate because it's cumulative. So if you have a cumulative preferred dividend, the dividend will accumulate whether whether declared or not declared. But non-cumulative is different. If they declare it, you get it. If they do not declare it, forget about it. That's the difference. So when I say cumulative, it means it accumulates. Whether declared or not declared, خلاص, automatically it accumulates. But when I say non-cumulative, it means I declare it, I get it. I do not declare it, I do not get it. Make sense? So right here, I'm saying cumulative preferred dividends, always take it into consideration, always, because it accumulates automatically. But non-cumulative, pay attention. You only take it into consideration if it's declared. Because if it's declared, it's your right. If it's not declared, it's gone. Noor, makes sense? The others, does it make sense?
Yes, makes sense.
All right. So we have this example. Amy, let's try it. Example 2 for basic EPS numerator. Amy is muted.
Yes.
What?
An entity has two classes of preferred stock. It declared 4% dividend on its 100,000 of non-cumulative preferred stock. The entity did not declare a dividend on its 200,000 of 6% cumulative preferred stock. Undistributed dividends for the past 4 years have accumulated on the stock. The following is an excerpt. Okay. شو يعني
Extraction.
Okay, from the entity's condensed income statement for the year.
Okay, so right here, I'm a little bit lost because they have cumulative and non-cumulative preferred stock, right?
Right.
Let me make like a recap to have a better understanding and to make a summary. So I'm gonna write down non-cumulative. What is
4%
the value?
dividend.
Right here. It's 100,000, right?
Right.
And what is the dividend percentage? Dividend percentage?
4%.
Yes. So the dividend percentage, it's 4%. So far, so good. Did they declare it or they did not declare the dividend? What did they say right here?
The entity did not it declared the 4%, did not declare the 6%.
Exactly. The other one was not
cumulative.
Yes. So right
it's not
here, I'm
declared
writing
the 4%.
What is the second one? Cumulative or non-cumulative? The second preferred stock?
Cumulative.
Okay, I'm gonna write down cumulative. And what is the value of the second cumulative preferred stock?
200,000.
Yes. And what is the dividend percentage?
6%.
Yes. And
not declared.
Not declared. Now, it's super important to see whether we have to take this into consideration, yes or no. So cumulative, what did I say regarding the cumulative?
It's always, we take it into consideration.
Exactly. Do I care about whether it's declared or not declared, or I do not care?
I do not care.
I do not care. خلاص, cumulative, it accumulates automatically. It's taken into consideration. So now when I want to take it into consideration, what is the value of that dividend? 6% of the preferred stock, 6% of the 200K. What is the preferred dividend on the cumulative preferred stock? It is simply, you say 200 times 6%, it's 12,000, right?
Right.
So I have 12,000, and that dividend will be taken into consideration in the EPS. Why? Because the dividend is
cumulative.
If it's cumulative, do you care about whether it's declared or not?
No.
No. But non-cumulative, we have to be careful. We only take it into consideration if it is
declared.
And right here, this non-cumulative, isn't it declared?
Yes.
It is declared. So 4% times the 100K, this is how much?
4%?
Yes. 4% times 100, so this is 4K. Okay. So now what is the total preferred dividend that I will take into consideration in my calculation?
The sum of 12K
exactly.
and 4K.
Okay, 16.
Exactly. It's $16,000. We have $16,000 of preferred dividends that will be taken into consideration in my calculation. Okay, so now they also give us other information. What is the other information shared with us?
There is continuing operations
Yes, income from continuing operations
and discontinued operation.
all right, and discontinued operations. So right here, what is the income from continuing operations?
$1 million.
And the loss from discontinued operations?
It's a loss, okay.
Yes. So what is the net income, continuing and discontinued operations?
870K.
Exactly. So now, when I want to calculate the basic EPS, we say in general, it's the net income available to common shareholders divided by WACSO. Right here, you can use the net income. And if you want, you can also use the income from continuing operations. If we use the income from continuing operations, we're going to say it is the 1
million.
But pay attention, what is available to common shareholders is the 1 million minus the preferred dividend. So it will be 1 million minus how much preferred dividends in total do we have?
16K.
Yes. So here my numerator will be the 1 million minus 16,000. If you decide to take the net income instead of income from continuing operations, you're going to say it's the net income minus preferred dividends. So what will be your numerator in this case? What is your net income? Look at this.
870.
Yes, the net income is 870. So 870K minus 16K, what will be your numerator in this case? 854, right?
Right.
So that will be your numerator. And definitely you take that numerator, which is the income available to common shareholders, and you divide it by what?
WACSO.
WACSO. What's the meaning of WACSO? Weighted average common shares outstanding. So what does it mean, the word WACSO, Eme? Weighted average common shares outstanding. All righty?
Okay.
Here, do we
Yes.
take into consideration the preferred shares or it's only the common shares?
Sorry, ما سمعت السؤال.
Do we take into consideration the preferred shares or only the common shares in the denominator? Right here in the denominator, it's only which number of shares? The common
The
shares.
common shares.
Do you include the preferred shares into consideration in the calculation? No. Because we said the basic EPS, it is only for the
Common stock.
common stock. So what is the formula of the basic EPS right here? What did we say? Let's read this formula. Income
Okay, it's
available
income available to common shareholders
divided
by weighted
WACSO.
average number of common shares outstanding.
Exactly. And by the way, when I say net income available to common shareholders, what does it mean in other words?
Net income minus preferred dividends.
Exactly. It's the net income minus the preferred dividends. Make sense?
Yes.
All right. So this is an additional MCQ. And right here, they're gonna teach us how to calculate the denominator. So, Zainab, what do we call the denominator in the basic EPS formula? The denominator, we call it
WACSO.
WACSO. It means, what is the abbreviation of WACSO? Weighted average common shares outstanding.
Outstanding.
Outstanding. So it's the weighted average common shares outstanding. By the way, let me ask you something. If a company is making an issuing shares, when you issue shares, it means you're selling shares. When you sell shares, to whom you sell the shares, Zainab?
Suppliers.
Shareholders. Shareholders. So when you sell your shares to the shareholders, when you issue shares, do you have an increase in the equity or decrease?
Increase.
Increase, because more shareholders.
More
so
shareholders.
that's why upon issuance, what do I do to the WACSO, the number of shares?
number of shares denominator increase.
Increase.
So
I'm sorry. And now, if you sell, this is if you issue the shares. What if you buy back your shares? When you repurchase, for example, your shares, or when you repurchase the
equity decrease.
exactly,
Equity.
it will decrease. And by the way, upon issuance and repurchase, if you are calculating the weighted average, does the date matter or it's not important?
It's important. Date
It's
matter.
important. Exactly, the date matters. It's important when you calculate the WACSO, the issuance date and the repurchase date is super important. So right here we have an example. I want you to read this data that we have, and I will tell you how to calculate the WACSO. Okay, I will not use this approach. I will use a different approach. This is my approach. I will explain it to you. So what do we have in this example? Example 2.5 basic EPS denominator. You can read it.
Okay, عنا January 1 beginning balance 2040 بمارش 1
240,000 common shares outstanding.
240
Exactly. And then,
بمارش 1 issued 60,000 shares.
yes.
صاروا يعني كانوا 240 صاروا 300.
No, we issued 60,000 shares, but pay attention to something. The date, does it matter or it's not important?
It's important.
It's important. And usually when you have issuance, the number of shares increases or decreases?
The number of shares increases.
Exactly. Upon
repurchase 20,000 shares.
Yes, it will go down,
decreases.
right?
Why?
Because
They
repurchase, it's not issuance. Repurchase is the opposite to issuance. By the way, when you repurchase, let's assume you are a company. And if you are buying back your own shares, for example, if you buy back your own shares, will you receive cash or you will pay cash when you buy back your own shares?
Buy cash, pay cash.
Yes, repurchase, you pay cash. So you credit or you debit the cash?
Credit the cash.
Right. That debit, it's your equity, right?
Yes.
So your equity is going down or up in the debit side?
Debit equity gone up. We
equity,
buy.
it goes down in the debit side. Equity goes down in the debit side. Liabilities go down in the debit side. Okay, so equity and liabilities, they go down in the debit side. So that's why we say it's a minus. And accordingly, when you repurchase your shares, your equity goes down. 300K minus 20,000, it will be?
Okay.
280 in total. But by the way, these numbers are not relevant because we said with issuance and repurchase, the date is super important. We have to make a pro rata.
Yes.
I will not rely on these values. And finally, November 1, we did another issuance of
80,000 shares.
Yes. Okay.
يعني
So now, what are we trying to calculate? Now we are trying to calculate the
importance of dates. بدنا نشوف
WACSO. Okay. WACSO, weighted average common shares outstanding. So let us start with the following. January 1, you started with how many shares?
240,000.
Yes. So I will put right here 240,000 shares. Now, issuance. When you have an issuance, is it a plus or a minus issuance?
Plus.
Plus. So I will put plus. How many shares did we issue?
60,000.
60,000. I will put 60,000, but here issuance date is important. So March 1 you issued. It means March, April, May, June, July, August, September, October, November, December. How many months?
10.
10. So I will multiply by 10 divided by 12. Or you can say January and February lapsed. So 12 minus 2 months, that lapsed 10. So I will multiply by 10 divided by 12.
Yes.
Repurchase. If it's a repurchase, you do plus or minus for the WACSO?
Minus.
So I will put minus 20,000 because we repurchased 20,000 shares. But again, date is important. August 1. So you have August, September, October, November, and
December. 5 months times 5 of
12. Exactly. I will multiply by 5 divided by 12. Again, issued plus or minus?
Plus.
Plus 80,000 times November 1. So we have November and
December. 2 months
So I will
divided
multiply by 2 divided by 12. Now, when you make that calculation, you see, you make the calculation. For example, 60K times 10 divided by 12, this is 50K. 20K times 5 divided by 12, this is 8,333. And 80K times 2 divided by 12, this is 13,333. 240K plus 50K plus 8.33K plus, minus, plus 13.33K, we're gonna get a WACSO of how much?
WACSO of 306.
200. I did the calculation. It's underlined in green. How much,
WACSO of,
Dina? 295.
240,000. Yes.
Yeah, okay. So by the way, it's 295. I did the calculation already. Okay?
Okay.
You can verify this calculation if you want. But if you make 240K plus 50K plus 8,333 plus 13, minus again, I keep on saying plus. Minus 8,333. Yes. It's gonna be 295K. So now if we scroll down a little bit, there is another concept related to the WACSO. Okay? And Abdurrahman, stock dividend and stock split. So when I say stock dividend, we are distributing dividends to the shareholders. But instead of giving them cash dividend, we are giving them a dividend in form of what? Stock. That's why we call it stock dividend. So for example, Abdurrahman, you are a shareholder, you have 100 shares. We want to distribute dividends, but we will not give you cash. So maybe we're gonna give you additional 10 shares. And now your new number of shares will be 110. So what is the difference between stock dividend and cash dividend? Cash dividend. Yes, cash dividend is dividend in form of cash. Stock dividend.
In form of shares.
We cannot hear you properly at all. Stock dividend is a dividend in form of stocks in forms of shares. Stock split, I will explain to you about the stock split, but pay attention to something. When we have stock dividend, stock split, the date is not important. I don't care about the date. I do my calculation with a retro effect. It's like if it occurred at the very early beginning. It's not like the issuance and the repurchase. Issuance and repurchase, we make a pro rata and the date is important. Stock dividend, stock splits, the date is irrelevant. You do a retro effect with a retro adjustment. Who would like to do example 2.6? Because this example, it includes the stock split and it includes the stock dividend as well. Who would like to do it? Yalla. Let's go ahead, Amir.
Yeah, so this is using the data from example 2.4, assume declaration of a 50% common stock division on June 1st and 2-for-1 common stock split on October 1st. So yeah, can we use the same method that you used, the one where you only take the...
Exactly. So at the beginning, there are no changes. So we started with how many common shares?
240,000. So we can multiply that by...
I'm putting.
Yeah.
And
then 60,000 multiplied by how many months?
Exactly.
March.
Issued.
April,
So plus or minus?
Yeah, we have to plus. Yeah.
Plus. So plus the 60,000 times 10 months divided by 12. Then now they changed. By the way, when they introduce and when they incorporate the stock dividend and stock split, I advise you to make subtotals. Okay, so calculate subtotals. So at the beginning, I'm starting with 240. Then I issued 60,000 shares. We said 60 times 10 divided by 12. This is how much? We did the calculation right here. It's 50K, right?
Mm-hmm.
So now I need to calculate the subtotal. 240 plus 50K, Amir, it's how much?
290.
Yes. Now, when they say stock dividend, does the date matter or it's irrelevant?
Irrelevant.
Irrelevant. I assume it's like if it occurred beginning. The beginning, the number of shares always it's 100. And now you have additional 50% dividend in form of stock. So the new coefficient is 110. 50. Because stock dividend, imagine if you have 100 shares, and imagine that they declare a 50% stock dividend. How many additional shares will you obtain?
50,000 additional.
Yes, so you'll have 50 additional shares. You're gonna end up by having 150. Am I correct?
Yes.
So when they say there is a stock dividend, always add 100%. 100% plus 50%.
So should we say that 240, 50% of 240?
No. First, forget about the 40, okay?
Oh,
Just
okay,
say
okay.
50% stock dividend plus the original 100%, the base.
Yeah. 250,000 shares.
It will be 150. So
Yes.
I need to multiply by 1.5. But what will you multiply by 1.5? The subtotal that you had.
Oh,
So I
okay.
started with 240. Then we issued, plus we did the calculation. This is my subtotal. Whenever you have a stock dividend, whenever you have a stock split, you work on the subtotals.
Okay.
Work on the subtotal simply. So calculate the subtotal for the past history and multiply by 1.5. So I'm gonna start again. They said beginning balance is 240. What is your starting point?
Your starting point is 240,000.
Exactly. Then they said issued. So I will add the 60,000 times
10
how
divided by
many
2.
months? Yes, because we said with issuance and with the repurchase date is important. So
Yeah.
I'm gonna add 50K and I will obtain a subtotal. What is my subtotal at this level?
290,000.
Why did I calculate a subtotal?
Because you
Because
were gonna
I
have a
see
stock
that there is
dividend.
a stock dividend. Whenever they have a stock dividend,
The date doesn't matter, but we need the
you
subtotals.
calculate. Exactly, but calculate the subtotal. So now 100%, it's always base 100%. If you have a stock dividend of 50%, you're gonna have a percentage of 150.
50%.
So 150% in terms of decimal, this is how much?
1.5.
So now I take the 290 and I multiply it by 1.5. When I take the 290 and multiply by 1.5, what is now my new subtotal?
435,000.
Yes. So I will continue. We're done with the first three scenarios. Then they said we repurchased
20,000 shares. So we have to
if you are
subtract
repurchased.
1,000.
Yes. Is that important?
Yes.
Yes.
So we need to
With
multiply the
repurchase and issuance date.
20,000. We have to multiply
Yes.
the 20,000
August, September,
by
October, November, December. You're gonna multiply by.
So August, September, October, November. Yeah, 5
Exactly.
months. Right.
Yes. Bravo. We're gonna say it's minus 20,000 times
5 by 12.
5 divided by 12, right?
Yeah.
So if you say 20 times 5 divided by 8,333. So now your calculation, you will say it is 435 minus 8,333. What is your new subtotal?
Minus 8,333. 426,000.
426,667, right?
Yeah.
Yes, right here, 20,000 times 5 divided by 12. It is minus 8,333. And when I make my calculation, 435K minus 8,333, I'm gonna get how much?
426,667.
I'm gonna get how much? I'm gonna get, exactly, we're gonna get 426,667. So this is my new subtotal. By the way, just focus on something. If you have, let's say, stock split, stock dividends, reissue, repurchase, you can always calculate the subtotals. Always calculate subtotals. So what we are currently doing is that we are calculating the subtotals. All right?
Yeah.
Make sense?
Yes.
Okay. So right here, I did the 435. And then I said, I have repurchase. So I made minus 20K times 5 divided by 12. And now what is my new subtotal?
426,667.
426? Yes. And now again, pay attention. You have 2-for-1 stock split. I'm gonna explain to you about the stock split, okay? Let me do it right here. If they say 2-for-1 stock split, it means the number of shares is doubling and the par value is divided by 2, but the total does not change. Let me give you an example. So let's assume I have 100 shares and the value of each share is $2. So what is your total value? The total value of the shares?
Is
100 shares times 2. What is your total value right here? It is 200, right? So this
Yeah.
is the number of shares. That's the par value, let's say, and that's the total. When you do a stock split 2-for-1, write it down like a fraction, 2-for-1. So 2/1. 2/1, what is the coefficient that you obtain?
2.
2, right? 2 divided by 1, it's 2. So the number of shares will double and the par will be divided by 2. This is what happens. So when I say 100 times 2, it's how much?
200.
How many shares?
200 shares.
200. And 2 divided by 2, it's 1. So now
1.
look at the total. 200 times 1. Does the total change?
No.
It does not change. It remains
Same.
200. By the way, why do the companies make like stock split? Sometimes they make stock split to reduce the value of the par to become more affordable. So for example, if you are an investor and you only want to purchase one share, it will be easy for you. Instead of paying 2, but imagine if it's $2,000. Instead of paying $2,000, now you can pay $1,000. That's why they do the stock split, to increase the number of shares so that it becomes more affordable for the investors to purchase those shares or the shareholders to purchase the shares. Make sense?
Yeah.
So when they tell you right here, at the end, I'm going to make a recap. No worries. If you did not understand, we will make a recap together. When I say 2-for-1 stock split, write it down as a fraction, 2/1. 2/1, this is how much? 2. So number of shares will be doubled times 2. So what will you do right here at this level?
Multiply by 2.
You will multiply, yes, multiply by 2. And you get this new subtotal. Before I make a recap in deep details, at the end, what did they do? They
Issued another 80,000.
issued additional, yes.
80,000.
Upon issuance, does the date matter or it does not matter?
It matters.
It matters. So I will say plus 80,000 times how many months from November 1 till end of the year?
2 by 12.
Exactly. All right, let's make a recap. Just for us to understand this calculation, the 866,667. Okay, I will repeat it. So first thing, that's the last idea for today, and we will end the session. I'm gonna take a screenshot of the date and the transactions that occurred. Then I will go to Excel to have a better understanding. All right, let's start again. All righty, Amir. So what is your starting point? We said beginning balance, how many shares?
240,000.
They told me, yes, 240. Then they said issued. Upon issuance, 60,000, it's a plus. Does the date matter?
Yeah.
It's March
So,
1. So January
10
and
by
February
12.
lapsed. You need to multiply by, yes. So now, shall I calculate the subtotal? It's always good to calculate the subtotal. What is your subtotal at this level?
290,000, yes.
Yes, 290. We're done with the second transaction. Now the third transaction, distributed 50% stock dividend. If you have stock dividend, does the date matter?
No.
No. And if I have stock dividend, always add the percentage 100%. 100% to the 50%, add them together. So what is the new percentage?
150%.
150%. 150%, if you want to write it down as a decimal, it will be how much?
1.5.
Exactly. Here it's taking it, okay, as a decimal. خلاص. I'm simply going to say it's 1.5. So right here, you will multiply by how much?
1.5.
By 1.5. And we said the date is not important. So what is the new number of shares times 1.5? What is the new number of shares?
435,000.
Exactly. So we're done with this, we're done with this, we're done with this. And now, August 1, we have a repurchase. Repurchase, that's a plus or a minus?
Minus.
Minus. Does the date matter?
Yeah, yes.
Yes, times. You have August, September, October, November, December. How many months? 5. So I will multiply by 5 and divide by 12. What is the number of shares?
8,333.
Yes. And now I calculate again my subtotal. Subtotal, this plus this. What is your new subtotal?
426,667.
Yes. Again, you have 2-for-1 stock split. When they say 2-for-1, write it down like a fraction. 2/1, this is how much?
2.
2. So the number of shares will be multiplied by 2. Does the date matter or it's irrelevant?
Irrelevant.
Irrelevant. So now I'm going to say the new number of shares, this times 2, it will be
853.
853,333. And the final transaction, it's issuance. Issuance, it means your number of shares is increasing or decreasing, the issuance.
Increasing.
Yes. So plus 80,000 times the date matters?
Yeah, so 2 by 12.
Exactly. So now what is the final number of WACSO?
866,667.
Yes, so it will be 866,667. So if I go to that page, you see at the end, how did we obtain that calculation? WACSO, it's easy. I always calculate the subtotal at each level. With issuance and repurchase, date is important. Stock split, stock dividend, date is not important. Make sense?
Yes.
All right. Yeah, perfect. By the way, Aimee, in the previous example that you did, what was the income from continuing operations? What was the income from continuing operations? Aimee?
Yes.
What was the income from continuing operations? 980. Look at this, you did it. You remember when we said
Okay,
it's the income from continuing operations, it's the preferred dividends of 16,000?
Okay, of 16, yes.
So we calculate.
Okay.
So now, if you are calculating the basic EPS, you will say it's the income available to common shareholders, which is, if you are taking the income from continuing operations, it will be how much your numerator? 984. And you divide by this WACSO. What is the value of your WACSO, for example?
866.
866, 667, yes. So I'm going to divide by, for example, 866,667 shares. So if I take my calculator, 984,000 divided by 866,667, what will be my basic EPS?
1.13.
Yes, 1.135. So you see this 1.135? And if you decide to take the net income as a numerator, how do you calculate your basic EPS in this case? How will you calculate the basic EPS? What will be your numerator? The net income available to common shareholders, it will be?
Net income.
Exactly. The 854,000 divided by, what is your WACSO? The same. So now try this calculation. Aimee, 854,000 divided by, what is our WACSO?
866.
This
666.
It will be, yes, you see? Exactly.
Yes,
right here, if you scroll down, they tell you it will be 0.985 if you're using the net income as a numerator.
Okay.
But we calculated the WACS. So just as a, I'm not going to start with the diluted EPS today. Just as a recap, what is the formula of the basic EPS? Give me the formula of the basic EPS. It's the net income available to whom? Available to preferred and common shareholders, or only common shareholders, Aimee? Only common shareholders. So when I say net income available to common shareholders, it means, in other words, the net income minus the preferred dividends. We back out the preferred dividend. And right here, you remember when we talked about cumulative and non-cumulative?
Okay, yes.
You remember. So this is the numerator. And we divide by the calculation that Amr did. What do we call that calculation?
WACSO.
WACSO. The weighted average common shares outstanding. In the WACSO, If you have issuance, do you make a plus or minus?
Issuance, it's a plus.
Repurchase, yes. Stock dividend, stock split, we do times. Stock dividend, stock split, we do times. Date is important with the issuance, repurchase, stock dividend, or stock splits. Where the date is important?
Issuance.
Issuance and repurchase. But stock dividend and stock split, do we take the date into consideration or we do not look at the
No.
date?
We do not look at
Exactly.
the date.
Exactly. Right here, preferred dividend. If it's cumulative, you always take it into consideration or not? We said
Cumulative?
yes, because it accumulates automatically. So whether declared, not declared, does it matter?
No, it doesn't matter.
No,
It's cumulative.
automatically accumulated. Bravo.
Automatically, yes.
Non-cumulative, to take it into consideration, it
It must be declared.
Bravo.
Declared.
If it's non-cumulative and not declared, do you calculate it? Do you take it into consideration in the calculation?
No, I don't. No.
Exactly. Exactly. That's absolutely correct. So I think that's enough for today. We covered study unit 1 in full and partially study unit 2. We only covered the basic EPS. But next time, okay, we're gonna continue with study unit 2. What you can do meanwhile is I will send you all the notes, all the Excel, so that you can start repeating those concepts on your own. So tomorrow on Sunday, if you have free time, try to sit and try to review everything we did in class. If you want to rewatch the recording and take notes, that will be good. The Excel, it has all of the notes that you need to get, but also you can add on top of it and make your own Excels. You can make your own notes. During the weekdays, try to read the notes and try to understand how the calculations and the different concepts work. And once the access is given to you, you can start doing multiple choice questions and simulations. And as I said before, in case you're facing difficulties, in case you're facing problems with the multiple choice questions and or simulations, you can send them by email, you can send them on the WhatsApp group, and we will solve them together in class. So we will allocate some time to solve them. Next time, I'm gonna add multiple choice questions and simulations. So we will work on additional MCQs and also, as I said, task-based simulation. This is mainly everything regarding today. Again, and as I always say, it's all about motivation and hard work. It's all about positive energy. It's all about believing in yourself. Always tell yourself, if the others did it, that means that we can do it. At the beginning, maybe you're going to struggle a little bit with the load of information, but after that, you're going to get used to it, and you will find that it will add value to your experience. If you want to get a better job, if you want to get a better salary, you need the CPA certificate, for sure. All righty.